We are going live, both on GoToWebinar and YouTube. And just waiting. Welcome to the show, everybody. It's good to have you. All right, it looks good. It takes a second to make sure to spin up the YouTube machine, and I just wanted to make sure everything's going well. Thank you for coming to the conference. It's good to see you. My name is Jeff Gibby. I'm going to kick us off by doing all of our favorite activity. That's reading a legal disclaimer. I'm also going to welcome our sponsors and all of our guests today. So I want to thank you for coming here. It's good to see you. And I also want to encourage you, if you're watching us on YouTube, make sure to like and subscribe. It helps a great deal. After we get our first guest, which is Alex Spiroglou, started, I'm going to put in a link to register for today's event. We'll be doing prize drawings all day. Make sure you register. If you register, it helps a great deal. We really appreciate it. And there you go. All right, let's get started. If you do have questions as we go, talk in the questions box. You can go to webinar. There's a little question. The chat, for some reason, they disable over at GoToWebinar. I don't know why, but click on questions. You can type in a question. You can send it, and we'll be able to see it. If you're watching on YouTube, hello. Just ask us in the chat, and we'll do our best to make sure all of the questions get answered. We're usually pretty good about it. Sometimes it gets a little overwhelming. So anyway, let's kick off. Today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock and its employees shall have no liability for any investment decisions based on the use of the software, trading strategies, or any information provided in connection with the company. Metastock and its employees do not endorse the purchase of a security, nor are they paid for the promotion of a security. No information construed in the presentations today should be construed as investment advice or the solicitation to buy a security. Made it. All right. As we get started, I want to say thank you, and we will talk a little bit more about our great sponsors as we go through the day-to-day. But I want to say thank you to Stocks and Commodities Magazine. They've been publishing the Stocks and Commodities Magazine since 1982. They've got 17,000 articles in their archives. They've got 1.3 million subscribers. They've also been an ardent and a long-time running supporter of the Metastock events, and we appreciate it. You can find out more about them at traders.com. Want to invite you to join the Traders Forum. You can do that at thetradersforum.com. Traders Forum is a great community. We've got a lot of active traders that chat with each other all day long, every day. The market's open. We do lessons. You can learn about technical analysis, the markets. It's a community of traders designed to help traders. And all of that stuff that I just mentioned is free. You can join for free at thetradersforum.com. So with that being said, we are Metastock, as you can kind of see right here. Here. It's reversed. Metastock's been rated the best software in its price category for like 32 years in a row. It's one of the most it is the most powerful, in my opinion, tools out there to help you scan markets, test trading ideas, figure out what methodologies you're using, and deploy those methodologies in the market. So we are doing kind of a special extended trial. We'll talk more about that, but you can find that on all of the products we talk about today at metastock.com/conf promo. If you have any questions, you're welcome to give us a phone call, 800-882-3040 from the US or Canada, or chat with us at metastock.com/saleschat. So I know that was a lot. Let's go ahead and get started. Alex Spiroglou is our first guest. Alex has taken the concept of the MACD and made it so that you can do an apples-to-apples comparison across many different instruments using his MACD-V. The MACD-V has won a CMT award. It's won a Charles Dow Award, which I believe is actually issued by the CMT. Alex, you can correct me if I'm wrong. It's a very, very prestigious award. Of course, the CMT is the Chartered Market Technicians Association, and being a CMT is actually kind of a process. I don't think we'll get into it today, but we will get into the next demo. Alex, let's go ahead and get you started. I'm going to go ahead and make you the presenter. Give me just a second to do that.
Thank you, Veg, very much for the invitation.
Of
Jeff,
course.
it's really, really great to be here. Let me try to get this presentation started with the technical bits. I'm trying to go to my GoToWebinar. So screens, entire screen. Okay, let's do the entire screen. It should be able to show. Right, share.
First
Can you
try.
see?
Yep.
Perfect. Got
Coming
it.
straight through.
All right. So
Alex,
can you see my PowerPoint?
I can.
That is.
Yes.
Perfect.
And I will get out of the way. I'm here if you need me.
Yeah, sure. So then you see the first slide, momentum.
Yes, sir.
Perfect. Okay. So let's start the presentation because I usually have the problem of having too many slides for my own good. So today's presentation is about the MACD Volatility Normalized Momentum. It is a breakthrough in momentum trading and momentum indicators, and not just because I said so. It's because been awarded twice. First of all, by the CMT Association, the Charles H. Dow Award. It is the most prestigious award given to technical analyst research, and also the National Association of Active Investment Managers, the Founders Award, in both won in 2022 awarded. So there is a bit of industry level. It's not social media likes and forwards. So experts have rated this tool as being a breakthrough technical analysis. So as I mentioned, this is a chart of the S&P 500, and we'll be talking about the bottom bit, which is the MACD, and its close cousin, the MACD histogram or momentum. So as I mentioned, this indicator became public knowledge in 2002 when I wrote a paper. Today's presentation is a small part of this paper, and it won 2 awards. These are the 2 ones, so I think it's probably worth your time to invest your time in following this indicator. So this is the first webinar we'll be doing with Jeff. This is an introductory at a very high level, because as you will later hear through the webinar, I discovered this indicator 2015. So I spent a lot of time. Now it's close to 11 years. So I mean, I still don't believe it. Time has passed so quickly. So I spent 7 years from 2022 up until I disclosed it. So there's a lot more under the hood. And I'll show you how to get that information. So the 4 biggest mistakes that people do when using momentum indicators, which of course, this is what led to the innovation. So let's look at these 4 mistakes that people do, these frustrations. So mistake number 1, the first mistake is what I call indicatoritis, basically using 5 momentum indicators to produce a Christmas tree chart. Basically, you have a price chart, and you've got the RSI, the ADX, histograms, ergodic oscillators, all sorts of technical and momentum indicators, which pretty much sing the same song. It's completely redundant to be using the stochastic and then on the MACD, then the RSI, then the CMO or whatever, the percent B, whatever. So it's a huge mistake. And I'll show you, of course, how to solve it. The second mistake that people do is what I call the all-weather indicator. And the all-weather indicator is basically using the same tool for all markets. So the first mistake is about not distinguishing, about not be able to distinguish which using all indicators, and then the second is not knowing the advantages, disadvantages of indicators, because some are best for trending markets and some momentum indicators are based at range bound markets. The third mistake, the third challenge people have is what I call the 2 pattern problem. Very limited use, very limited techniques. Now switching from tools to techniques. So the basic way that people use momentum indicators is, overbought, oversold, OBOS, and divergences. But I think through the MACD, I've managed to uncover a lot of patterns, and today I'll show you the 7 core patterns that you can use in addition to overbought, oversold, and divergences. So this is a two-lens pattern. So you've got overbought, oversold, usually through RSI and stochastics. Range band indicators. You've got 70-30 overbought, oversold levels, so-called overbought and oversold, and then you've got the MACDs. You've got divergences and things. So again, more patterns to follow this presentation. So the fourth mistake is when people use momentum indicators, is they use it as with what's called a silver bullet mentality. They think it's the be all and all of trading. So you plot a momentum indicator below your chart, and you think that's an ATM printing money, but that's a big mistake because momentum is only a part of price action, and then so if you classify that as technical analysis, but you also have macro. So the real advantage is to learn how to combine technicals and macro across multiple time frames. This will be the fourth part of the presentation. This will show you how to combine technicals and macro, and also through using a roadmap where exactly each one fits. So this is the silver bullet factory mentality. So the consequences of those, of course, is burning money. People, use very poor techniques, multiple indicators, not knowing when to switch these indicators, as I mentioned, or just using momentum indicators and out of context without macro, and they waste their assets. So this is the things we will be talking about. Also, I'll give you a bit of a risk warning. If you don't have the time to read the risk warning, this presentation, I'll give you a synopsis. This presentation is what I call FEPO, for educational purposes only. Actually, this FEPO, I got it from my friend Tom DeMark. I really liked it, so I'm borrowing from him. If you're looking for a get-rich-quick scheme, I'm not your guy. And there is only one guarantee I can give you in trading, that you will have losses. So what will we learn? This is my promise. So first of all, talk about the MACD, how to overcome the limitations of classic momentum indicators, and identify the 7 core momentum patterns of the market. This methodology will be simple and systematic, so it's easy to learn, works across all time frames, works across all markets, and can be combined with existing methodologies. So, and this is how usually my presentations end. So in order to avoid that and have you stay awake, I will offer 3 bonuses. First of all, the award-winning pattern. The MACD, I'll show you I'll send you the link so you can download the MACD and it's free. You can use it on Metastock. And also I'll be running called the Momentum Model webinar. So feel free to send me an email so you can get these bonuses. Provided you send me an email, of course, you stay away up until the end of the presentation. So let's start. Dealing with the first problem, indicatoritis. As I mentioned before, this is the chart, the Christmas tree chart. Truly inexperienced traders use. They plot all momentum indicators and they to get confirmation. But basically, they have the all indicators sing the same song. So the solution to this problem is to simply understand momentum, what it is, and just use one tool to measure it. So momentum, and I'm showing a map of England because that's where I live, although I'm Greek by heritage. So think of trend, for example, before we go into momentum. Trend is basically direction. So if you live in London, going north, that would be bullish. And if you go south, that would be bearish. So that's trend. So is the market bullish or bearish? Momentum, on the other hand, measures the speed for each direction you're going. So it's a speedometer. Now, of course, you can define it more at a closer level at a higher level for distinguish between acceleration and velocity. But basically, it's a speedometer. Think of it like that. A momentum is basically speedometer. It doesn't tell you if you're going north or south. It just tells you the speed that you're going at. And so, if trend is your friend, momentum tells you how close of a friend he or she is. Or as my friend Ralph Cambora says, one of the founders of the CMT Association, always listen to mom. and it's very, very important. So the first thing is we understand, in order to call indicatoritis, is to understand momentum. So the solution to this, so which indicator do we use? Now, if we go, for example, use the Metastock, and you've got literally hundreds of momentum indicators there. So which one do you choose? Because there are probably more indicators than traders. So in order to understand which indicator you use, and secondly, to understand the limitation, the pros and the cons of each, we will be studying them. And we will create a momentum indicator taxonomy table, which basically means we will classify and then see the under which environment each type of indicator works. So basically, there are two types of indicators. I know there are literally hundreds of momentum indicators, literally hundreds. But if you want to cut through the hype, you can classify momentum indicators in two broad categories. And after I reveal you this this way how to classify momentum indicators, next time you plot, you know exactly which category you plot one, you know in which category it belongs to. First of all is a range bound and normalized, sort of like the RSI, the CCI, stochastics, percent R, and so on and so forth. So range bound means they have a finite value that they can travel from, say, 0 to 100. And normalized because they're, say, for example, they're on a percentage basis, so the readings are comparable. And then you've got unbound and non-normalized. Think the MACD, rate of change, and so on and so forth. Unbound because they can take any value, because, and non-normalized because there are there are absolute price indicators. So the value that they produce is not relevant, as we shall see, to history or compared across other indicators. So the value is not normalized. So now that we've got a momentum indicator taxonomy understanding, and here is an example, for example, the RSI and the stochastic indicator. You can see that pretty much they go up and down at the same time. So start, one of the mistakes is start plotting all the indicators. So the problem this is called multicollinearity, which means you're using the same inputs to and you're hoping to get different results, but it's not. You see pretty much the same. The only difference you can have between the RSI and the stochastic and other indicators is by using different lookbacks, but by and large you can see they go up at the same time, go down at the same time, so you're not really getting any different information by using all these indicators at the same time. So the solution is just use one indicator. That's the first step. Understand that using 5 momentum indicators is a big mistake. It only causes confusion. So use one. Now, obviously, the next question will be, which one should we use? And this is the part of the next problem. Which one should we use? And I've used, I must say, I've used indicators from both categories, from both types of indicators, but I've never been 100% happy. And the reason is, and that's where mistake number 2 comes, the challenge number 2, is that there isn't an all-weather indicator. So, for example, some indicators work better for trending markets, and some work in range-bound choppy markets. So when the market is under one environment, one type of momentum indicator will work better, and another when it's range-bound and choppy. So let's try to understand which one does what and try to compare. So this is the evaluation scorecard. So we will be examining range-bound indicators, unbound indicators, and this is the criteria we'll be using to evaluate them. So let's begin. So let's look at range-bound / normalized indicators. The obvious advantage they have is normalized scaling. In this particular example, I've picked the stochastic oscillator. You can replace it with any kind of range-bound indicator, and the properties, the observations, if you will, of this category will be exactly the same. The conclusions will come from the comparison. So normalized scaling, 0 to 100, which means you can have the indicator can be at 70%, and that is normalized because across time you'll have another 70%, another 70% overbought or oversold. So the normalized scaling makes the outputs of the indicator comparable. So the indicator is comparable across time. Yes, it is, because 70% or the is comparable across time. You also comparable across securities. So an RSI or stochastic at 70 can be compared with an RSI 7 of the S&P 500 with, say, the Bund. And because it is comparable across time and securities, you can create a momentum life cycle model, basically, signal filtering, and say, okay, I'm buying when the RSI is below 30 and the trend is up. So this is like my basic definition of a pullback. But this is programmable. This is rules based, and it's extremely important to be rules based as a trader in general. So these are all the benefits of range bound and normalized momentum indicators. So let's continue. What are the problems with range bound and normalized indicators? First of all, values cannot adapt to trend. So let's look at this particular example. This is the E-mini S&P 500. The market is trending heavily upwards from almost 4,000 points up until 5,000. So the actually more than 5,000. So about a 28% return from November to April. But the indicator did not, the stochastic indicator did not adapt. So the market rose 25% with very big good momentum, almost in a straight line. But the value that we got from the stochastic indicator was always getting pegged at 100. That's the maximum you could get. So it was like a speedometer that you can only count up until, like, say 70 miles per hour. So no matter how fast the car went, that's the maximum value that the speedometer could measure. Again, you can see that in the May to July period. So that was a big problem, because yes, you get 100, or 90% or 80%, telling you it's high, but it cannot adapt. So it doesn't give you it gives you a false reading of momentum. So it's not truly a momentum. So, and then as a result of that, because it's normal, it's a range bound, you also have prolonged extreme readings. And that means as the market again rallied heavily from November to April, the indicator got pegged at the high levels, and those interpreting it at a very basic level, they said, oh, this is an overbought market. Actually, it wasn't. It was a very strong market. So it gives you prolonged overbought and oversold reading. So people say, oh, the market is high, and perhaps we should be selling it or getting out, but actually you should be doing the opposite, because the overbought oversold readings were just a function that of the indicator not be able to rise more, to adapt with the trend. So going back to the indicator card, so the indicator influence, the trend influence on the indicator is negative. So we wouldn't pick that. Extreme readings again are prolonged, and divergent signals as a result of that are false, because the market goes up. The indicator cannot adjust, so it's just basically flat line. So someone can misinterpret this as a divergence. Say, okay, look, there is a divergence. The market goes up, the indicator goes down, but it's not that the indicator goes down. It's just that it can adjust. So these are the advantages and disadvantages of range bound indicators. So let's go to the unbound indicators. Next step. Unbound indicators, and now we'll be examining the MACD indicator, well known, created by Gerald Appel. Gerald created this in the 1970s. In 2019, he won the annual award by the CMT Association. It's the most popular technical analysis momentum indicator after the RSI. I mean, I think I read that somewhere in it was a Bloomberg study. In any case, I mean, it's an extremely popular momentum indicator, both that and the RSI. So the formula, I'm sure everyone knows it. It's a short EMA minus a long EMA. Then you put the moving average on that spread, the signal line, and then you've got the histogram, the MACD line minus the signal line. Of course, that wasn't discovered by Jerry Appel, but a gentleman called Asprey. I won't go into the mechanics of the explaining the basics of the MACD indicator. I mean, there are literally hundreds and thousands of videos, basic videos like that on YouTube. So I'll just give it as a fresh reminder. So I'll throw that away. Values adapt to trends. So let's look at the advantages and disadvantages of unbound indicators. And again, non-normalized and unbound indicators, I'll pick the MACD as an example, but you can replace it with any type of indicator in this category. So values adapt to trend. Do they? Yes, they absolutely do. Because in an unbound indicator, it's like it's not limited to a 0 to 100, for example, scaling. As the market falls or as the market rises, the indicator can rise with it as long as it has momentum. So this is an example. This is the crash of the S&P 500 during COVID. And you can see as the market was falling, February, March, April, the MACD was falling. It was falling and falling along with the market. In the simple reason is, as I mentioned, it is an unbound indicator. Now compare that to the stochastic indicator. As soon as the market started falling back late in February, the indicator, the stochastic, gave you a so-called oversold reading, and then stayed oversold. So it was a big problem here because you're getting a false sense of security that the market was oversold. Well, the MACD kept making new momentum lows. Now, if you also closely observe during the March period, there was some kind of a divergence forming in the stochastic indicator, but there wasn't any kind of divergence. It was just a function that the indicator couldn't, fall anymore. But an indicator could adapt to trend. Look at the MACD. Didn't give a divergence, and that's the simple reasons. And you can see that it's not making any prolonged extreme readings. Now you can see through the June to August period where the green lines are, the MACD could adapt to trend. It could rise with a trend. So it has a much better behavior during trending environments. While the stochastic, as you can see right here, was just getting prolonged extreme readings. So does it give, as a result of that, the divergent signals? Yeah, I think the MACD indicator has a much better behavior during divergences because it's unbound. It is in a better position to indicate when the momentum is truly slowing down, as opposed to not being to rise more because of the mathematical way it is constructed. So, for example, here you can see the stochastic indicator was giving a bit of a divergent signal. Actually, it wasn't. But if you looked at the MACD, no, the market was making new momentum highs. So that's the big difference. So going back to the scorecard, the influence of trend, unbound indicators are, yes, it's a big advantage they have. Values adapt to the trend. You have extreme readings. Yes, the indicator adapts to these, and divergent signals are much better. So as far as trend influence is concerned, the indicator is much better unbound indicators. So let's look at the scaling issues. Now, this is the big problem that the MACD has, and all indicators in its family. The problem is that because it's an absolute price indicator, as you recall previously from the formula, it is short-term moving average minus long-term moving average. So it's raw points. What it does is just giving you on a points basis, and this is not very practical. I mean, the absolute price of the MACD, if in this particular example, for example, it was 23 points. It wasn't really helpful because it's just 23 points. So the value it produces, the pattern, for example, the shapes is very useful, but the value itself is not useful. Actually, it's practically useless. So that's why it doesn't have also stability across time. So this is a chart of the S&P 500 again from 1997 up until 2024. And this is how the oscillation of the MACD indicator is. And you can see around 2019, it's starting being more volatile. And but that wasn't a function of they had more momentum. It's just that the market had increased in price. So the absolute price of the indicator, the swings, were higher than the in the past because it was relating to a market that had increased in value. So the biggest value was creating a bigger absolute price of the MACD. So again, this is coming from the paper. And please do send me an email so I can send you the paper and the rest of the, so you can, learn more about this in more depth. So from, I did a study from 1957 to 1971. The maximum MACD value was 1.56, the minimum was minus 3.3. So from 2019 to 21, and the study ends at 21 because that comes from the paper which was done in 2022, but the results are the same. It doesn't really matter. So the maximum MACD value was 86, and the minimum was minus 225. Now, that doesn't mean that the MACD, the market had more momentum from 2019 to 21 as opposed to the 50s and 60s and 70s. It's just that the market had increased in absolute price so much that it made the MACD values naturally bigger. So the absolute price of the indicator was completely useless. So it's not stable across time. As a result of that, as you can probably imagine, it's not stable across securities. For example, the absolute price of the MACD on the S&P 500, in this particular example, it was 23 points. But for cattle, it was 4 points. Now, that doesn't mean that the S&P had 6 times the momentum of cattle, which is the market on the right chart. It just means that it had a higher price. So again, this is another example of this. So it's not stable across securities. So which means the absolute price is not just stable, is not comparable across time, but not even across securities. So basically, the absolute value is meaningless. As a result of that, because it's not comparable across time for the same security, not comparable across securities, you cannot do a life cycle model. Basically, you cannot say, okay, this is my overbought, this is my oversold. I want to be taking trades here in this area. You cannot filter it as you could do with the RSI. So again, you can see you can't pick a value, say, oh, if it's below 100 or below 50 or below 60, it's all over the place. So this is the problem with it's not doable to do this. And that another problem you have with the MACD is that you get a lot of false signals because it's a trend following tool, and that creates a lot of I mean, the good thing about the MACD is that once a move starts, it will absolutely get you in, but it has a lot of false signals, a lot of false starts, because by design trend following strategies do. So because you cannot create a life cycle model, a framework, you cannot filter these. So the signal accuracy is a big problem. And again, the coming workshop, I will let you know how to use the signal line, but for now, I will tell you is do not use it for signals. There are other ways to use it, but it's a very bad idea to use it for signals. So limitation number 5. The fifth limitation is that when the market has a lot of volatility, because the MACD is comprised of moving averages, they tend to lag. So in terms of or sudden shifts in momentum and direction, there is a big time gap, if you will, between when the actual market turning point is and with the MACD signal. So you can see this, how much the market rose in this instance before the crossover of the MACD on the signal line, and that's because it's constructed of a moving average. Again, there are ways around it, but I just want you to know that the signal line timing is not it's not the best tool for timing. So that, again, as mentioned, there are other ways to use it. We'll be having it the coming workshops, but not use it for signals. I think it's a bit of a misnomer. So to recap, so you've got two sorts of indicators. You've got the RSI and the stochastics. So they go from 0 to 100. But when you have a market that going above 100 miles, you can't measure it. And the unbounded indicators, it's just you have like a speedometer that has no readings on it. So both have problems. On one hand, one is limited measurement, and on the other one, you can't measure it. So this is how it looks like. So under range bound environments, range bound indicators work best. In trending environments, unbound indicator works best. So some, under some environments are, they all have their limitations. So around 2014, because I was getting a bit tired switching between the one type and the other, my goal was to create an indicator would be the best of two worlds. And that would be by having unbound and normalized. So this was my idea. So again, going back to the indicator taxonomy table, now you've got, as I mentioned, range bound and normalized, and then you've got unbound and non-normalized. My strategy was to create an best of the two worlds indicator, which would be normalized on one hand and unbound on the other. So how could I do that? So this is my quest for the Holy Grail, if you will. So how could I normalize an unbound indicator? So the first thing to do was normalize it by price, the MACD, put in a percentage basis. Although I thought I had discovered this, someone else had done it before me. The MACD percentage actually referred to as PPO, percent price oscillator, because I tried to look it up in the literature, and someone had already done that. So let's look at the idea before the PPO, the MACD percent. So what you do is you've got the numerator is the classic MACD formula, 12 minus 26, and then you divide it by either the close or the 26 period moving average, pretty much the same thing, and then you multiply it by 100. So what you're doing is taking the absolute spread between these two moving averages and putting it as a function of the say the longer time period or the close, and then multiplied by 100. So basically the MACD now becomes a percentage. So let's look how this behaves. So let's look at limitation number one. This is, again, top chart is the S&P 500, bottom chart is the PPO, MACD percent. And you can see that pretty much it's stable around the mean. Now you've got the occasional large dips, or we have a bear market, but that's positive because that happens because of the indicator being unbound. So as the market falls, the indicator adapts to it. So that's an advantage. But for most of the time, you can see it's between these two values. So let's put some numbers. What are the ranges? Well, what I try to do in the study is trying to find where 95% of the values reside of the indicator and find the extremes. And the extremes could be the so-called overbought and oversold. So through this study, I put the numbers to the test. So 95% of the values, actually 94.3, were between 2 and minus 2. And above 2 were overbought, and below minus 2 was oversold. So 2.2% of the time was overbought, 3.5% of the time was oversold. So yeah, it worked. So limitation one was solved. So this is putting the PPO MACD percent is stable across time. So let's look at the second limitation. Is it comparable across securities? So we take two completely different assets for this comparison. So the chart on the left is the German Bund, fixed income market, bonds, and then natural gas. Again, these charts are from the paper. Do contact me so I can send you the paper, and also to make sure that you get more information, because this is the introductory part of the MACD, the MACD. So let's do the same study where 95% of the values reside for each market. Let's go for the Bund. We can find that 93.6, close enough, as between 0.7 and minus 0.7. Above 0.7, 3.5. So that's your overbought. Below minus 0.7, it's 2.9. So it is stable across time. It works on the Bund as well. Let's look at the for natural gas. it's above 7% is overbought, below -7% is oversold, and almost 95% of the values are between 7 and -7. So again, it works for the natural gases as well. But if you compare these values across these markets, you will end up with this. You'll find that you have different overbought and different oversold levels for each market. So for example, the overbought level for the natural gas is 7%, the S&P 500 is 2%, and for the Bund is 0.7%. So limitation 2, comparing across securities, is not solved, because from this table you can understand that in order to have find the overbought and oversold levels using the MACD percent, you need to find the individual overbought and oversold levels for each security. So if you're checking, for example, the constituent stocks of the S&P 500 stocks, you need to do this exercise 500 times. Not very practical, huh? So PPO is not stable across securities. So normalizing by price is not the solution. Naturally, of course, the other limitations stand. Since you have different overbought and oversold lenses for each security, you cannot create a uniform momentum life cycle framework. So it is an improvement. So if someone is using the MACD, using the PPO is an improvement, but it's not a solution to the other issues. So around 2015, I had my eureka moment. Being Greek, being inspired from the, having a eureka moment. And this is what I did. I started to question why did this indicator, this type of normalization percent work? Because at the end of the day, a percentage is a percentage. It should be comparable. I mean, in everyday life, we compare things on a percentage basis to make them comparable. But it didn't seem to work on markets, at least not in this particular example. And then it dawned on me why this was happening. This what gave the inspiration for the MACD. And the paper, which then I disclosed in 2022, because for the years from 2015 to 2022, I was just using it, and then I decided to make it public and say everyone can benefit from it. So this is the discovery I made. The formula was, instead of normalizing by price, I would normalize by a different factor. And the different factor came from the observation, from the question, why aren't percentages the same? Because these markets have different volatility. So for example, the Bund is a lot less volatile than natural gas. So for example, a 2% swing on the Bund is a very big move. On natural gas, they call it a Thursday. So in order to normalize, I truly normalized by volatility. And the weapon of choice, if you will, for volatility was average true range. So instead of normalizing by the 26 period of price, I did the 26 period of the ATR. So let's try to put the same test to the MACD. As you can see, again, 95% of the values are between 150 and minus 150, 150 and minus 150. So basically, this means that the momentum is 1.5 times its volatility. And you can see it is stable across time, similar to the PPO. So 150 and minus 150. So it is stable across time, and it works. So this is how the MACD versus the MACD would look like. The MACD, you can see, stable across time, and that's the indicator on the third chart. And the MACD is all over the place. So there is a huge benefit using the MACD versus the MACD, because one is not stable across time and the other one simply is. So again, going back to the indicator valuation scorecard. So is it normalized? Yes, it is. It is normalized now. So let's look at the normalization across securities. Let's try this for the Bund. Again, top chart is Bund, the bottom chart is the MACD, and let's put this to the test. And then you can see that above 150 and below, sorry, between 150 and minus 150 is 95% of the values. So you can see that again, it is it's normalized also for the Bund. And not only that, you also have the benefit of having max values that adapt with the trend and momentum. So in this, for the Bund, the max value is 295 because it's a freely unbound indicator. The minimum value is minus 23, again, because it is an unbound indicator. So it's not getting pegged at 100 and minus 100. It can take whatever value the market dictates. So look at natural gas. Again, natural gas, bottom chart is the MACD. Let's look at the numbers where 95% of the values are. Between 150 and minus 150, 95% of the value, actually 95.5%. So this 150 minus 150 range of values contain 95% of the values. And above that is overbought, below that is oversold. You can see again the max value here is 298, completely different than the Bund, than the S&P 500. The minimum value is 362, completely different than the max value of natural gas or the minimum value of it's not symmetric because it's unbound and truly measures momentum. But you can see it's comparable across securities. So now the MACD, normalizing the MACD by volatility, is stable across securities, which means the indicator values across one market are comparable across all markets. And that gives us a huge advantage. It's comparable across time, comparable across securities, and now we can create a life cycle model. So this is a life cycle model. So the black line is the MACD, the dashed line is the signal line, and and I've used 50 and minus 50. Again, I won't go into the details of how I defined 50 and minus 50 because I want to be it's on the paper, and I'll be doing a follow-up webinar to explain better these 7 core patterns. So let's look at these, what these patterns are that you cannot do with the MACD and the RSI. So this is the 7 core patterns. They all begin with the letter R. So let's look at these one by one. 150 again is the extreme value. Then you've got the 50 level, minus 50 and minus 150. So these are 7 possible combinations. This is how the MACD looks like, and also the histogram. You can use it for free in Metastock. So let's look at the ranges. Sorry, before going into the 7 ranges, let's actually see from a math point of view, a quantitative point of view. Are these ranges, the 50 and minus 50, comparable across securities? And you can see 36% of the time, and is between 50 and minus 50. For the Bund is 33%. Percent of the time in USA. Again, even these secondary levels are also ranges are also comparable across securities, and for natural gas it's 26%. So by and large, even with comparing 3 completely different asset classes, completely different trendiness, completely different volatilities, the MACD manages to adjust for this. So the indicator scorecard. So normalized scaling, the MACD is comparable across time, comparable across securities, and it has a momentum life cycle model, which means it is from the advantages it has are comparable to the range bound indicators and much better than unbound indicators like the MACD. So on this comparison, it's much better than the MACD. So the trend influence, of course, it goes to say that because it's still an unbound indicator, it keeps the core advantages of the MACD indicator, so which we shall see a bit later on. So let's look at the histogram. The formula for the histogram, again, this is the histogram. Just the MACD manages the signal line, and this is how it looks like. On the top, so on the middle part of the channel, part of the chart, we've got the S&P 500. The top part is the histogram, and the bottom is the MACD histogram. And again, you can see how stable it is across time, and you can have overbought and oversold levels, something that you cannot do with the histogram itself. Completely useless from from an absolute price point of view. So the histogram has been normalized again for those that like a bit of math. So 40 and minus 40 are the overbought and oversold levels for the histogram. And you can see the times it spends in overbought and oversold level are completely comparable. three different completely asset classes, different trendiness, different momentum, but the indicator managed to adapt. So the all-weather indicator problem is solved by the MACD because it combines the best of two worlds of unbound indicators and also normalized indicators. So there is a very big advantage to have this, your so-called all-weather indicator replaced by the MACD. So let's look at the next problem, the two-pattern problem, because most momentum indicators are being used as overbought and oversold and divergences. Can we create more patterns with it? So this is the mistake I was referring to. So the rules, because in general I want to be a rules-based trader. Follow the rules or follow the fools. So let's look at the MACD ranges. 7 ranges. I will present these very brief, very quickly. 7 core ranges, 7 core patterns, all begin with the letter R. So the first range is the risk range, the overbought or oversold. The MACD below the signal line and MACD below 150, that's the oversold level. So this is how it looks like. So this is your pattern number 1 to find the truly oversold market, not just be getting pegged at low levels because it's normalized scaling. MACD below 150 and below the signal line. How do we find a rebounding market? So when you're coming off of the risk range, so the rules are MACD above the signal line and between minus 150 and up until 50. So if you want to find the market that is rebounding, coming off of a low, you can program this in Metastock. It's already actually programmed in Metastock and you don't have to do anything different. So let's look at the next pattern, pattern number 3, the rallying stage. So how can you find the market that is rallying? Not by eyeballing, by having a rules-based approach, a quantitative way to quantifying basically a rally of the market. So how do you do that? MACD above 50 and above the signal line. So this is how you quantify this, and you can find market that is rallying. The second is the risk level to the upside, and it's the mirror image of the risk level to range to the downside. So these are the 7 core range patterns. MACD above the signal line, above 150. Basically, that's your overbought signal, something that we got before COVID, the risk range. And then we've got retracing. So how do you define a pullback? MACD below the signal line, below 150 and above minus 50. So if you want to define a market that's having a pullback, that's a very easy way to do so. Now, of course, you can refine it. As I mentioned, there are more advanced patterns, but these are extremely useful to start with. And also reversing or round down, as I like later on termed it again, it's basically the opposite of rallying. So a market that's falling, having a bear market, it has a rundown. So MACD below the signal line and below minus 50. So this is, again, it's color coded for ease of use, free to use on the on Metastock. And with this, you can find a market that is trending downwards quite aggressively. And this is the most interesting pattern I have. How do you find the market that is range bound? Because if you remember, one of the limitations was the second limitation is not knowing when a market is ranging or trending, and you can do that with a MACD. So when the MACD is between 50 and minus 50, which basically means that it doesn't have a lot of momentum for 20 consecutive bars, it means that the market is ranging. It doesn't have enough momentum to be going to the rallying stage or to the reversing stage, but as a prolonged oscillation around its mean. And I define prolonged as with 20 consecutive bars. So that's a really interesting pattern. So you can find a market that is ranging by seeing the MACD between 50 and minus 50. So you can see here it is creating a trading range. So this is going back to the scorecard. So where the other indicators fail, this is where the MACD shines. So it's a big advantage. So going from the old school indicators, and I'm not saying in a disrespectful, because I learned from this. If the inventors of these indicators weren't here, I wouldn't be here. So, but the MACD is a step forward. So the two pattern problem, we solved this with the MACD ranges, and let's show you some more ranges, the histogram ranges, the overbought and oversold. Above the histogram, above 40 is the overbought, below -40 is the short-term oversold. Again, extremely useful to get a different feel for overbought and oversold markets by using the histogram. And this is how it looks on the S&P 500. Oversold and overbought levels for the histogram. Again, something that we could not possibly do without normalizing for volatility. This is taken from the paper. It's at your disposal. You just have to, as I mentioned, email me and then stay awake. And this is how it looks like. This is the chart of the FTSE 100, British stock market. So these are the range rules. So the two pattern problem was created by the range rules. We've got 7 patterns. These are the core patterns. There are more. So going from 2 basic patterns, overbought and oversold and divergences, you go a lot more. So you go 7 plus the divergences. So the MACD ranges and the range rules solve your third problem. So let's go to the final one, the silver bullet mentality. And you can create, of course, trend specific ranges, more patterns, that is. So this is a study I did. Again, it's mentioned in the paper when I studied the behavior of the indicator when it's above and below the 200 bar moving average. So what I found was that you have overbought, oversold levels specific for bull markets and specific for bear markets. These are the stats. This is an idea I got from my friend, the late Andrew Cardwell. So what I found is the markets are above the 200-day moving average. Usually the indicator doesn't go below 100. So this is your oversold level for bull markets. And likewise, this is the oversold level for overbought level for bear markets. It's quite symmetrical for the S&P 500. This is another pattern. So let's look at the market completely different. 67% of the time it's in an uptrend. So what you can find is that, again, 98.9% of the observations were above -100 and 99.8% were above below 100 when the market was in a bear market. This is another pattern. So, but it's quite stable for the bull. Again, so these are bull market and bear market rules. So you can have mild, moderate, and extreme overbought and oversold leadings, depending on if you're in a bull market or a bear market. Same thing for natural gas. Again, if you want to go into details of the studies, you can find it in the paper, but it's stable across securities. So these are two bonus patterns for you, if you will. So, but let's look at the LBR 310 oscillator. That's another indicator that we was improved. This is my friend Linda Raschke. So this is the 310 oscillator. Again, this also has, I did the study again mentioned in the paper that has overbought and oversold levels. So this volatility normalization improved a lot of the technical analysis indicators. That it was quite a breakthrough. So let's look at the fourth mistake, which is using momentum indicators out of context, the silver bullet mentality, think that the RSI, the MACD, or the stochastics is the be-all and all of technical analysis. And what I'll try to show you is what is called the smart alpha system, a rules-based way to combine technicals and macro into rules-based strategies. So it's based on 2 core beliefs. First of all, that there are multiple time frames. This is an idea taken from late Ian Notley. So you've got the 3 time frames I use are the monthly, the daily, and the weekly. So you always have to be watching what the time frame above is doing. So these are my ones: daily, weekly, and monthly. And looking at trends out of context is a big mistake. But the thing is, not just to look at them from a technical point of view, but also from a fundamental, because each time frame has its own return drivers. Different factors influence markets on the weekly chart, difference on the monthly, and difference on the technical. So which are the factors? Again, goes back to the multiple factors technique, multiple time frame, multiple factors technique. So what I do is I go to the monthly chart and look at economic statistics, basically the business cycle. Then I go to the weekly chart, which look at macro, like commitment of traders report, sentiment, seasonals, and then I go into the daily to check the technicals. And this is how I combine technicals and fundamentals and multiple time frames. The MTMF approach, multiple time frames, multiple factors. And once I've got that, then I trade, which is using the forest framework. Setup, signal, stop, and size. So I have this as a way to, so like a checklist, if you will, like a roadmap. First of all, I look at the macro, intermarkets, COT, sentiment indicators, a smart seasonal index. Then I go to the markets. What I look at the multiple trend model. Then I look at the MACD model, volatility valuation index, again, another proprietary indicator, and relative ranker. So, and then I look at the, go from macro to markets to a model. This is how, whoops. And this is how I shape this, create a strategy. My forest framework, setup, signals, stops, and size. So setup is basically why the market should go, which directional buy should it be looking for, long or short. It's a combination of technicals and fundamentals. The signal is where I actually physically get in. You can use a lot of signal generating techniques, but this should be on top of a setup. Then I create my stop, and then the have a size for the position size, which again, there are lots of rules. I don't use a fixed like, oh, X% of my portfolio. It depends on the type of strategy and other factors as well. So this is my step-by-step framework for in order to trade the smart alpha system. And this is where the MACD belongs, because although it is an extremely useful indicator, I don't want to be misrepresenting it as the be-all and all of technical analysis. And you should never fall into that trap that any kind of technical analysis indicator is the be-all and all of trading, and you can just learn one indicator and trade with that. This is a way to combine. Again, I'll be having a workshop how to combine technicals and fundamentals. So for free bonuses for those that manage to stay awake, all you have to do is send me an email at alex@alexspiroglou.com. You get the paper, the links to get the indicator for Metastock, and also a series of webinars I'm preparing. So this is where you can find it in Metastock, unless they have changed the place where it is stored. So I would expect probably Jeff to correct me. So you can find it in support, download, updates, and then you can find Metastock update and patch files. So this is where you can find the MACD. Or I've tried to use a tiny URL, so you can go directly to that page, tiny URL/MACD Metastock, and you can find the install file, the PDF, which the PDF manual for the indicator. Again, this is all for free. You don't have to, you don't have to purchase it. You just, you can use it for free. So you can find the MACD indicators. This is the top part. It's got an asterisk, Alex Spiroglou, MACD free version 1. And I'm saying free because there is, we are in the process of signing off an advanced version of the MACD, the MACD Pro, which is a lot more advanced. But for now, I want you to play around with the basic version, the free version, the publicly available one. So you can also find templates. Again, all for them for free. Contact me and I'll give you the details. Of course, Jeff will be able to do that. You can also have some basic commentary. So it's extremely valuable tool. You also have the range rules, the 7 patterns highlighted. You can also scan for these. I mean, it's open code. So you can have create chart checklist, a lot of pattern recognition just for the or explorations. You can find which markets are rallying, which markets are in a risk, which markets are rebounding for a very large number. I mean, Metastock is extremely useful for its scan, among other things. And you can look for your favorite market, your group of favorite markets for your favorite patterns. You can take these patterns, create more advanced ones like I have, but they're an excellent basis for scans for pattern recognition, open code. Again, all you have to do is email me, alex@alexspiroglou.com, and I'll send you the bonuses. And I hope that I've kept you awake, and I would like to thank you for your attention. I don't know if we have enough time to take some questions. I tried to go as fast as I could so I can keep to the schedule, because I know there are other speakers after me, and I would like to respect their time as well.
We have two questions that we can
Go
get
ahead.
to. There's a few, but there's two I think that I can answer live. The rest I'll just chat answers to. One, we had a question: can you use this on any instrument?
Absolutely. Any instrument, any time frame, as long as it's liquid. I mean, it's not like some weird penny stock which you can't use well, technical answer wouldn't work there. So yeah, but you can use it any time frame, any time frame, any market. Because of the volatility normalization, you can use it for stocks. You can use it for futures, FX, any market, any time frame.
I didn't fall asleep, Alex.
I'm glad to hear that.
Let's see. Paula wanted to have the email. I put the email in the chat. I also put
Perfect.
the link to the free MACD in the chat.
Perfect. Thank you.
The other question we had is, when will the advanced version be? We're in the final development stages on that. I anticipate 2-3-ish weeks. I think is probably what
Maximum.
it'll take.
Yeah, we'll get the and I'm to tell you that I'm really excited about the advanced version, because if the basic version was awarded, imagine how much better the advanced version will be. It truly is. It will help you a lot. I mean, and not only that, and one of the thing is I want to break the old model of giving an indicator, is also more importantly explain to you how to use it. So when the MACD model, the more advanced version, is released, there will be accompanied by a community when you can go and ask your question. You will have access to me. I will also be having commentary. So basically follow a 5C framework. The closed count indicator, a course will be for free. Commentary, which means I'll show you how to how I apply it in real time. You can have a community when you can ask people, and then you can have also any kind of questions if you have, and support coaching. Basically, ask whatever questions you went for, or if you need any kind of support.
All right, we got to move on. Alex, thank you. Very good. Very good. Thank you very much. Paula says thank you, Alex. Great session.
Thank you so much, Jeff, for the invitation.
Of course. Let me go ahead and kind of move over here. I'm going to go ahead and share my window here. Okay. Let me get this out of the way here. Okay. Get to a point where we can actually kind of do what we're doing. All right. And I don't think this is actually on the right page real quick. As we move on to the next speaker, we're going to do it really quickly because we are running just a few minutes behind schedule. I do want to say, though, I don't want to forget to say thank you to Stocks and Commodities Magazine for sponsoring the events that we've run for, I guess we're on 14 or 15 years now. It's been a while. They've been supporters of this conferences and the summits. It's a great magazine. I like making sure that I put stuff in my path that makes sure that I continue to get better at what I'm doing as opposed to getting worse. And one of the ways you can do that around trading is to get Stocks and Commodities Magazine, because it's going to give you good lessons, good classes, good articles every month. So big thank you to traders.com for sponsoring the event. The MACD that Alex just talked about is free as part of Metastock. You can download it from the site. If you haven't heard of Metastock, it's been rated the best software in its price category for 32 years in a row this year. It's great at scanning the markets, testing trading ideas. It's got a patented forecaster. We're going to talk a lot about the power of Metastock in just about an hour. But we do have a special extended trial offer where you can try it for 3 months for the cost of one. You can get that or any of the other things we're talking about today or the rest of the week at metastock.com/conf promo. So without further ado, I want to introduce you a friend of mine, Marina Villatoro, and I'm sure I say that right every time. Marina is what I often refer to as one of the world's most interesting ladies. She says that she is one of the first spin instructors in the country. I don't think she's old enough. She does a travel vlog. She's an expat. I believe she's living in Spain right now. And she does a course on how to day trade. All of those things. So There you go. That's your introduction, Marina. That's what I'm sticking with. Before I let you get started, though, can you help me give away a prize?
Yeah, sure.
Okay.
Hi, everybody.
We're going to give away this book. This book was by the great Steve Bigelow. It's called High Profit Candlestick Patterns. Steve was awesome, one of our best partners, and this book is great. And Marina, what I need from you, I just need a number between 1 and like 4,400 or something. Let me look. 1 and 4,359.
Wait, between what?
Actually, it has to be between 2 because there's a header up. 2 and 4,359.
Oh, 4,000. Okay. 3,597.
Okay. And that is Jim M. I know Jim. Jim, you know who you are if you're watching. Jim's a big user of Metastock. You're up in Detroit. You know who you are. Congratulations, Jim. I am going to personally take this to the mailbox next week and send it to you. So with that, thank you for the assist, Marina.
Yeah, and thanks for the incredible intro. I love the intro.
Yeah. I practice.
For sure. Well, it's so good to see you, and I hope you're doing good.
It's good to see you. I just made you the presenter.
Okay.
Did I get everything right in terms of like your most interesting, right?
There you go. The most interesting. Well, I hope so.
All right. I can see your screen.
So. Okay, I think I'm losing I'm not seeing. How do I do this? Can you see me?
I can see you, and I can see the screen, and I can hear you. Okay. So everything looks great on this end, as long as you don't touch anything.
Okay.
All right. I'm going to get out of the way. If you need me, I know we're kind of starting about 10 minutes late. I don't want you to worry about that. I'll make Kelly go shorter. He's next. So
no, it's okay. I'm good. I'll be
take the time you need.
Thanks, everybody. Thanks, Jeff. And hi, everybody. Thank you so much for having me. You know what? I would like to remove me because sometimes I think that becomes a little bit of a distraction. No, it's okay. I'll keep it. Hang on, though. I need to figure out how to be able to see me. There we go. Let's just stick to that. Okay. Well, hi, everybody. I am Marina the Trader Chick, and this is me, and also I am right here as well. And today I really want to talk to you guys about day trading, busting myths about day trading, what there is to day trade, the different lingos, brokers, I mean the whole fun stuff about trading. Hang on just 1 second here. I do want to remove this because I feel like it's taking up more of the screen than I want. Okay, hang on. There we go. But before I get into the charting and all that other stuff about day trading, I always like to begin with an intro because I find that we bring ourselves to the charts. Okay, no matter who you are, where you come from, we all might look at the same chart, but we bring ourselves, the humans that we are, into the chart, right? So that's really something that I recommend for you guys to remember as well, because we bring in our filter. So my filter is, I'm the Trader Chick. I am an expat. I'm now living in Spain. I have been an expat now for over 23 years. Before moving to Spain, my family and I, we lived in Costa Rica, and then after that in Guatemala for almost 20 years. And now we live in Spain. And the reason why I bring this up is for several reasons. One, you could trade anywhere in the world. There is no such thing as how's the internet, isn't it bad? I lived in third world countries and first world countries, and it's great regardless. Also, bringing in a worldlier perspective, not only seeing what's in front of you in the country you're at, really helps understand the worldwide economy. And the best part of all, and I'm going to really touch upon this, is when you day trade, it has really nothing to do with what is the overall market doing in the first place. And the last and most exciting part of all, offering your children a chance to experience different cultures, I don't even think that there's anything that could ever give you a more of a fulfilling thing, even if you guys do it for 1 year. So after each of my live presentations, I always get people who are really interested in becoming expats or moving abroad. So I'm always available. Please just email me, because it is a very different topic than trading, but I'm happy to help anybody, even if it's just for 1 year, to just try it out. It's certainly one of the best, most fulfilling things you could definitely do. And before I was a day trader, like Jeff said, I was a fitness instructor. And yes, I was literally one of the very first spin instructors and Pilates instructors in New York. So I used to do that in New York City. And the reason why I bring this up is because a lot of people have this misconception that you need to come from a financial background, an economic background, a math background. None of that is true. Okay, you can literally come from any walks of life and become a successful day trader. Any, okay? And the coolest thing of all about day trading is that you can literally do it from anywhere in the world. Anywhere in the world. Me and my family, we travel 3 to 4 months out of the year. So as much as I would love to have been a trust fund baby, I am definitely not one of those. Everything I have earned is because I have worked for it. And I have to say, once you learn the strategy how to day trade, you could literally do it for 1.5 hours a day and then enjoy the rest of the day. And you could do it from anywhere in the world. Now, before I jump into my presentation, I am giving the entire presentation completely for free, because I know that we only have a limited amount of time together, and Jeff always puts up the replay so you guys could go over it as well with the replay. So you could go right here, makingofadaytrader.com, makingofadaytrader.com. You could go here and get it immediately for free. So makingofadaytrader.com. All right, guys, let's break these things down, because once you could break down the simplicity behind the financial markets, it's like opening up a reservoir that is blocked to be able to truly move to the next level. And a lot of times is because we have miniature blocks that we didn't even know existed until we're like, oh, this is what was holding me back. So first and foremost, what in the world is day trading, and why is it not investing? And it's interesting because whenever I say to people that I'm a day trader, people always like to respond, oh, I really want to learn how to invest. And I always say, well, we trade to invest, because unlike investing, in day trading, we really do not want to diversify. Okay, this is something that is really, really important, guys. We don't want to diversify. So I'm going to give you a really good example. Hang on just one more second here. Yeah, I think it'll be important for you guys to like see my passion behind behind this explanation. So imagine your child wants to play a musical instrument, okay? And they come up to you and they're like, Mama, Papa, I really want to play a musical instrument. And you say to them, okay, which musical instrument do you want to learn? And they're like, well, I want to play the violin, I want to do the flute, the drums, and the piano. And you look at them and you're like, those are so different. They are such 4 different instruments. What I recommend is focus on one. Focus on the one instrument, and when you can master that one instrument, then think about moving on to the next instrument. In the financial markets world, we actually call everything financial instruments. It's the same thing. So when you are day trading, it's really, really important to focus on one instrument. And we're going to get really deep into the instrument part, like what the instruments are. Hang on a second. So you'll be able to understand what is the best thing that you want to trade. But this is something that if you're going to just take away one really important thing for today, this is it. So please, guys, focus on one, because unlike investing, with day trading, we want to focus on the one, because also investors, we have, at least I do, I have a really robust portfolio because I invest in quite a lot of different companies. And the thing about investing is, when you invest in a company, you could sit through the highs and the lows, right? If I'm invested in Apple, let's say, and they're coming out with a new product, and the market is fluctuating up or down, I'm okay with it because I know overall Apple is going to produce something powerful, right? So you sit through it. However, when you are day trading, I don't care about the product that they're coming out with in 3 months, right? Why do I care? Because I'm in it for the day. So I don't care if the market is going up or if the market is going down, because I could benefit from both ways, right? Interestingly enough, most day traders make more money on the down than on the up. Just saying, because usually the market goes down a lot faster than it goes up, right? So I want to now talk about busting the myths of day trading, because a lot of times when we have these limiting beliefs, we are held behind them and we cannot push through it. Okay. So the first thing that I get all the time, well, it's too risky. Day trading is like gambling. Let me ask you this. If somebody comes up to you and says, I want to be a pilot, and literally the next sentence is, let's go hop in a plane, I'm going to take off, you're going to think they're absolutely not nuts, right? Like they're bonkers. Because why? You have to learn how to fly a plane, right? You have to learn how to land the plane. You have to learn all the gadgets of flying a plane. So if you get into this plane because this one person decided in that moment they want to be a pilot, that's like a kamikaze mission, right? You'd say, hey, that is really risky. So day trading is no different. Just because you have a little bit of money does not mean you're going to become a millionaire by putting in your money. And it always amazes me that people think that they could just put in their hard-earned money from, let's say, if you're a doctor, into the markets, that you're going to win. No, you might win at being a doctor, but going into day trading, that is an entirely different thing. You have to learn a strategy. Once you start to understand that there is a strategy, guess what? The gambling, the risk part of it is gone, okay? Because you have a strategy. The other thing, and actually, to be honest with you, I am shocked that this still exists, but one of my students wrote to me the other day saying that their brokers are insisting that they get a minimum of $25,000. This is so untrue. This $25,000 to get started has been, it's like 1990s, okay? Because today you could literally start with $500 and even probably smaller amounts of money for day trading. The reason why they bring up this $25,000 is because the brokers, and I'm going to go really deep into this, they give you this perk saying that they're going to give you a margin account. I'm going to explain margin accounts in a few minutes, but one thing you'll know right now, that it is a loan sharking. You do not ever want to have a margin account. So this $25,000, it is a lie. It does not exist. You could literally start with $500, maybe even $100. Now, the other thing is, like I mentioned before, you have to be a math whiz or financial background. No, you don't. I don't even look at numbers, honestly, because it's technical analysis. It has nothing to do with numbers. And the only time I actually deal with numbers is for my profits and my losses. And I can use a calculator if I actually need to think about that. You do not need any of that. And that day trading is stressful and chaotic. Well, if you're sitting in front of something like this, yeah, you know what? Anybody will go into total chaos and PTSD mode, quite frankly. I mean, the human brain, the human mind cannot sustain looking at something like this. It is absolutely not possible. Okay, I use one chart. For me, I am on one chart and two indicators. That's all. You can keep it simple, guys. Literally, you can keep it simple. And the other thing is, it's called the shiny object syndrome. And guess what? It is a real thing. Okay. People believe that they need to buy the latest softwares, the latest indicators, the latest algorithms. Not at all. If you have a really strong, powerful charting software like Metastock, you do not need to be chasing all the newest gadgets, because they have so many incredible things already part of the service, okay? And quite frankly, the people that are selling you algorithms, the only people making money from the algorithms are the ones selling you the algorithms, because the algorithms have never, ever worked for anyone. And also there's this weird thing with especially newly like amateur traders or novice traders, that they have to be constantly buying these new softwares and gadgets. You don't. You could truly make it simple and fun. All right. And that's really the coolest thing of it all. And as I mentioned a little bit before, you don't need to know the entire world economy and the financial market information all the time. On the contrary, there's this thing, buying the rumors, selling the news, because the majority of the news is telenovelas. They're melodramas, right? And usually by the pundits that are telling you the stories, they usually have their own agenda. Stay away from the market research, guys. You don't need that. I have some students that come to me who trade equities, right? And I mean, they are so burnt out. They wake up at 4:30 in the morning to do this crazy, ridiculous research. Then they sit all day in front of their charts, glued to their screens, in complete PTSD chaos mode. Then, of course, they're losing because they're emotionally spent and completely burnt out. And then they sit for another hour or two researching why they didn't win. Because you're going about it the wrong way. First of all, you don't need any of this information. And like I said earlier, I don't spend more than 30 to 45 minutes a day in front of my charts anymore, because I know what I'm looking for. I'm also a scalper. I day trade, boom, in and out. It also depends on the amount of positions you put in at the time and what your strategy is all about. This is a huge, huge thing that happens to all beginner traders. I can bet the farm that every single person in here has done this at one point. I'm certainly guilty of it. When I first began trading, I was trigger happy. It's actually an actual term, trigger happy. What does that mean? In a 2-hour session, I would go in like 40 times in and out of trades. Even if I was doing okay, guess what? I would be totally losing on the commissions. All right, guys. So you have to understand what I now recognize. And now that I have been doing this for so many years and I've met so many pro traders, I kind of even like, I use the metaphor, the analogy that we are like big game hunters, right? Not because I condone hunting, but because a big game hunter, when they go out there, they're not going to be just shooting at little prairie dogs and field mice. They're going to wait for the big game to come out, right? It's the same thing with day trading. You want to focus on those big, highly profitable trades, because all you really need is one or two and you can win really big. Because the most radical way to trade is conservatively. Because when you do smaller profits and don't go for those crazy huge targets, which by the way is only written on paper, nobody actually does that. Aggression does not work. But when you do consistent profits, guess what? You're going to be profitable yearly. And in the long term, you want this to be a consistent thing that you are doing all the time. And the other thing, that this is my own term that I've coined, FOMAT, fear of missing a trade. The amount of people that chase trades is unbelievable. Chasing a trade makes you an emotional trader. And as we all know, trading can be very emotional. However, the more you keep your emotions out of it and just focus on the validity of the trades, the better you become as a trader. Think of it like this. If you are going to go surfing, all right, and you're on the shore, you're putting on your wetsuit, and all of a sudden you see this unbelievable wave coming through. Are you going to hop in the water and paddle like a maniac just to miss the wave? No. Why? Because you know that there is going to be another wave coming. Here's the fact, guys. There is always another trade coming. Do not chase trades. And you know it. You'll know it because there's this little switch that puts this urgency into you. And that's when you know you have gone the wrong way. That's when you know you are going into the emotional way. You are in FOMAT mode, fear of missing a trade. You need to cut that out. There are millions. There are an infinite amount of trades that are coming. All right, so let's talk about what to trade. Like I mentioned earlier, what financial instruments are there to trade. So Forex, we all know about Forex, right? Which is the foreign exchange, which usually functions with pairs, right? You have two different currencies and you place them with one another, you pair it. Again, a lot of people in Forex believe that they need to do a bunch of pairs. If you do one or two, that's all you will need. You do not need more than that, okay? It's really important to understand this. No more than two, because it's just too much to keep up with, okay? And it's usually not about the countries, believe it or not. It's usually the people leading the countries, and you never know what kind of relations they're going to have, and boom, all of a sudden, you know, the market starts to fluctuate without any real understanding behind it. All right, equities. To me, this is really interesting. When I ask people, so what do you trade? And they're like, oh, I trade stocks. In the United States alone, there's over 5,000 different stocks that you could trade, or you could go, you know, invest in or whatever. 5,000. So when you tell me stocks, I automatically know that you are not a pro. All right. So the pros, how will they respond? They will say maybe a sector, technology, pharmaceuticals, entertainment, or they'll say, I only focus on the big caps, small caps. And believe it or not, a lot of day traders only focus on the big movers. Amazon, Tesla, Microsoft, Meta. These are big movers, right? Like they are such big movers that their volatility is amazing. If you only focus on one of those, or even two of those, you will have enough to do and to focus on and have fun doing it. All right, futures. That's another one, right? So what do you trade? Oh, I do futures. Okay, so you are focusing on wheat, on soy, on sugar, on the E-minis, on the NASDAQ. You like, they're so different that again, it's recommended focus on one. I'm personally an E-mini futures. That's my thing, which is literally the S&P 500 index on the futures market. Options. Again, if you're going into options, great. Stick with options. Stick with options until you truly understand what is happening and you are doing well at it. And then we have crypto, right? So aside from Bitcoin and ETH, there is the crypto market, which has over 6,000 altcoins and projects to play with. Guys, don't go crazy with crypto. Crypto is still an emerging area. It's still up and down, up and down. But if you are going to go into it, one thing I will tell you right off the bat, do not leverage. No matter what you do, do not leverage. All right. Do not put more money into the pot than you have, meaning that you are borrowing from your exchange, because I don't think I've ever met anybody that actually made money with that. Okay. The only people making money are the ones that are giving you the money for leverage, because you have to pay them back with an interest. And that brings me to brokers and margin accounts. So brokers, exchanges, whatever you want to call it. First of all, this is something that I get quite often. I get a lot of people that come to me and they're like, oh, I just opened up a broker account. I'm like, okay, so what are you going to be trading? They're like, oh, I'm not really sure. So here's the thing. If you want to trade crypto, you need to go with a crypto exchange, right? Just because some crypto exchanges today have some stocks on them does not make them a good stock equity platform. Or the other way, you want to go and trade equities, but you are with a broker that focuses on futures. What happens then? First of all, your feed is probably going to be all weird. You're going to have to pay extra for the feed. Then you're going to also have to pay extra for commissions, because if you're with an equities broker and you want to trade futures, that's a huge separation. So you will definitely be paying a lot less commission if you are with a broker that specializes in futures. And now let's talk about margin accounts, because the majority of brokers will be pushing this margin account on you. What is a margin account? It's literally them lending you money against the money that you already have. And basically, it is a loan sharking deal, right? So what they do is they give you the money, so you spend your money on certain equities, certain positions, and then all of a sudden now the broker is lending you this money that you can make so much more money of. Well, but what if you lose? And chances are you probably will, because you don't know what you're doing a lot of the times. So here you have now all your money plus the margin amount of money. Now the margin, that account that they give you, you have to borrow it. So now you have to pay it back with an interest. Guys, it is not obligatory at all to ever have a margin account. And the second your broker comes to you and says that, say no, you are not interested in a margin account. And again, understanding commissions and the live feed. If you are with a futures broker and you want to trade crypto, you're going to be paying a lot more commission because they're going first to the broker that works with this particular kind of an instrument. Okay, and on top of that, you need the live feed, guys. You need to have live feed. You cannot have delayed feed, and you have to pay for that. Again, if you are with an equities broker and you want to trade futures, there's different feeds. Okay, that means you have to pay for different feeds. Please understand what you're doing so that you minimize those costs, and it's very simple to do that. And platforms, I have to say, when you have a strong platform, you do not need anything else. And in my opinion, Metastock is amazing. Like, they also have this white glove service that helps you completely set up your charts, and they do it all for you. I have absolutely, like, they are a fantastic platform that I really recommend working with. All right, so here's the thing. No matter what you'll do in your life, I don't care if you are a mechanic, a doctor, a pilot, there are lingos for each one, right? Like lingos that if I entered the world of pilots, I probably would not understand until I learned. It's the same thing with day trading and the financial markets, identical. So it absolutely amazes me when people don't even know the basics and they have put their life savings on into the markets and don't even understand what is actually happening as far as lingo, and chances are what's happening in front of them in the first place. So intraday trading, it is literally going in and out of all your positions in the same day. You end the day with all your positions closed. Why does this matter? Two reasons. Number one, the time frame. If you are day trading, are you really going to look at a 1 week chart? No, you're going to be looking at the 1 or 2 minute chart, right? What if you wanted to swing trade? Okay, it's still trading, but swing trading means that you are holding overnight, okay, or even several nights. So you need to understand that, and you really need to know what you are doing. It makes a massive difference because then your time frame works with what you are planning on doing in the first place. All right, bull market, we all know it's a bull market going up, market's going down, bear market is the market going down. A lot of people don't realize the importance of understanding that there are three trends. Okay, you have the upward trend, you have the downward trend, and you have the sideways trend. Three trends, guys, and the sideways trend, that is the one that you need to understand the most because this is where the majority of the money gets lost. All right, let's talk about profit targets and risk management. We all know of risk management, right? We all know about a stop loss. Yet the majority of people are still putting in their mental stop losses, right? I mean, the ego will always win. So you got to fight that ego and keep your stop loss where you are telling the market all you want to risk on that trade. Profit target is just as important because you are telling the market where you want to take the profit, because what happens there is that greed can take over and you hit your profit target, but you moved it because wait, the market is continuing, and guess what? Right when you move it, remove the profit target because you could have been filled and filled your pockets with the money, it turns on you, goes down, and you are in a mental stop loss. Boom. Not only have you lost the profit, but you've also lost all your money because you removed the risk as well. This is where you really need to focus on this. And interestingly enough, a majority of charts, you can actually do an automated system specifically for that. Okay, indicators. I am a huge believer that you do not need a lot of indicators. So I struggled for years when I first began, And I used to take indicators from all these gurus and all of my teachers and all this, that I had over 10 indicators. I was in constant analysis paralysis. And I quit. It was terrible. I went through so many different things in the beginning. But one thing I did when I quit finally, because I ended up losing way too much money, and I decided to come back, and what I said was, I'm going to remove all my indicators. And then I started to put back indicators to see which ones aligned with me. And some of the most popular indicators are Fibonacci's, Kettler bands, Bollinger bands, and they were constantly giving me massive stress. And when I removed them, I felt this load lift off of me because I simply didn't align with it. Guys, you need to align with your indicator. Okay, it is very important. You need to align with your indicators. Okay, again, the trending markets, guys, you need to understand what those are. And let's talk about a buy or going long. Because a lot of times it amazes me that people don't even know the difference between going long and shorting the market. So what is buying or going long? It is literally entering at a low price point, exiting at a higher price point, and taking the money in between. That is the profit. You start low, you get out high, boom, profit. Selling, shorting the market, it is literally the exact opposite. You are entering at a high price point, exiting at a lower price point. Do not overthink this, and you're taking the profit in between. Why? Because the technical analysis tells us to do this. When we understand technical analysis, everything makes sense. All right, now let's talk about entries, because a pro has a limit order. They put in their order where they want the market to enter. They are telling the market, this is where I want to enter. Novices, amateurs, put in market. What does that mean? They're seeing the market and they're like, wait, this looks like really good. And then boom, they enter the market with no real strategy. And the market knows this. So what the market does is it finds you. It finds you slippage. Okay, slippage. That is almost 20% of what you can earn. So guys, you need to show who's boss. And the way you do that is by putting in limit orders. Again, I'm going to go back to the stop limit, because I cannot tell you the amount of people, and I was included in this at one point, who put in mental stops, right? Your ego is like, I'm going to be able to get out when I need to. You won't. You won't, because then the ego will be like, no, it's about to turn. It's about to turn. It never does. And next thing you know, you have just wiped out your account multiple times. All right. So there is a way to stop this. You could put in a small amount of a stop, a small risk, and that's it. So you need to know what works best for you. What are you willing to risk on that trade? Okay. Now, I talk a lot about technical analysis. I'm a very, very big fan of technical analysis. That's actually the only way I trade. And what I love about technical analysis is that it's simple. Once you understand how to use it, you can use it on any financial instrument, on any chart for it, and you don't need a lot of indicators. So, resistance and support. These are probably some of the most important in technical analysis. So what's a resistance area? It's when the market is going up and all of a sudden, boom, it starts to hit a ceiling. 3 or more times it's hitting that ceiling. Okay, the resistance area, boom. Support area, the floor of the market. All right, the floor of the market, guys. When you're hitting the floor over and over and over again, that's the support area. Now, these are my favorite reversal patterns. They are the telltale signs, and they are so easy to spot. And once you start to spot them, you'll be like, oh my God, why haven't I been using them before? They are literally the aha moments for probably the majority of my students. Double tops, triple tops, double bottoms, triple bottoms, and head and shoulders. Once you start to spot them, so are they 100% indicative that it's going to be reversed? No, but it is 100% indicative that the market is slowing down, and you never want to be in a weak market. Divergence. This is actually my favorite. I personally love divergence more than anything else. I find that this is just the most accurate. So I use 2 indicators. I use an EMA line and I use the MACDs. So if you look at the bottom, the red dots, those are MACDs. If you look at top, that is my price action. My price action is going up. Meanwhile, my MACDs are going down, right? So they are divergent. What does this represent? It means, again, the market is slowing down. It is becoming weak. Guys, you do not ever want to put your money into a weak market. All right, you worked too hard for that money. Why put it into a weak market? Wait until you don't have divergence, where it's really clear and confirmed the strength of the market. That's when you truly make the money. All right, we're going to put all of this together. So again, please go to makingofadaytrader.com and you could get the entire presentation completely for free right here. All right, now I want to put it all together. Breakouts are probably the most powerful trades that you will have, okay? But if you don't know how to spot one, you're going to miss out on this particular trade. So how do we spot a breakout? First of all, it's through resistance and support areas, right? The market is going in one direction, and then all of a sudden, boom, it goes flat. That is exactly where we do not want to touch anything, because we don't know if the market is going to completely change direction or if it's going to break out and continue in the same direction. That's the breakout. All right. So here's a perfect example. We have a very strong resistance area. Now look at my MACDs. They're the ones with the red dots and the black dashed dots, the black dashed lines. The black dashed line, that is the zero line. Okay, that is where the market has absolutely no strength at all. It's the zero line. This is where the market is dead. However, boom, we had a massive breakout. Look at the MACDs. Look at the price action. This is what's telling me the confirmation that I needed. Okay, this is how you recognize where is the strength. And you do that with technical analysis. And I guarantee you, technical analysis, once you understand them, you will be using, you'll just truly enjoy looking and reading the charts. Okay, so here's the thing, guys. We have absolutely everything we need to take action, right? We have these amazing webinars, presentations. We have gurus on YouTube. We have podcasts. We have books. I mean, nonstop, right? But how do you know that you are doing it right? How do you know that you are doing it right? For example, all of this is great, but the real question that I keep on getting people asking me is, how do I get started? Right? And this isn't a question that I usually get from beginners. It's actually usually from people that have been trying for ages and are still losing money. They ask me, what can I do to turn this around to be profitable consistently? Okay, the reality is it's usually the basics. I know that this sounds basic, but interestingly enough, I always say you cannot be putting in your windows if you don't have a wall holding them up, right? The windows are going to be crashing. And a lot of times these academies and mentors and conferences, they go right into like the hardcore stuff, and you end up missing the basics. For example, my oldest son right now is trying to get his driver's license. Okay, in Spain, it's really complicated. And we are teaching him how to drive, right? So he's been a passenger. However, when he sat down into the driver's seat, my husband's like, all right, you got to put the clutch, put your foot on the clutch and the brake, make sure the gear is in neutral, and then you're going to put it in first, remove the brake. And my son is like, what do you mean clutch, gear? Just because you are a passenger does not mean that you know how to drive. And all of us who have learned how to drive, we started with the basics, right? Today, we don't even think of it. We just hop in. Okay, now I want to take you guys to even more of something. Just imagine, this is a pretend exercise. Imagine somebody who gets into your car who has never been in a car before, ever. And you say to them, all right, you need to buckle up. It's going to save your life. And they're like, buckle up? What am I buckling up? Right? They have no idea what that means because nobody's ever shown them the seatbelt. But once you show them the seatbelt, guess what? They could save their lives. Okay? So if you are never shown a basic, how are you able to do it? Right? And this was my own personal sad truth. I spent over $20,000 on different trainings and chat rooms and alerts. And every time I was in a chat room, I was constantly struggling, and I was watching the admins, take these trades, and I was like asking questions, and they were basic questions. Please explain to me, what do you mean by divergence? What do you mean by resistance? And I was either ignored entirely or treated like I was born with this information. And none of us are born with any information, right? We need to learn it from somewhere. And at one point, I was struggling for 2 years. I was just constantly losing. It was awful, until finally I ended up losing almost $4,000. And actually, I did it by chasing a trade because a moderator said, this is a great trade. I did not understand why, but at this point, if they're saying it's a good trade, I started to chase it. Of course, the second I got into it, it turned on me. I mean, it was awful. I lost $4,000 almost in 5 minutes, but it wasn't even the money. I just lost all hope in myself. I felt completely defeated. I felt like a total loser, and I just ended up quitting. I quit because I was just too traumatized, and it was just awful. I just felt like that I just could never get it right. Okay. But here's the thing, guys. All of us in the room here are most likely bit by the trading bug, right? And it never stops itching. And the reason why, do you know why? It's because we all know deep down that we can do this, right? Like, even though I quit for several months, I never truly stopped watching the others, like other traders. And I was saying to myself, I'm like, if they could do this, so can I. So can I. So after about 4 months, I decided to come back, and I decided to go back to the basics. At that point, I had 3 charts. I had over 10 indicators. I literally donated 2 high definition monitors to my garbage men, and I removed all my indicators and slowly started to put in what felt right for me and learning the basics until I truly, truly mastered and understood the basics. And about a few years back, one of my students goes to me, he's like, Marina, your entire teaching philosophy is very similar to Coach John Wooden. So I never heard of Coach John Wooden before. And of course I looked him up. And if any of you guys know who he was a legendary coach. And his entire coaching philosophy was, when in doubt, get back to the basics. And this guy brought his team to 10 national and NCAAs, 88 national championships. He trained the A stars. Okay. Yet every season when they began, he made them put their ego aside and get back to the basics. How to tie up your shoe, how to roll up your sock, how to dribble the ball. Because if your shoe is untied, you could get a blister, or even worse, a sprained ankle, and then you're sitting out the entire time, the entire season, regardless of the amount of NCAA championships you had won. You got to get back to the basics. So today I have a very special offer for participants only, and this is only for participants. I don't offer this to anybody else. My introductory course, Bootcamp for Day Trading. So you could do it on any apparatus, on tablets, phones, desktops, laptops, all of this one-time price for $97. All right, guys, I want you to go here with me right now. Just give me 5 more minutes, and then you guys could take a break. 5 minutes. Go to bootcampfordaytrading.com. Bootcampfordaytrading.com. Go there, and you're going to follow along with me. Bootcampfordaytrading.com. So what can you guys get for $97 today that brings you the same return on investment? Do you guys like to play golf? Because me and my husband, we do. And when we lived in Guatemala, when we first moved to Guatemala, it was like, I don't know, it was like $27 per person. Before moving 3 years ago, it was $147 per person. And this is in Guatemala, a third world country. How about going out to eat? Yeah. So me and my husband could go out and get a paella here for 2 people and wine, and that's already more than $97. So the reality of that is pretty strong, right? So let me break down what you guys are going to get for $97, one-time fee. First of all, you're going to get a simplified day trading package, and I know how difficult it can be to set up your charts. So I actually have a tutorial that will help you get past the understanding how to do it and get right into the fun stuff, which is the trading, right? And then we go down deep into the anatomy of understanding the market, the trends, the movements, the reversal areas, the divergences. Once you guys understand reversal patterns and divergences, I guarantee you'll be like released and just truly see so many more opportunities. Also understanding support and resistance areas. And I'm going to say it again, divergences, because once you understand divergence, you're going to be able to sit out when the markets are really weak and low, slow, and enter when the markets are strong and confirmed. And that happens through understanding the divergences. And you'll also be able to start to spot the breakout trades. Okay, understanding and mastering the breakout trade is amazing. And interestingly enough, there is such a thing called fake out breakouts, the phobos, and I will also teach you how to avoid them because they are avoidable, but sometimes people don't realize that and hop in thinking it's a breakout and it's just a fake out breakout, and they happen often. And you'll have unlimited access to the curriculum, which is priceless. All of this is valued at $1,600. Okay, you guys get all of this frameworks for $97. So here's what some of my students have to say. And like I said before, you could trade from anywhere in the world. I have traders everywhere, everywhere. So Michelle, I just finished the boot camp. Best money I ever spent. Derek, you are the only mentor that truly checks the work. Adrian, I'm enjoying the boot camp and I'm learning every day. Now I want to go back to something that I asked you a little while ago. It's something that is really important. How do you know you're doing it right? How do you know that you are actually doing it right? Who is there to help you with your charts, understanding the accountability part, right? Just because you're watching all these gurus and all of these videos, but how do you know if that you are actually understanding it? So in this $97, I am putting in one entire month of a mentorship, one-on-one feedback, coaching with me, unlimited. You guys could send me your charts. You could ask me all your questions. Anything, I am here completely to support you. Okay, because with a mentor, that is literally what's going to help you get to that next stage. And I am going to be here to help you the whole way. Okay, and on top of that, I have a live chat room where you guys could see what is happening in the live market and everything that we are learning to be able to apply it. This is separate. You guys get the membership on top of the mentorship. All of this is valued at $2,600. For you guys, I have one-time price $97. So I want you guys to go to here right now, bootcampfordaytrading.com. Go to bootcampfordaytrading.com. Here's what you guys will get for the $97. Everything in the course, 30 days one-on-one mentorship with me, unlimited feedback. We could do Zoom chats, you name it, and in the chat room. And all of this is worth less than one trade. I don't know about you guys, but my trades usually are between $200 to $400. This is less than one trade. It like the cost of this investment will 10x your return of the cost of this course is 10x, will give you 10x the investment. Okay, and this way you can go to 100 of these meals and take out your friends, pay for all these dinners. But the thing is, guys, because of my mentorship, I only have a limited amount of spots that I could help with. Okay, I can only take on a certain amount of students because I really want to devote my time and give you my full attention. So I'm just saying, I would definitely hop on it. $97, you guys get unlimited one-on-one with me. So even in that one month with me, just sending me all your questions alone is priceless. Okay, so let's go here. So bootcampfordaytrading.com, and this is the order form. All right, as you can see here, one-time payment $97. If you want to do it in two payments, you could do $59 two times, but you get access to absolutely everything automatically. Okay, and access to me immediately. So this is the order form. So go here, bootcampfordaytrading.com, bootcampfordaytrading.com. All right, guys, let's go here together. Let me know if you have any questions or anything. And again, thank you so much for your valuable time, right? Time is the most important thing, the commodity that we can never renew. And I really deeply appreciate you guys spending this time with me. And thanks, Jeff, so much. I always love these presentations. For me, Metastock is just one of my most joyful ones. And thank you so much, everybody.
We try to bring the joy.
You do. You always bring the joy.
Very cool. Thanks a lot, Marina. I appreciate you coming in and spending some time with us.
Bye, everybody.
Bootcampfordaytrading.com. I've got it in the chat. I've got it in the other chat. Take a look at it. Thanks, Marina.
Bye, everybody.
Let me go ahead and do this real quick. Oh, I need to move things around. Okay, here we go. All right. Should be able to see me, see the screen. Thanks for coming. I do want to, as we kind of transition into the next speaker, I want to invite you to join the Traders Forum. The Traders Forum, you can come in here, you can chat with other traders, you can learn about the markets. It's a community of traders designed to help other traders. You can find out about it more at thetradersforum.com. All of the offers, we're going to start to talk a little bit about Metastock today. All the offers that we're going to talk about today, you can get at metastock.com/conf promo or metastock.com/saleschat. If you have questions, if you want to connect with us, if you want to get more information about why Metastock has been rated the best software in its price category for 32 years in a row, 800-882-3040 or metastock.com/saleschat. So our next presenter is actually right here, but I'm not going to bring him over here yet. I'm going to have him help me with a prize drawing first. Kelly, are you ready?
I'm ready.
I kind of wish I could just grab the.
Here, I'll just come.
Yeah. Just kneel right here, and the camera will resend it.
Hey, everybody.
All right. So we're going to give away this book. It's Candlestick Profits: Eliminating Emotions, and it's by Steve Bigelow, a great friend of Metastock, huge mentor, etc., etc., etc. It will focus on you.
It's looking at you. So.
All right, Kelly. So I'm going to get out of your way by literally leaving the room. Before I do that, I just need a number between 2 and 4,359.
Let's go 1,685.
All right, say it again.
1,685.
All right. But so I can hear it this time. All right, and so that is a Adrian Maya. Oh, an Adrian M. All right. Our next presenter, just to kind of give him a bit of an introduction, is the president of Metastock. Kelly's been working here with me for a number of years now, like decades probably.
Yeah.
He does a great job. He spends a lot of time kind of doing, well, whatever he's asked to do, basically. I think that's all of our jobs here. So without further ado, I'm going to exit stage left. I will see you guys later in just about an hour. Thanks.
Did you have my presentation up?
Yes, I do have your presentation up. It's right here. It's right here. And then Metastock's also running. Okay. Although you might need to reconnect. I haven't, anyway, if you need to, go online.
Okay, sounds good. All right. Well, hello, everyone, and thank you for being here. Thank you, Jeff, for the kind introduction and giving up your spot. It's one of those mornings where it's having a bit of a computer issue. So let's go ahead and kick off here. So again, my name is Kelly Clement. As Jeff said, I'm the president of Metastock. And my role here is to really kind of talk about what I like to talk about in the market. And one of those big things I like to talk about is backtesting. So I'm going to be talking about that, what it is, how it works, what it does. And we'll dive into that here in just a little bit. But first, what I want to do is kind of set the stage a little bit. And when I get into my presentations, one of the things that I like to do is I like to, show my disclaimer and talk about it for just a second, because that's what I have to do. So I'm just going to read the disclaimer again. I know you've already been through it, but I always have to do this. This is part of the gig. So this demonstration is designed to instruct you in using Metastock and accompanying software plugins, and it's not a recommendation to buy or sell, but rather guidelines to interpreting and using the specific indicators and features included within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock and its employees shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company. Metastock and its employees do not endorse the purchase of any security, nor is it paid for the promotion of any security. No information contained in this presentation should be construed as investment advice or a solicitation to buy any security. So we are going to be looking at stocks, commodities, currencies, whatever today. But I am not here to tell you what to buy or sell. I'm just here to kind of show you how Metastock works and ways that you could use it to make informed decisions. So before I kind of get into my presentation, one of the things I'd like to do is talk a little bit about the emotions of trading. And the emotions of trading are what get a lot of us. This is what gets us in trouble. If I look at this slide here, one of the things that you're going to see is 3 sets of emotions. One, look at that elation. How often have we felt that elation when something's going our way? When the trade's just killing it, when it's just skyrocketing or it's going down and we're in a short, we just get that, yeah, I'm killing it feeling. We've all been right there. Hopefully you've been there at least once, right? But we've all had this emotion. And then, you know, it kind of starts to turn. We stay in it. It's going to keep going. It's going to keep going. And then it plummets. It goes against us. We don't have stops in. We're not following rules. It just completely drops. And then we just get this anger. We get that feeling of, why didn't I follow my rules? Why didn't I do what I always say I will do? And we've all felt this range of emotion. This is part of trading. If you haven't felt this or you haven't been through this when you first started trading, or if you're just starting trading and you kind of feel these emotions, this is what we're trying to avoid. This is what we're trying to get out of. So to kick us off from there, I have 2 quick questions for you guys, and I'd love some answers. I'd love to hear what your thoughts are. Poll number 1. What is harder to do? Overcome the emotions of trading or follow your checklist? So are you, if you don't really have a checklist, do you get stuck in those emotions and that's really hard for you? Or do you have a checklist of things that you want to do, but kind of get stuck by not doing those? Let me know there. So on this one, just in the chat box, all you have to do is put a 1 or a 2 for the answer. 1, overcoming the emotions of trading, or 2, following your checklist. So let me know on that one. So that's poll number 1. Okay, then poll number 2, I'm just going to go over there. Okay, then poll number 2, which statement describes you best? And this one you're going to answer either A or B. And there's no right or wrong answer here. Let me say that. This is just for you to kind of give me a feel of where you are in your trading. So poll number 2, I'd rather miss a trade than lose money. Or B, I'd rather take a loss than miss a big move. Okay, so are you willing to just not take a trade, or are you willing to maybe lose a little bit in order to get that big gain? So just give me your answers in the chat or in the questions box. I know they kind of move things around in there, so that would be helpful for me if you could do that in there. And again, no wrong, right answer. I'll come back and kind of look at those here in just a second as we go through it. Okay, I was scrolling the wrong way in the chat. I was like, nobody's responding, but people are. So thank you, Paula. Thank you, Paula, on those. It's helpful to know. Okay, thank you. All right, yeah, great. Okay, very helpful. This is great. Thank you so much. I appreciate that. And there's a lot of mixes in there. People have different issues with their trading. So let's talk about this for just a second. When we get into trading and we're talking about how we trade, what we do, one of the big things that we do talk about, as I've just done, is those emotional trades and the emotions of things getting in our way. And what I like to talk about here in the cockpit of a plane is when you walk onto a plane and you turn and you look into the cockpit, you'll see the pilots often here with a clipboard or something that they're going through and kind of deep in thought and study. And what they're doing is they're going through their checklist. They're going through what has to happen on that plane before you take off, before anything happens. Now, if a pilot goes through in here and doesn't do their checklist, well, that's when you can get in trouble on things. Okay, I'm as the president of the company, I travel a lot. I'm around talking to partners and dealers and our business partners all over the world, and I want my pilots going through this. But one of the things I also like to do is watch a TV show called Airplane Disasters. And I don't know if you've ever seen Airplane Disasters. I enjoy the show. It's a great show. And what this show does is it takes when there's a disaster with an airplane, and these investigators come in and they go back and they investigate exactly what happened to that flight to make it crash. Okay, now a lot of times there may be something mechanical or weather or something like that that's affected it. But if it's not that, what happens is they go back and they find that the pilots weren't following procedure or didn't do their checklist. And when they don't do their checklist, things go wrong. And that's what happens to us in our trading as well. If we're not following our checklist, we're not doing what we say we're going to do to get in a trade and out of a trade, well, that's when disaster happens. Okay, and that's what we want to avoid. So let's go ahead and jump into what we're going to be talking about today. So what I'm going to be talking about today is trade identification. So you can see there's kind of four main things here that we're going to focus on. One is symbol selection, how to find the best symbols to trade. Entry and exit timing, when you should get in and out of a trade. System testing, how to test your system before you spend your first trading dollar. And then finally, how to add that clarity to your trading decisions, how to make sure we're actually getting the right trade, right? Getting into it. So that's what we want to talk about. So what are we going to talk about that in? Well, we're going to be talking about that in Metastock. So you've seen a little bit of Metastock this morning in some of the other presentations. And just to talk about Metastock really briefly before I get into the presentation, because we're going to be talking about some of these things, is one, we're going to be talking about, oh, thank you, Paula. I appreciate that relation to the analogy. That's great. So we're going to be talking about scanning the markets, finding opportunities, testing your trading strategies, forecasting. That'll actually be in another presentation by Scott Brown later in the week. I recommend you watch that one. And then how to get signals and commentary on your charts to understand what's really happening on that trade and on that chart. Okay, so that's a little bit about Metastock. You're going to see that all here in just a moment. But what I want to do here in my presentation is start us out by talking about indicators. Okay, so why talk about indicators first? Well, the reason for that is if I were to go in and look at different sets of indicators, they do very different things. And if we talk about indicators, they kind of fall into four main categories. So if you're trading and you're looking at the market, you'll get different types of scenarios that happen with these indicators. And I do see a few hands popping up and wanting to ask questions. If you have questions, just put it into the questions box, and I'm happy to stop and talk about your question and what it is that you want to talk about. So, you know, that's free game here. You're welcome to ask any questions during this presentation and jump in. Just type them in the chat box, and I'll be able to jump in. Okay. So as we're going through here and we talk about these four main categories, well, let's break those down a little bit. Okay. So if we talk about trending indicators, okay, we talk about things like analyze the direction and strength of the price, movements over time to identify market trends. So we're talking about things that are trending, right? So they may be going in a certain direction, either up or down. If we're talking about momentum indicators, well, that measures the speed or velocity of the price relationship to the price and gets us into an overbought or oversold situation. So trend, I mean, obviously we're going in a direction. Momentum is that how fast it's moving, where it's going. Then we have volatility, tracks the degree of variation in the price. And then finally, volume, how much that asset is traded. So when I'm trading, I'm trying to pick from this grouping of indicators to know what it is that I want to trade. Okay, so if I were to pull up a chart, so just really quick here, let's go to Metastock and pull up a chart. So let's just say I had the SPY up here. Okay, so we've got a bunch of indicators, things going on here. So if I look at this, what do I have here? Okay, I've got trend, I've also got momentum. I've also got velocity. So there's a lot of things going on, obviously, with the SPY here, but we're starting to have a pullback a little bit here. Okay, so if we look at this, there's different periods of this stock that do different things. We have, we have relational bounce ups, we have trend, momentum, volatility, all kinds of different things happening here. So how do you know what type of indicator to use when you're trading this? So if I go back to my PowerPoint here for just a second. So if I break this down, let's break it down here for just a second. So if I'm talking about these types of indicators, if I'm looking at trend, I'm talking about indicators like moving average or the MACD. Okay, those are great trending indicators, and a lot of people use those in their trading, right? I mean, that's a very popular thing as trend. Momentum is stochastic and RSI, just as a few examples. Obviously, there's more indicators that fall into these, but these are some of the base examples. Volatility would be things like Bollinger Bands or average true range. And then volume, examples would be, well, volume, okay, volume's volume, unbalanced volume or Chaikin money flow, okay? So if I'm doing this and I'm looking at this, how do you know which indicator to choose? What's right out of these groups for what I'm looking at? How do you identify the right indicator for the current market condition? And that's what we're going to talk about today, is how do we identify this and figure out what the right indicator is for the market condition. Okay, so there's a couple of ways to do this. One, if I'm just looking at a chart, I might not know, what's kind of happening there. If there's a current, how do I go through and find a current opportunity based off an indicator I like, or how do I find the best system to work on this particular stock if it's what I want to trade? Okay, so there's a couple different ideas and workflows here that we're going to kind of talk about. So if I look at my PowerPoint here just again, so workflow. One, we're going to select an indicator. We're going to scan the market and look for an opportunity. And then what we're going to do is see if that opportunity is a good one, okay? So that's what we're going to kind of do to start. After that, we're going to say, well, how do I find the best indicator to work on what it is that I'm trading? Okay, so those are our two workflows that we're going to focus on. So to start, what I want to do is I just want to close this chart. Now, when you're in Metastock, there's a lot that you can do in Metastock. Metastock is an amazing toolbox full of a lot of different tools, and you can do just about anything that you want to. But everything that is in Metastock, just to kind of give you a quick tour here, is over here in this left hand, what's called the power toolbar here. So if I go and I look at chart, that's where I can chart. If I want to get quotes, I can go to Quote Center. If I want to scan the market, I can go to Explore. If I want to backtest, right here, forecast, and then review options. Okay, so everything kind of boils down into this left-hand toolbar here. And what we want to do is we want to scan the market for an opportunity. So if I think about what people usually use to trade, trading trend is one of the big things that people do. So we'll start there. So we're going to look for a MACD opportunity. Now let's just look at the MACD on a chart just to look at it and kind of talk about it a little bit before we scan the market for it. It's just so everybody knows what we're looking for here. So I'm just going to open up a clean chart. Well, let's put on a clean chart here. So I'll just come over here and we'll do a clean template. Okay, so I'm looking at just a clean chart here. Now if I come up here and put on the MACD, I'll just search here and drag and drop it. It'll put it into my chart. And what we can see is with the MACD, what I'm looking for is I'm looking for a crossing of these lines to identify trade opportunities. So right here would be a buy opportunity on the SPY. Okay, so if we had bought here and just kind of held here, followed the indicator, it would have been a pretty solid trade, right? If I come up here and I look, what are we getting? We're getting a crossing of that signal line right now. So here's my buy, here's my sell. So that's kind of the way that that works. So what we're doing with our scan is we're looking for these buys and sells to be happening on the current bar so we can identify opportunities. Now, if you're not familiar with indicators, one of the great things about Metastock is I could come in here and I can just type in MACD on this, what we call expert advisor, click attach. And what it'll do is it'll actually show those buy and sell signals that we just identified right on the chart for me. So there's my buy signal, there's my sell. So it'll identify them all on my chart for me. So if you're trying to figure out where those are happening with those scrunched up times, you can see them right on the chart. To take it further, I can also get in and talk about commentary. So commentary will actually tell us exactly what's happening on the chart right now. So if I look at this, it's currently in a bearish state since it's trading below the signal line. It crossed zero periods ago, meaning it happened right today. Now the day's not closed yet, so it's not a fully confirmed bar, but this identifies that that's happening right now. So it kind of walks us through. It tells us if it's overbought or oversold, or if there's a divergence. Okay, so there's different ways you can trade the MACD, not just buy and sell signals. You can do overbought, oversold, and divergence. And this will help you know what's going on. So what we're going to do is we're going to look for a current opportunity here. So if I go back to my Explorer, I'm going to search for the MACD. Okay, we're going to do the expert system here. And what I want to do is I'm going to do the S&P 100. So we'll just see what's going on today. I'll go to index constituents here. Oh, it's not in my list here. So we're not going to do that. Maybe Jeff has it up here. Okay, we'll do the NASDAQ 100 here. Okay, so I'm going to go ahead and select the NASDAQ 100, do the MACD expert system, and then I'll start my exploration. Okay, so this is basically a scan of some local data I had on the computer. And what it did, it identified opportunities for me here. So I have 22 results of things that are matched the MACD opportunity. So if I rank these, I can see that these are ones that had buy signals. So of the list that I scanned, 6 had buy opportunities, 2 have sell opportunities. Let's see, and then we have, well, let's highlight these. We have 11 that are overbought, and then 3 that are oversold. Okay, so we've got a range of things here. So we've got 22 opportunities of different things happening on different charts. So if I was to just click applied materials here, and if I was to look at the MACD on this one, I could go through and I could analyze it kind of like we were doing with the SPY and look at each and every buy and sell signal and try and figure out if that one is a good trade. But why do that? Why spend time trying to figure out how everything is performed when we can automate that? And that's the big thing we want to focus on here. Okay, so you can see how quickly I can identify an opportunity. But what I want to do now is talk about how do I know which one of those is the best opportunity to take? So I've got 22 opportunities. I want to narrow that down to 1 or 2 to know which ones are really the best one to take. And that's what we're going to focus on here. Okay, so we've just done market scanning, so we don't need to talk about that. But we want to talk about backtesting a little bit. Now, if you've done backtesting before, it's simply trying to look at how all the signals on your chart have performed over time. So you can look at them and say, well, this one performed well, and this one performed well, and this one performed well, this one didn't, this one did, and measure all those and try to determine how it's worked historically. Okay, so that's all we're trying to do. So if I talk about backtesting, all I'm trying to do is say backtesting is a method of evaluating a strategy or model's performance by applying it to historical data. So again, that's all we're doing. We're looking at historical data to see how it performed in the past. So this is commonly used in finance to assess the viability of trading strategies. Now, if you talk to institutional traders, which we do all the time, there's a version of Metastock that's available to institutional traders that they use for backtesting. And one of the big things they love about Metastock is they can build their strategies, put them into the Metastock system tester, and see how well their systems have performed before they actually trade them. Okay, so it's a very powerful analysis tool. Now, why would we use it? Why would we use system testing when we're going through and looking at it? Well, let's talk about these 5 points here because they're all great points in the way that it looks. There's one or two things that really stand out to me when I talk about this. One is validate the strategy's effectiveness. Quickly determine if your idea might work before committing real capital. Okay? I mean, isn't that something that we all kind of want to know? Is, well, okay, I'm about to take this trade, and on this stock, how well has that performed in the past? And that's what we're doing here. We're validating my strategy. 2, avoid costly mistakes. Okay? Does your system hold up across different periods? Okay, so there's sometimes when a stock is trending, there's sometimes when a stock is in a momentum phase, there's sometimes when volume's better to be using. So does it stand up in the current trading market? And that's a big thing. So you can backtest something 6 months ago. Well, today it's a completely different story. Is it still holding up? Is it still using the same kind of effectiveness? Point number 3 here, okay, improving confidence. This is the one that stands out to me. If I'm taking a trade, I want to be confident in that trade. Okay, if we can gain confidence from a proven history, well, that's huge. Now, one thing that I want to highlight on backtesting is it's just that. It's backtesting. It's using historical data to help us identify if something has worked well in the past. Now, is that a guarantee of future performance? Not at all. There's no guarantees in the market. If there were guarantees, man, we'd all be playing a different game, right? But what we want to do is we want to improve our confidence in our trade. And if we could do that, man, we'll be such better traders because we're going in confident in what it's doing. Okay. Optimize performance. So you can go in and backtest and you can optimize and change things and update things to kind of help it fit the best thing around your stock. We're not going to really get into optimizing today, but that's something you can do with backtesting. And we have other videos that are on that. But I want to focus on the main core of backtesting today. And then finally, again, another huge one, understanding risk. If I can understand the risk of what I'm walking into, I can be an informed trader because maybe I don't want to put in as much into a trade because I'm not as confident in it, or I'm more confident. Yeah, Paula, great comment there. Including volatility environment, which can upend momentum instantly. Absolutely, right? Things can change on us. Now, even if I were to look at a stock on a daily basis, does it trade the same as it does on a 5-minute basis? Absolutely not. They're different. So one of the big things I kind of like to talk about is personality. If I look at a stock, and if I were to compare Applied Materials here to NVIDIA, well, they're two different stocks, right? They all have their own personality. So really what we're doing when we do these back tests is we're doing a personality test. We're trying to say, hey, we're a little match.com here. We're trying to match the personality of this stock with the personality of the trading system and get them together, right? So we're trying to do that. We're trying to merge these things together. Okay, so I mean, if we think about it, it's a little bit of a time machine because what we're doing is we're analyzing that historical data to verify our strategy, and then we're taking every trade to see how it would have performed. So it's really a good review of how that stock did. Okay, so again, this is all historical as we go through this, but it can really help us in our trading. Okay, so let's go back here. I'm going to close these charts for just a second. Okay, and if I go back into my Explorer and I look at this report here again that went up on the other screen, bring it back. Okay, so again, we have these 22 signals that popped up. Now these 22 signals are giving me opportunities. Now, how do I know again which one is the best? So let's go in and let's go into our next function here, the system tester. Now, the system tester is the tool that we just talked about. This allows us to bring everything together, okay? So what I'm going to do is I'm going to search my system. Okay, we're going to do the MACD again, so the MACD expert system. And I want to do that list of stocks that I just explored, okay? So now I need to tell the system tester a little bit about me and how I trade before I run my test, because changing these items will depend on how your results look. So you want to make sure you fill out your questionnaire about your personality before you do this, okay? So you can tell it, hey, I take long trades only, I take short trades only, or I do both. Okay, so we're going to say both, because in our scan we had long opportunities, short opportunities, so we'll just say both. But it's important to say whether you trade long, short, or both, okay? Then we can say how much time we're going to look back over. So in my look back, I can say, well, I want to look at the last year. I want to look at the last 2 years. I like to look about the last 5 years. Well, why would I want to look back at the last 5 years? Well, if I do that, it's allowing me to look at different market conditions and how the system's performed in different market conditions. Okay, does it hold up when it's not trending? Does it not hold up when it's trending? So we want to look at that. But that's all up to you. You can say what you like to look at. Now I'm doing this on a daily interval, okay? And then I can say a little bit more, okay? I'm going to, now on these options, reporting is just how it's going to look on a chart if you click on it, so we're not worried about that. So here what we can do is we can say how much we're trading or what we're doing. So I can say, well, we're living large today. I've got 100,000 in my trading account. We're just going to do some easy things here. So let's say I have 100,000 in my trading account. Then you can say what you're willing to risk of that money in any given trade. So one, you could say, well, I only trade 25 shares at a time, or I trade 1,000 shares at a time, or 1,000,000 shares at a time, whatever it may be, okay? Or I can say transaction cost. So what you could say is, well, I'm always willing to risk $5,000 in a trade, or $10,000 in a trade. You can set it like that. Or you can say percentage of available equity. Now what that is if I'm taking my 100,000 and I were to say 10%, I wouldn't recommend 10% into a trade. You know, that's all up to you. And that's why this is important to fill out, because what we're trying to do is determine how this system will work for you in your trading. So if I were to say I'm only willing to risk 1% or $1,000, well, that limits what I might be buying in that buy and sell. Let's say something's trading at 800, well, you're only buying one share of it at a time. So this is a little bit part of that situation here. So if I say I'm willing to risk 10% and I have 100,000, well, I'm willing to put 10,000 into a trade at any given time. Okay, so that's what I'm doing there. Now, if you're trading commodities, what you do is a points only test, okay, because commodities trade a little bit differently. Now, so I'm risking my 10%. In this tab, what you can do is you can say if you trade on margin or if you get money on your money market account when you're not in a trade. So those are things people have asked us for in the past. If you trade on margin, you could put in your margin requirements. If you pay commissions when you trade. I know a lot of US brokers don't charge commissions anymore, but we have a lot of international clients who still do pay commissions, or there are some brokers that do charge commission. You can make that part of your back test, because that is a real cost of trading if you pay commissions. If I'm doing that and I'm paying $10 in, $10 out, or $40 in, $40 out, that can affect your profit. And you want to be able to see that in your back test. So you can fill that in here, whether you do points per transaction, per unit, or a percentage of the transaction. I'm going to leave it at 0 since typically I don't pay commissions with my broker. And then finally, we have this last tab. Now, a lot of these tabs, again, and I'm going through a lot of information here, but once you kind of set all this up, it's kind of set it and forget it, okay? Because if you're doing the same thing, you're doing the same concepts in your back testing, then you're all set here and you don't have to worry about that. So this first one here is realistic market prices. Now, what in the world would realistic market prices be as part of back testing? So what this is, it's basically saying, hey, so let's talk about, say, on the SPY. When we were looking at that SPY chart, it had a sell signal that had come in and was there today. Now, that's not a confirmed trade. So the way the system tester has to look at it is say, okay, I have to wait till the close of the bar. And then when the bar's closed, then that position is set and it takes it on the next trading bar. Okay. Now you can change that. So you can say, well, I want to actually get out on the low of the bar, or the close of the bar, or the open of the bar, or buy on those conditions. So you can change the condition of when you're getting in and out of trades. And then you can say, I also want to wait 3 bars after that signal, or 2 bars after that signal to do that. So you can really get in with some customization here. I'm just going to leave the default at the close of the bar, buy or sell in the next bar. And then finally, we have slippage. Now, slippage is basically saying when I'm looking at it, I'm buying. Let's say I have the sell signal today, and then I have it ready to get out on the next bar. Do you always get in right at the open? You may have some movement there. So you can set a percentage, like a 0.01 or 0.02, or a certain point, like 1 point or 2 points, to kind of justify the slippage of that trade. Okay, so that is kind of our concepts there. So let's go back to our system test. We've got all that set up. So let's run our test now. Let's see which of those would have been the best opportunity. Okay, so it just ran through that test. Let's go ahead and view our report, and let's take a look here. Okay, so here's what I tested. Okay, so I have my 22 stock. Well, let's maximize this so it's a little bit better. Okay, here I have my list of stocks that we had opportunities with, my symbol that we did daily. Here's my date range. So I tested from 5/14/2021 to 5/6/2026. Okay, so the data I'm using is local data that Jeff had downloaded on this machine, which dated through the 6th. Okay, so we'll do a more current example here in just a minute. But this is through the 6th. So here I have my net profit, percent gain, number of trades, and then my winners and losers. So let's rank on percent gain. So during this period, Intel was my best trading stock, percentage-wise. Now, this doesn't mean it's the best one to trade, but this is the best one it did percentage-wise over that time. Remember, this is over a 5-year period. Okay, so if I look at this, I had 202 trades, 90 were winners, 112 were losers. So I had more losses than I had gains, but it was my best performing stock. So what does that tell me? Just an initial glance, if I'm thinking about that, what it's telling me is if I had 112 losses but only 90 winners, okay, so it tells me my losses were probably smaller and my winners were probably bigger. And we're going to validate that when we go into it. So let's jump in and let's take a look at it here. Okay. Now, when I get into these reports, there's a lot of information here, and I don't go into all this information. We're just going to highlight a few quick things. But if, you know, and I'll show you quickly what I look at when I system test and how quickly I go through it. But if you really like to get into the weeds and look into a lot of detail, there's a lot of detail here. Okay. So all I want to focus on here is one, again, my profitable trades, 66 were long, 24 were short, 83 were long on losers, and 29 were losers. But I can see my average profit here was 621, and my average loss was 337. Now, this is an important note. Okay, the way I just system tested, I just said buy when it says buy and sell when it says sell. What's missing out of that equation? Stops, right? We're missing stops. And you can go in and you could program your stops into the system tester. So if you have a certain stop level that you like to use or percentage or different things, you could program those in. That's part of the system tester and what it's capable of. But here, all I'm doing is says when it says buy, buy, when it says sell, sell. And because I just want to see how it stands on its own legs, okay? My highest profit was about 3,600. My highest loss was about 2,400, okay? Now, if I put stops with this, it'd be a very different picture, obviously. Okay, so you can go through, you can look at all this information, you can look at orders, you can look at positions, but what I like to focus on is here, the equity line. Okay, so the equity line is what my money would have done over time if I had taken every buy signal and every sell signal over that period. And if I do that, this is what my money would have looked like. So this is my initial investment, 100,000, and here's 5 years back. Okay, so if I look here, you can see we had some losses and it stayed down here. And again, this is when the MACD says buy, buy, when it says sell, sell, and what my money would have done. And overall, the first like 3 years, it didn't really do much, right? But what's it been doing kind of lately? We've been kind of seeing more of this upward trend. And how is Intel performing right here? Okay, well, that tells me that the MACD has probably been performing pretty well in the last probably 50, 60 periods. Okay, so recent market, it's working well. And again, this is back to the 6th. So up to that point, it was working really well and performing really well. So if I was looking at this, if I was thinking about making a trade, would this have been an opportunity I would have considered? Okay, so it's really performing well. So this might be something to think about at that time, right? And then this is just all the math on how everything's broken out that you could go through. So let's go back here for just a second. I'm just going to move this over here, and let's close that, and let's pull up Intel with a clean chart. Okay, so this one when we scanned was back on the 6th. Okay, so 5, 6. Okay, so this would have been the trigger right here for this particular one, and then we had the run up. Okay, so if I put on my expert, we can see the buy and sell signals. Okay, so we would have had the signal in there. Okay, so it would have been a valid signal in that period. Now, if we were going through and we were looking at those tests again, let's close this out. And we were to look at those results. Oh, let's go up here, look at report. Okay, and we go down to my current one. All right, and we look at this. If I were to maximize this again and rank this again, let's look at the next one here. So if I were to look at Western Digital, then I go right to my equity line. Okay, so what do you think of this equity line? Okay, it's been choppy, kind of up and down. Again, we're kind of seeing that same, it's working well in the current market, so something to consider. But what I usually like to look for when I'm looking for an equity line is I'm looking for a smooth, consistent equity line, something that's working across all markets. I'm not really seeing that here. We're kind of seeing the same behavior across different stocks. Okay, so I'm not seeing anything that's really working with the trend right here. So let's maybe look at it. Let's kind of maybe look at a current example. So let's close this. Let's go back to our scanner and let's do a current scan here. So let's do the MACD again. But let's do something that's current. So let's try the Dow 30. Okay, and if I were to do that, we'll do today's date. And let's just see if anything's happening on the Dow 30 with the MACD. Okay, you can see it's rejecting a few. So we're getting some examples. Okay, so this would be more current market here. So this is what we're looking at here. So if I rank, we've got a buy opportunity here on McDonald's. We've got a sell on Amgen, and then an overbought on Cisco, and then nothing there. Oh, and then a sell on United. Okay, so let's look out of those four. Let's do that same system test. So now we're just doing a quick one, a quick scan, a quick opportunity, and let's do. So I did that scan very quickly. I've run my back test very quickly. And now I can say, okay, well, I know United and Amgen seem to work well. McDonald's does not with MACD. So if I run a percent gain here, so United Healthcare, about 2% over that period. Look at my equity line, it's choppy. Okay, so if I'm doing this and I'm getting ready to trade, and I go through and I look at my equity lines and they look choppy, they don't look good. As a trader, that's okay, because what I'm doing, again, is I'm eliminating my risk. I'm taking out things that I don't want to see. I want to see something that performs consistently, and I'm not seeing that here. So let's run one more scan here. So if I were to go back to Explore, and let's actually try RSI on, let's actually relative strength. Okay, we're going to do relative strength. So RSI, we'll do the same Dow 30, and we'll see if anything's going on. And this is how quickly you can scan through, identify an opportunity. Okay, so I've just looked through that list of stocks. I've got Apple and McDonald's that have an RSI signal. So let's come to our system test. And now let's change this to RSI. Okay, RSI. And then we'll do my exploration results. We'll start my system test. And obviously you can do this across anything, any market, right? So if I rank this now and I go percent gain, okay, I'm not seeing anything that clearly jumps out to me. Again, I'm looking for a good, smooth, consistent equity line over that time. Okay, so let's maybe take a different approach to it. And this is where I need your help just a little bit. We're going to take some different examples, but what I would like you to do is I would like you to just give me some symbols to look at that we can backtest and identify to see what system is performing best on them at the current time. Okay, so while you're doing that, I'm going to put in just one symbol here. We'll do the SPY since we've looked at that. Okay, so what I've done here is instead of looking at finding a current opportunity and then testing to see if it's a good strategy, what I'm going to do is do that second workflow we talked about. I want to be able to say, well, I'm just trading the SPY. Okay. So I'm going to take the RSI. Well, let's do this. So we're going to put in the SPY, SPY. And then what I'm going to do is I'm going to select a large group of systems. So I'm going to do what we call the performance systems in Metastock. This is a collection of about 80 strategies that come built in with Metastock that allow us to look at kind of different market conditions. So I'm going to test all of these against the SPY to see which one performs the best, okay? Okay, so we're getting a couple symbols in there. Awesome. We'll take a look at those here in just a second. Okay, so I've already got my results here. So when I look at my results here, this is very different than what I was looking at before, because before we had a list of stocks. And now what I have is I have a list of strategies and how they performed against the SPY. So if I rank this now and I come in, I can see that this PS detrended EMA system, so it's an exponential moving average system, has been the best performer over the last 5 years. But what has it done? One trade. Okay, so if I'm looking at one trade over 5 years, as an active trader, I don't know if that really matches my style, but let's look at the equity line. Okay, now if I were to look at this equity line, so it got in way back here and has been in that trade since. But if I'm looking at an equity line, I like that equity line. For the most part, we're seeing smooth, consistent performance and getting that out of and looking at that. That's what I want to see in an equity line. It's that kind of thing, but with active trades. Okay, let's go back here and let's look at the second. Well, the second system is only one trade too. Let's look at our third one here. We'll go down to the third one. So this one had a 6% over the 5 years. Now, one of the questions I get asked is, well, Kelly, looking at this, I'm only getting 6% back over that whole year, over that 5 year period. Is that really worth trading? Now, remember, this is over that whole period. Every trade in, every trade out, every trade in. So it's got wins, losses, everything in there, and that's a cumulative return. So this isn't really what you're looking at. So don't be too concerned about percent gain when you're trading it. You want to really focus in on that equity line. So here with this pattern trading system 1, we had 164 trades, 100 winners, 64 losers. So a lot more winners than we had losers. So if I pull this up and look at this one, let's go to my equity line here. Okay, so that's exactly what I would want to see. If I had a current signal and I was trading, I would be wanting to see an equity line that looks like this. That smooth, consistent performance across markets. Okay, so that's big time. That's exactly what we want to see. So if I was trading SPY and I wanted to look at this system, so we were looking at the pattern trading system 1, I would go back to my chart. I would put in the SPY. And then I would go to my expert advisor and I would go to pattern trading system 1, put that on my chart. And then you can see the buy-in trades that actually occurred here and what it was doing. Okay, so it just generated a buy a couple bars ago, but it's already exited out. Okay, so you can see entries, exits, everything on that trade. Now, the one difference is when you're back testing this way is you're testing something and then you're seeing how well it's worked. That doesn't mean that there's a current opportunity on it. You may have to wait for the next opportunity with it. So that's just something to keep in mind as part of this. Okay, so let's look at a couple of symbols when you come in here. Question is from Paula, can I look under the hood of each strategy and is this Metastock 20? Yes, so this is Metastock 20. And that's a great question. So if I were to go back to my system tester here and I were to go back to this report and look at it here, so here's my report. So if I view it again and I go into, say, let's rank on this again and go into the pattern trading system 1. If I were to go over to the system, what it's going to do is it's going to tell me here what the formula is for that backtest. So you can look under the hood. But I'll say that with a caveat, because when you're looking at this, one of the things that happens is not all of the systems are open source. A majority of them are in Metastock. But if the creator of the system wants to keep it proprietary, this may say you need to enter a formula to enter it. But I would say probably about 90% of what's included in Metastock is open source, so you can go in and you can look under the hood. And that's a great question. So yeah, so that's how you would do it if you wanted to see what's under the hood. You can just see what's happening right there. And if you don't know how Metastock formula language works, we have some great tutorials and books online that show you how formula language works. So don't be, and you can always ask our free support, hey, what's this kind of doing? Can you tell me what's going on with this? And it'll walk you through it. Okay, so let's system test some of these questions we had. So let's go in and let's system test. Apple was our next one. Okay, so I'll just leave my results the same here. And let's go ahead and system test. Okay, Paula, while this is running, I hear that there's a forecaster capability in Metastock. I'd like to see that one day on a future seminar as well. So if you want to see the forecaster, on Wednesday, Scott Brown will be doing the forecaster presentation. So you can come and see that on Wednesday. So yes, come and see the forecaster. So that's a great one. I clicked off my system test. Okay, there we go, view report. Okay, so this is on Apple. So this is a view of Apple and what's going on with Apple out of those strategies as well. So if I click this, now the pattern trading system, again, is the same is what we just saw in the SPY. So very similar trading, very similar things would be my guess. If I go to the equity line, man, that's a pretty equity line. I like the way that looks. It's smooth, consistent against different trading markets over time. Again, our 5-year period and what we're seeing. So this is a great great equity line. So again, you just open your chart, go to it, look at it. Let's look at our next one down. Okay, and this is what stands out to me in backtesting. Okay, because I can look at this and I can say, okay, my PS trading system 1 was my top performer, and my 4-day range switch here was my second one. But if I looked at that equity line on the second one, it had all its gains out of 1 or 2 trades, and they just kind of stayed flat. So looking at that equity line versus just looking at this first screen is so important, because you're going to get so much more information out of the equity line than you would by just looking at it by itself. Okay. Now, one thing I like to highlight here too is, so PS trading system 1 was my top performer. But if I come back to my system test and say, hey, I only do longs only, let's see if we get a different result. Okay, so it's going to go through and look at it in this other way and see what it looks like here. Now, it may be the same system. I don't know. I haven't back tested it. So it is the same system. So, so it is the same thing there. Okay. So let's go ahead and let's look at another stock here. Just 1 or 2 other quick examples, then I will wrap up. Okay, so let's see, we had SNDK. Okay, and let's go ahead and run my test on this one. Oh, this is a great question. Thank you, Robert. I appreciate it. So doesn't comparing back-tested results imply you need to trade the same instrument over the back-testing range to see the same return? Otherwise, wouldn't the win-losses over the back-testing period be one of the most important considerations? So yes, so the way that I look at back-testing, and people will look at this different ways, and it's a great question, and I really do appreciate it. What I'm trying to do out of backtesting is, if I see that result come in, so if I go back here and look at my report here, and let's say I had a current opportunity on one of these, okay? So here on this, the PS Arun reversal system was the highest trading one, okay? And we've got an equity line that's very smooth and consistent over time. So if I'm walking into that trade and I'm thinking, okay, do I feel confident in this trade? Well, I feel more confident in this trade because it's been performing consistently over time. I don't really take an expectation of what those past results were, except for if I were to look at my average profit based off of the system that I used, I can know what my expected profit would be out of that range. And then I can also protect myself by knowing what my unprofitable trades would be. So I know, if I know on average what the expectation of a drop is versus my gain, I can set ranges for trading, right? I can say, well, my expectation is I'm going to move up here for my top performer, and my losses on average come down here. So you can know where to set stops and targets based off of that information. So I hope that kind of helped answer that question. So I'm really focused in on really getting what my confidence level in that trade, and then I can use those other bits of information for more information. And we have great videos on system testing and how to kind of use system testing. Jeff's hovering outside, so might need to start to wrap up. But think of it again in this way. It's validating that strategy's effectiveness, knowing that you, with confidence, that it's performing well. Now, that doesn't mean, again, that it's going to perform well. It might go against you the next day. And that's why setting your stops and having your expectations of your trade are so important in part of that backtesting analogy. So when you put it all together, it really pulls it in. Okay. And it's just knowing that they're all back tested. So solid question. Is it possible to backtest correlations or portfolio test in Metastock? No, it is not possible to portfolio test right now. That's something we're looking at for the future, but right now it doesn't portfolio test. That's a great question as well. So let me just talk about what you get if you get Metastock really quickly. If you have Metastock, you probably love our support staff. They're an amazing set. They can help you with just about anything, and our support is free for the life of using our software. So call our support if you ever have questions, you want to know what a formula means or anything, give them a call. But if you're just getting new, if you're new to Metastock, you're just getting set up, we offer free white glove setup. It's one of the hallmarks of Metastock is when you get started with Metastock, they will spend 30 minutes with you, an hour with you, 2 hours with you, talking to you about what you want to get out of Metastock and helping you get that set up. It's truly a great experience. So when you get Metastock, make sure you get your free white glove support. Again, free lifetime support, free phone chat and email, free training videos. There's all kinds of things that you get with Metastock. We are really here to support you and help you get set up the best way to get the most out of Metastock and use it in the best way. Now, getting started with Metastock, how do you get started? Well, we do offer a 3-for-1 trial that you can take advantage of. Basically, everything I've shown you in Metastock's in our free trial. You can start off with our end-of-day version or our real-time. If you just go to metastock.com/conf-promo, go to metastock.com/sales chat if you want to chat with somebody about what version of Metastock's best for you. There's a couple of versions. We have our Metastock end-of-day or our Metastock real-time. Or you can just give guys a call. If you want to talk to people on the phone, they love to talk on the phone. They can chat you through anything. Just give them a call at 800-882-3040, and they'd be happy to walk you through what's best for you in Metastock and how to get started and everything. So again, metastock.com/conf-promo or /sales chat or 800-882-3040. Jeff, come on in. He's standing at the glass door staring at me, telling me it's my time. So I know we got to get on to the next presenter. Thank you so much, everybody. I appreciate your time and your questions and everything. I hope you get started with Metastock, and thanks for joining me today. Jeff,
all right,
over to you.
Thanks. Supposed to exit stage left.
But I can't.
All right, let's get sat back down. Good job, Kelly. I love how just multiple. I love how many systems are in there. I love the fact that you can test them all. You get all that expert advisor. That system tester allows you to skip your learning process, and well, not skip your learning process, but shortcut. It allows you to figure out what works well. I think it's important that you understand why you're trading when you're trading in the market. Discipline's such a key to kind of trading well, but man, that system tester sure helps you understand what's working and what works well. So very, very good. Thanks again, Kelly. Let's go ahead and, am I in the right? Let's get into the right PowerPoint real quick here. Looks the same, right? All right. Kelly did do a really good job of talking about the opportunities that are available, the extended trial, the buy one, get two free. You can do that if you go to metastock.com/conf-promo. You can give us a call, 800-882-3040, or you can go to metastock.com/sales chat. So thanks again. Paula, thanks for all the questions today. That's awesome. Robert, thank you for participating as well. As we move on to our next speaker, I want to say thank you to Stocks and Commodities Magazine for supporting the event all of these years. We appreciate it. You can find more about Stocks and Commodities Magazine at traders.com. And I do want to welcome our next guest. Jake Bernstein is an avid trader. He's been trading for a very, 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 very long time. He's been trading, I think he said he placed his first trade in the 1960s. He's written a prolific amount of books on trading, some very popular ones on day trading, and he specializes in creating methodologies that employ his setup, trigger, and follow-through methodologies. I had to kind of remember that. Brian has kind of taken a lot of the concepts that Jake has worked on, and he has incorporated them into what I call the Swiss Army knife of indicators. It's been a very, very popular methodology and a very popular way to look at systems and methods within Metastock. So without further ado, let's welcome both of you guys in here. Jake, Brian, how are you doing?
Doing okay.
You're doing okay? Okay, good. That's good to hear.
Can you hear me okay?
I can hear you. Great.
And I don't look like a terrible one. Hold on.
I cannot hear Brian though.
Jeff, am I logged in twice?
You are logged in twice. I'll dismiss the one that is a duplicate login.
Okay,
We
that's
can
better.
still hear you. Yep, we only have one of you now. Brian, I can't really hear you.
I'm here.
Okay, there you are.
Yep, I was trying to be quiet.
Very good.
Okay, so thank you for that introduction, Jeff. Sorry about the voice or lack thereof. I've considered it a great big pleasure to be doing business with Metastock for such a long time. I don't know what's more impressive, being here with Metastock or being here with Metastock over 30 times over the years has been a very great experience for me. And of course, the ability to do something with Brian has been a great experience as well. Brian is a consummate professional, great coach, excellent at options, and really good at understanding my stuff. So I want to thank everybody for letting me be here. You want to enable my screen sharing, Jeff?
Oh yeah, I can do that. Let me. I turned on Brian's, but let me make yours of it. Make you the presenter instead.
Yeah, for the time being.
And it should ask you to turn, or if you want to share your screen. No, I'll make sure that that kind of comes through fine.
Okay, it's not asking me.
Let's try it again.
Okay, hold on 1 second, please.
Okay. It should be asking you right now to share your screen.
I'll tell you what, it's not letting me do it. Because it won't let me go to my presentation. Just 1 moment, please.
Did you get the screen prompt that said, hey, do you want to share your screen?
No, I didn't get that either.
At the bottom of the screen, do you see where it says share? Share my screen?
It's grayed out.
It's grayed out. Okay. Interesting. Let me make me the presenter again. I will share your picture, and then we'll make you the presenter.
So everything on my screen is grayed out, including your picture.
Did it? Is it prompting you to share your screen at all, Jake?
No, not at all.
Okay.
Let me try that again. It's got a big X where it says share.
If you click on share, does it do anything?
No.
Okay.
Tell you what, Brian, you want to put up your PowerPoint? Hello, Brian.
Yeah. We are seeing Brian's PowerPoint.
Just hit share
Can see it.
and should see my screen.
Yep.
Okay, we will work with that one. Okay, so very good. So I've been trading for 58 years, probably starting to sound like it and look like it as well. For the first 15 years that I traded, I couldn't figure it out. There was so much available that was worthless that no matter what I tried, it was all subject to interpretation. Then fortunately, computers came along. We had programs in their nascent stage, such as Metastock, which gave us an opportunity to look at things objectively and clearly. So now, and for many, many years, I never use judgment in understanding the markets. Judgment has no place in what I do. When it comes to evaluating people, I can talk to a person for 5 minutes, ask them 3 questions, and tell you immediately with great success whether they're going to make money trading or strike out. But when it comes to markets, I never interpret. It's completely fact-based, rules-based, scientific, and that's the beautiful thing about Metastock. But here's the downside. Kelly did a fantastic job teaching you or showing you the features of Metastock in terms of its objectivity and its backtesting capability. But the weakest link in the chain is always going to be the person. I can find a great trading system, give it to a poor trader, and they will lose money. I can give a good trader a bad trading system, and they will make money. How does that happen? It happens because of management of risk. It happens because of interpretation, because traders use looks like. They have great tools, but they don't use them. We can't change that. I can't change that. Brian can't change that. Jeff can't change that. Metastock can't change that. A person who is, excuse the expression, a shitty trader is always going to be a shitty trader no matter what tools you give them. I live up here in the mountains near Santa Cruz, California. I love fast cars. I love beautiful cars. People come to my house and they say, Jake, can I drive your fast car? I say, no, I will give you a ride in my fast car, but I won't let you drive it. Why? Because you're going to kill yourself. You don't know how to drive it. You're going to kill yourself, but what's worse, you're going to ruin my car. And it was expensive. So the bottom line is this. You can have the best trading system, the best software, the best charting program, the best backtesting, the best system development program, and still lose your butt because you're a crappy trader. I think you all know that. But how do you really say you know that until you really know it internally? So what Brian and I will present to you today is purely objective. It's clear. It's not subject to interpretation. And yet, the reason we have the disclaimer about how you can lose money is more about you than it is about us. If you're not a good trader, no one can change that. So the key question here is this. How do you become a good trader? Easy. You find a strategy that works. You backtest the strategy. Then you apply it in real time. Take what I call the 10 trade challenge. I always tell people, do the next 10 trades absolutely according to the rules. And Brian chimes in and says, how about doing the next one trade completely by the rules? Because most people can't even do one trade without finding a way to screw around with the rules. So again, not designed to insult you or to call you an idiot, but to call myself an idiot because it took me 15 years to realize that. So let's go forward. I'm going to talk a little bit about the strategy that Brian developed for us called expansion contraction, which he developed from my indicators and added his own so that we could look at trades completely objectively. He will explain to you what all these lines mean. But first, I will show you how I use this and how I use it not just for position trading, but for day trading as well. Why day trading? I'll tell you something interesting. About 4 months ago, my literary agent called me and said, hey, Jake, I've got a $5,000 check for you. You do? I said, who's it from? He said, it's from McGraw-Hill. So I said, well, wait a minute. Why does McGraw-Hill want to send me a check? He said, it's a royalty check for your day trading book. Wait a minute. I've written 7 day trading books. 5 of them have been bestsellers, but that was many years ago. He said, yes, but they're still selling. So I'm going to send you a check for $5,000 for a book that you wrote 18 years ago. Well, that's interesting. Why is it interesting? Because even today, many, many years after we have proven categorically that you make big money in big moves, and big moves make time, people still want to beat their head against the wall and day trade. I don't enjoy that. It's not because I don't have trading strategies in day trading that work. They do work. Like I said, I've written the 7 best-selling books on day trading from McGraw-Hill, Wiley, HarperCollins, and so forth. And I still get people who read those books and write me emails and ask me questions. But there's a fascination that people have with day trading. If they're in and out by the end of the day, they feel like they got away with something, or they love the challenge, or they feel they can make a certain amount of money every day. They'll say, if I can make $500 a day for the next 200 days, that's a nice little income for me. Well, it shouldn't work that way. You should remember that the most important thing you have is time, and your biggest money will be made in trades that you keep the longest, provided you're not keeping trades just because they're losers and you don't want to take the loss. So what I'm going to do is show you some charts. Then I'm going to turn it over to Brian, and he's going to teach you the real good stuff, how it works. But for me, as an old guy, I don't need to know how stuff works. I don't need to know what's under the hood of my Ferrari. As long as it gets me from point A to point B, fast, safe, and with a great experience, that's what it's all about for me. But remember, even though I do day trade, and many of my trades are closed out by the end of the day, I don't get into them intentionally with the purpose of day trading. Sometimes they last longer than a day. One more thing. Please also remember that the weakest link in the day trading chain after the trader is the fact that you must be out by the end of the day. That can work for you and it can work against you. If you're a real, true day trader, you're out by the end of the day, win, lose, or draw. That limits how much money you can make unless you increase the size of your position. If you're a real day trader, you're out quickly. You cannot carry trades overnight. If you carry trades overnight, you're no longer a day trader. And the good news is you're opening yourself up for a much bigger profit. The bad news is you're not a day trader. Furthermore, it's very important for you to understand what you can do in terms of time. Believe it or not, I still get phone calls from practicing doctors, surgeons who tell me they want to day trade. And I say, you mean you're going to have someone on a table, their guts are going to be open, and you want to be day trading while you're operating? And some of them admittedly say, yes, they do. To which I say, sorry, I will not teach you how to trade. You have to learn it from someone else because I don't want the responsibility. So let's look at this chart. This is an intraday chart of gold showing price on the top with various indicators. In the middle, Williams accumulation distribution and its moving average 57 simple. And on the bottom of the screen, the brilliant expansion contraction indicator. Because I'm a simple guy, because I learned over the years that for me, simple is best, I do simple things, which is not to say that I haven't done complicated things. I have. If there's a system, strategy, or indicator out there, I have most likely traded it or tested it and rejected it because it doesn't work for me. As a speaker this morning said, find your own place. Once you find your place and it works, ride that horse as long as you can. So this is the expansion contraction horse. And for me, it's very simple. At the bottom of the screen, and Brian will describe these in detail, we've got the expansion contraction indicator. You'll notice it varies from green to red, from red to green. You'll also notice that when the indicator is green, the bars are green. When the indicator is red, the bars are red. It couldn't be more simple. For me, it's this. 2 consecutive bars red, I go short. 2 consecutive bars green, I go long. If I don't go long immediately when the color changes, I buy the bottom of the channel support. Brian will describe all these to you. As you can see, these haven't really been cherry-picked. This is pretty much of what the market did exactly on that day. So it's clear. I'm long, I'm short. I have a profit target in between. I have a trailing stop, which is my risk management. It's that simple. Let's look at the next chart. Again, here's a more choppy market, but again, think about it. I'm long, I'm short. I'm long, I'm short. And notice the color has changed. There's a purple line, which means it's basically neutral, but Brian will explain that to you. We've also got this great big band over here, which I believe, Brian, is the Keltner band. And that also gives us support and resistance if you want to dig into those terms. But as I said, I'm the simpleton of the group. I've been around the block a few times, and having gone around the block so many times, I've learned that my place is not to be fancy, not to be the guru, not to be the great all-time trader, but to simply follow the rules, keep my nose to the grindstone, and do what works. In addition to that, I need to manage my risk. If I'm managing my risk effectively, that's the key to the whole thing. Brian, can we see the next chart? And by the way, these are all intraday charts. And I can't read this off the screen. Oh, it's gold. Yes, gold day trading. So notice the beauty of the strategy. Here's the B for the buy when the color changed. And on the right-hand side, you got all the way to the right, the S, the red S, which indicates reversal of position. But this is a big move, and it happened over a short period of time. And notice on the bottom of the screen, the expansion contraction indicator, a thing of great beauty, because it stayed long through this entire move. So what's one of the keys to success? One of the keys to success is don't try and be too fancy. Don't try and trade too much, because less is more. You don't need a lot of moves. You need a few good moves. I had a business partner once told me, if you think you're trading too much, trade less. Think about that for a moment. If you think you're trading too much, trade less. It sounds like a contradiction of terms, but clearly it's not. And by the way, looking at the expansion contraction analysis on the left-hand side of the screen, you'll see what Metastock did. It gives me major resistance, minor resistance, support, tells me all the things that I need to know about this chart. And that's the beauty of what Brian has done here. Brian, let's go to the next chart. So here's a closer up look at this chart, same chart we just saw. And again, I want you to notice this. With the vast majority of trading strategies, you're going to be chopped back and forth. Notice the expansion contraction indicator. Once it changes from red to green or from green to red, it stays there for a long time. It's consistent. And it also gives you opportunities to buy support and sell resistance, which Brian will cover in the next section. Let's go to the next chart, NQ. Okay, so here's NQ again, if you like NQ. By the way, I have met many traders, especially in the last few years, who love the NQ, love the S&P. I've got nothing against them. But remember, volatility is a knife that cuts both ways. It can hurt you and it can help you. I'm more interested in giving up things that can help me to avoid things that can hurt me. So again, I'm a very conservative trader, and that has been one of the reasons for my success after all these years. So many of the traders who got started when I got started in 1968, 1970, who were successful at that time and had big names in the business are no longer there. I came from a very poor family, grew up in one room in someone else's house. My daddy didn't have any money, but still I made it. How? By trial and error and being persistent and finding strategies that worked for me that did not involve too much risk. Let's go to the next slide. And again, you'll notice that this works well, even in choppy markets. And to determine how well it works, we use the backtesting feature on Metastock. So I'm going to turn it over to Brian, who can take the slide anywhere he wants and explain to you exactly what the indicator is and how it works. But remember one thing, it's not about the indicator. It's not about knowing what's under the hood. It's knowing what you can do and what you can't do. So if you find yourself in a really good place and you're making money consistently, even if it's a small amount, you can take that small, consistent amount and turn it into a huge amount by increasing your position size. So there are a number of ways to do this. You want to do it the right way. And Brian, I turn it over to you.
Thank you for that, Jake. I'm going to pop back a few slides here just to get back to the initial descriptions here of expansion contractions. I've focused in on the bottom indicator here to just show the red and the green line. As you can see, I've just labeled these as shorter term moves where prices being measured, the highs and the lows of every single bar are being measured at how fast they trade through Jake's moving average channel. So the short-term red and the green lines give us the short-term swings of price, and then the cloud or the cone areas in the background that are green shaded and red shaded are the long-term trends, and that can give us the pattern here of the short-term swings and long-term trends. as long as we're remaining short-term and long-term bearish, we'd want to stay in. So this is a momentum indicator, but unlike other types of momentum indicators, it's not lagging. It is calculated on every single bar. On the next chart here, I'm just identifying resistance and support on here. Major resistance should be where the cloud or the cone peaks. In the background, we'd have this as a significant high because we've been strong uptrending. And also when we've expanded widely with the cloud, we might identify a major support on that, basically in downtrends. And of course, that would help us with a physically identifiable support and resistance on here, and try to stay away from the overbought and oversold labels, which are really not accurate. The median, that is just a center line in here. You're going to see either a rising or falling median line or a solid zero line here. It comes in both ways. Ideally, what this is just telling us is where things should be crossing and changing from bullish to bearish on all of that. And also there'll be some dashed lines and some dash dot lines and some small dash lines that are running in there. As you can see, the 1 standard deviation short-term lines are closest to the median. What this does here, in order to try to keep this simple, is just tell us what the normal range is, and if the short-term lines or the long-term lines are exceeding their normal range, then we could consider them to be strong up or down. And that also labels the 2 standard deviations for long-term on there, show us the furthest apart lines. The 1 standard deviation long-term shows us what's normal for the cloud or the cone in the background. And that helps us identify initially a strong breakout that really fails to follow through and then becomes weak. So all of the definitions are included on all of this. And with that, as Jake had mentioned, expansion contraction identifies every single bar. The strong up are the dark green bars. The weak up, in other words, we're short-term bearish. In an uptrend, you'll see light green bars. Weak down patterns will have light red bars, where short-term we're bearish and all that. And then the strong down will be the dark red candles or bars. This just helps identify the complexity of expansion contraction at the bottom, right down into seeing it on the bars. And that should make it very simple. Basically, it just is what it is, clearly marked visual confirmation on that. As I mentioned, it measures strength and weakness by going over its normal range. That is taking a look at 500 bars of data in order to run a moving standard deviation on that, which helps us again identify above average pricing or below average pricing for strong or weak definitions. So ultimately, with the way expansion contraction's been coded on the metastock charts, you should always know what to do, whether you should be bullish or bearish, in or out. And I always like to say at the right edge of the chart, expansion contraction is helping us with reality. At the right edge of the chart, we're either strong or we're weak or we're up or we're down. And with the coding on there for the buy and the sell setups with the B's and the S's should make it pretty clear when you have a setup. And again, it's been back tested generally on high volume stocks. Generally, I'll look for 1 or 2 or 3 of the top weighted stocks in strong trending sectors to apply expansion contraction to. And it has had the win more often, make more than you lose on average results over time. And definitely want to be trading strong trends up or down. It's your best opportunity to get your big winners. And certainly one of the keys I remember Jake saying over and over and over is the big money's made in the big moves. And ideally, looking at expansion contraction, the long-term trend filter on that actually is an average of some 24 to 32 periods. And if that's on a weekly chart, you know that's going for months. We even saw in some of those day trading examples earlier, right down on a 1-minute chart, there was a over 60-minute move on a 1-minute chart on that, and that is quite a big move on a 1-minute chart that's usually inconsistent and choppy. So
Can I jump in for
go
a
ahead,
second?
Jake.
Thank you. Sorry to interrupt.
Go ahead.
Very important. when you have a piece of powerful trading software like Metastock, you have the temptation to put 20 or 30 indicators on your chart. My experience has been this: the more indicators you have on your chart, the more lines, the more strategies, the more colors, the lower you're going to be in your profits. There's an inverse relationship between how much you've got on your chart and what you make in the way of money. Because the more indicators you have, the more confusing it's going to be. And remember, 90% of all indicators come from the same place, price. That's why when you run a chart, you look at the chart and you look at the indicator, they're going to be looking the same thing. If you're looking at the same thing, it's a form of mental masturbation. You're looking at the same stuff, and most of the time you don't even know what it means. Go for simple, because simple is the most effective. And now I'll shut up, Brian. It's all yours.
No, I agree completely, Jake. In fact, the more complex your system is, the more likely you are not to follow it. And that is always a problem. I'm going to say even if you have a simple system, the probabilities are you're not going to follow it. As Jake was saying earlier, if you can't take a 20 or 10 trade in a row, make it one, because initially most individuals have a bit of a problem of following along. I'm just going to pop over to the E-mini charts. As Jake had asked for several day trading charts, some on gold, some on the NQ or NASDAQ. This is the E-mini here, where I've labeled out a sell setup. There's an S behind the triangle, and the triangle, of course, is just showing the expert advisor here with a strong sell. This is in the bottom right. It says IM 15. That is a 15-minute chart on that. So if we're looking at the 15-minute chart of the S&P E-mini on here, and as you can see at the bottom, we're looking for the day session. And this just happens to be one of those trends with just the cloud on here that shows from 11:15 on into the overnight session that we very clearly had a sell trigger on that. When you're seeing the small red or in this case diamonds or green diamonds at the top, this is just beyond the upper range of the Keltner or the lower range of the Keltner. I was just using average true range for a profit target, as there might be times when we exceed the normal range of price on pricing here and may revert back to the mean or give us a trade back up into the range. So daily we're getting, go ahead, Jake.
Why don't we use candles?
Candles give us the same information, but they're just more complex with the big body and all of that. So bars are simple. Let's put it this way. I started out simple with systems. I overcomplicated systems for a while, and I came back to simple. That may sound like an evolution that a lot of people go through from your experience, Jake.
Well, candles give us too much information.
Too much information. Keep it simple.
When I see the colors, it gets me confused. I'm basically a simple guy. I don't have a degree in math or science. I do have a degree in psychology, which has been more helpful than trading information. I'm sorry. Go ahead, Brian. I'm sorry to keep interrupting you.
Oh, jump in anytime. I think hopefully everybody appreciates the banter back and forth. As again, I have a slightly different take on your processes, editing them to my preferences. And so it's always good to start with someone who has coding and validated systems and then make them your own. But again, in that process, did find that overcomplicating things is fairly normal. And in coaching so many individuals over the years, I do find that we all go through that. Well, if this works, I can certainly make it better, and go through overcomplicating and then come back to simple. So ideally here, we're just seeing very simply of whether or not we're bullish and strong. To the left of the chart here, we got a buy setup with green bars, again, with expansion, contraction, bullish. It just doesn't exceed a very small standard deviation value here. So we can quantify this as a weak move up here, followed in essence then by a stronger move down, in which the cloud managed to exceed its normal range. And we did trend lower for a potential profitable trade. And I've now dropped down. Go ahead, Jake.
Can you give a brief example of how someone might use an option for this particular day trade?
Day trading options, it does depend on whether or not you're looking for a growth objective or an income objective. Typically, income would be selling options, and zero-day options are really popular for selling right now. They do have their inherent risks, and selling short-dated options are quite risky. I personally, from long-term backtesting of over a decade of information, am aggressive with options, but I'm a buyer of options and I'm a buyer of debit spreads in bull markets on daily to weekly charts. And I'm not a day trader because I technically really don't want to sit here all day and try to watch the charts, because life goes on and interruptions happen, and you're not going to be perfect at getting every type of a setup here. So I will say day trading is up to the individual. And certainly with Jake and I getting a little bit older, we prefer to more get in and stay in and manage once a week, once a day over intense day trading.
What do you mean a little bit older? Go ahead, Brad. Sorry.
That's okay, right? Not a problem at all. Of course, the last chart here, I've just popped up a buy setup here. I've dropped down to a 5-minute chart on the ES. Do find that expansion contraction works well on short dated charts, on long dated charts, on range charts. So again, for the individuals looking for a possible day trading system, the benefits of the trend component of expansion contraction can be a long-term move on here. And if we're just looking at the time frame, this buy trigger right up in the expert advisor shows that it was at 8:40 a.m. I'm also West Coast like Jake, so this is Pacific time, but we want a day trade during the market that we might have an opportunity to stay in through a large section of the day. If that's at 8:40 to get in, it's afternoon to get out at the latest on that. And there were some additional buying opportunities using some of Jake's strategies of buying on the dip at support and a verified uptrend. And so that helps with get in early, get in a little later. There are continuation trades. You might notice a small B here with expansion contraction where we had gotten weak and then got strong again. So plenty of opportunities to get in, take some profit, take some more profit, and eventually see that long-term trend there on a 5-minute chart start to weaken on that. So just to kind of go through the theme here, a little bit of some day trading on that. I kind of wanted to go through on using expansion, contraction, and even the trend filter on here to identify day trade situations that would help on the dip for you to stay in. Because admittedly, if I've bought at or near a high and price starts to dip in the past, I'd be a bit worried about that at becoming a loss. And of course, with Jake's swing trade strategy, on that one, we just have a triggering a buy here and just help us with the ability to stay in. If you've predefined your buy setups and triggers to get in, your stop loss rules should be clear in advance, and your profit taking rules for multiple profit taking, and eventually an exit rule should be clear. Go ahead, Jake.
Brian, this B and S we have on the chart, these are all put there by Metastock, right?
These are coded by Metastock, all a part of the basic indicator itself. And then, of course, the expert advisor has additional information, as you were saying, including all of the additional information that it shows here. I didn't have a set one that showed all of the information, but.
And one more thing, folks. If you're a grain trader, like the corn and the beans and the agricultural commodities, take a look at these with expansion contraction. You will be amazed at what you see. I can't find any indicator that's better in the grains and the beans than expansion contraction.
Well, I'm glad it's worth beans.
It's definitely worth beans.
Okay, so I'm going to pop up as last session. I did show an E-mini rules strategy on that using 16 tick charts. That's 4 points a bar. This is a test that started in February on the 2nd. And I've been continuing to run this through and improve on the actual entries and exits and stop losses and profit targets. But it's not been from guessing, it's been from set up the rules and forward trade them through all the markets on the days and track everything. So if you're not spreadsheeting out your results or tracking what's going on, how do you really know what kind of results? I'm just showing the current from the end of last week, updated results on here with all of the actual trades across the top. I just try to make it easier by coding week by week with the different color shading, and the days are out underlined. But if we look through the different weeks on the profits on here, this has been consistently profitable. It is based on $1,600 risk, or on that 8 points on 2 contracts, or 16 points total. Show the minimum starting on that if you want to have 2% risk on that stop loss, and A, the current balance, B, the total number of trades, and the win ratio on here, some of the max gains in a row, max losses in a row, 5 only once on that. So this doesn't have a lot of consecutive losses on that, and has shown more than 73 trades, or about 11 to 12% of the trades exceed the maximum loss. And there's only been one maximum loss out of 629 trades. So ideally, if you're going to have a system, you got your rules to get in, your rules to get out. You track your average days up, you track your average days down, and all of that, and identify that if you just took every trade, the process would be a positive outcome over time. In the time I got left here, about 20 minutes or so, I did want to just get in here and pop up some option trading results, as I really prefer options from backtesting. And again, the debit spreads are a fixed risk trade and a trend trade, and back tested options using Jake's setup trigger follow through method over 10 years to identify, do I want to be a buyer of calls or puts? Do I want to be a buyer of debits? Do I want to be a seller of credits? Do I want to buy straddles? Basically growth strategies, because I prefer growth. I don't need income on that, but I am popping up in here. There is the buy setup that shows on 410 in Apple. It was a strong buy. The marker from the expert advisor is the green triangle. The B is plotted here normally, and what I'm showing here from expansion contraction, positive, will AD, positive, a buy trigger using a 14 days to expiration, buying at the money and selling out of the money. Debit spread is sitting here currently at 479% up as of Friday. It'll be down a bit today from some of the markets as we've sold off, but we do want to see, can we just get in and buy shorter dated options on this? And the reason for the call debit spread again was that 10-year back testing. And on that, over history, I've seen that this market has a slight historical bullish market. I think most everybody knows that. And of course, ideally, if we're trading an option strategy that gives us an opportunity for growth, then that's what we're looking for on here. So on that one, I've just popped up from a back tester from Capital Markets Labs. This buy at the money, sell out of the money with 14 days to expiration would be up $1,876 with that 479% gain on $391 risk per contract. So ideally, with the shorter dated debit spreads, we can get in for a small amount and see that increase into a larger amount when we do get into a trend that continues to trend strongly. And as you can see, at least in here, it's not had a loss yet. And as long as we continue to trend strong up, we want to stay in Apple on a bull trade in here. I'm pulling up Amazon because these are in the current basket that I've been reporting for the last 3 years. We have back on April 6th, a secondary buy setup on here that is being shown as a strong buy in the expert advisor. And I'm just showing it's again, an individual on 4/6 at the end of the day had opened up and at the money, out of the money debit spread at 14 days. That trade as of the end of last week was up 529% on that without any type of add-ons, as we'll want to see how these do. Again, this is again just verifying the total return, $1,722 on a $325 risk per contract. Ideally, if you're trading with a smaller account, you want to be able to get in with a lower risk capital. Again, and ideally see these, if they do continue to trend, to produce a bigger gain on there. We haven't had all wins on this one. There has been a loss, but as you can see, the average gain actually total gains and the total losses on here would show you what that has done over time. I've gone to Google. Reasons for popping Google onto the basket over the last year was that Palantir, which had rotated on previous years being strong up, is no longer strong up. And Google is, and on the last session, I did a longer term analysis on Google and its seasonality, but I did want to plot up here from 4.9 on the next day after the buy setup on here with Will AD confirming that also is up over 500% on the risk on here, and will just pop up only $517 and has had a loss trade on there, but would be up right now on that, not only 524%, but a decent return on that trade. Just following the option process on buy or sell setups in top weighted stocks in strong trending markets again. This is NVIDIA. You can see that one triggered a buy here from the alerts on the 8th of April. And NVIDIA did have a decent dip before pulling up, so it's not quite up as much on that trade in here, but at least as you can see, we are seeing nice results on here. A $269 risk on that trade, which is a relatively small initial entry at $878 or 326% up. I will say this average percent return is every 14 days in this case. And if you're wondering why 14 days, I've tested 7 days to expiration all the way out to 90 days to expiration. And ideally on these trades, we're just looking to get in for the lowest cost possible with a statistical edge on the spread, and then play it out as long as the continue to get expansion, contraction trending. It's expanding. We're in a strong move up on this one, the QQQ. Although it is a little bit lower today, and these results will be down, as you can see, are up significantly, but the $870 original risk on this was a bit more expensive. Does show that the total return and return percent is a little bit lower than the other trades. But this is one of the reasons why we're looking to get in for a low risk price initially, and then stay in as long as these continue to trend. On this, I've had 3 rollovers on this one and just staying in. So again, I popped up the Teslas. I'm just running through the basket. 226% return on an 839 on these. Ideally, I'm really looking to try to keep these down to 1,000 or less on the premium in order to give the opportunity for the most amount of people to be able to afford that risk on that. So this was the last trade out there in the basket. But with that, I do want to just continue to pop up. What I've been showing are not only expansion, contraction, buy, sell setups taken the swing trades when for an uptrend, we come back to support, it's a buy. For a downtrend, and we come back up to resistance, then it is a sell setup there. And it's also including some divergent setups when they actually trigger. 2025, which is in the books. That's why I just closed it all out here. And we did have Palantir on there from last year, which has rotated into Google on that one. But you can see on here, we closed out trades, did well with the stocks. Those are not the option trades, but the buy and sell on the stocks. And also as a retail currency trader, what they did, the only loss on there on the last year was the Aussie dollar, which was down a bit. And 2025 results net were about half of what 2024's results were, but still a net year up. And that's just a part of tracking things over time. The last time there was a small negative year was back in 2015 on the currencies. Currently, 2026, the basket, as you can see, rotated out of Palantir as it stopped trending strongly last November. And by the beginning of January, was in a downtrend. Google still strong up. Google's seasonality play is coming into play right now, and Google is doing fairly well. So as you can see, this year, Apple is off a little bit, but floating a gain on the last position here, and the rest of the stocks are showing up some with some floating gains. And the currency is a bit more of a mixed basket, with the Japanese yen getting a bit wonky here recently, showing the euro yen and the USD yen are down on that. And that's okay. This basket has started out a bit slow. What was off a little bit last year was the Aussie is up the most this year and floating a bit of a gain. And that's what I do see over time, is that frequently something that's underperformed is likely to catch up. And the USD JPY, which has been overperforming with a high win rate, is okay to be in a bit of a drawdown right now. And as I was saying on the win rates in here, have just gone up over the last 3 running years. The Japanese yen with 46 wins and 9 losses. Many of these 9 losses are just coming up recently, as it was doing quite well and above the average win to loss ratio. And it's just pulling back some. So these are the nets over the last 3 years. So if I'm down a little in the currencies, it's no big deal. Over time, they're showing up significantly. And the same thing, Apple here, the trades with the expansion contraction show the wins to losses and the net up on that one as this test started out towards November of 2022 when we started popping out more of these webinars and everything. As you can see, top performer, NVIDIA on there. I did mark on here with Palantir, because that had been on the basket on there and it was still up, and that was really only on 20 months. So still appreciate not only Jake recommending Palantir at one point, but seeing it trending strongly. And now with Google this year, that is showing us with some positive results, especially on the options. And so hopefully what you're seeing is here in tracking trades over time, we've got a decent win to loss ratio, positive outcome. We've got net gains across the history of these, and ideally that's what we're seeing as a consistently profitable trading strategy over time. So again, as we're running through here with the expert advisor, the clearly defined setups following Jake's setup trigger follow through, which is this STF setup trigger follow through. We have a setup A, B, C, D are true, may trigger a trade today to get in, and I just kind of rewrote that as rules to get in, pick A, B, C, D, rules to get out of the loss, A, B, C, D, and rules for taking profit on there. And with options as well as stocks, I'm still a big fan of adding to a position in a strong trend, and you're up a lot if you're aggressive. Adding to a winning position on the next setup that triggers allows you to take a big winner and make it significantly bigger. That's what I showed on Google's trade last year that I missed, that had several add-ons and made it a multiple $1,000% gain on that. And ideally, we are back testing what's going on and forward tracking all of that. And want to keep emphasizing the liquid trending markets. Really do need to have high volume. I know I've got the 20-day average volume is greater than 5 million shares. I know Jake is something very similar to that. Ideally, we've got high volume all the time. And when we say trending, Jake's 5 above or 5 below is a great strong trending filter. Expansion, contraction, strong up or down, confirming helps us with identifying strong trends to get in, stay in, hold on. If you're in options, roll over on that. When there's a new setup that triggers, add to the winning trades. And ideally, when we're starting to do that, we can start to see some system tests and results and that show some positive outcome over time. So Jeff, if you're there in the background and are ready to kind of pop on and give your part about all of this, I'm pretty much gone through what I've got. And if Jake's got something to add in here too, that'd be great.
Yeah, I'm ready. I'm ready. Great job. I love how popular this has been and how really straightforward it is and how it's put together. I'm going to go ahead and take over the screen share, turn on my camera, talk a little bit about
just
this.
Let me say one thing. Let me say one thing before you start, Jeff. Okay.
Mm-hmm.
Brian, you did a great job as always. I want to say one word about artificial intelligence. Artificial intelligence, as you know, is threatening to take over everything, including trading. Don't be scared of it. Learn how to use it. It will help you immensely. It's helped me improve what I'm doing even more. Just learn how to use it and make sure you use it the right way by asking the right questions. If you ask garbage questions, you're going to get garbage answers. And thank you, Jeff, for giving us the opportunity to present our work. It's great, it's easy, it's simple, and it's objective. Thank you, Jeff.
You bet.
Hey,
Thank you.
sorry, Jake, and sorry, Jeff, for just jumping back in.
No
Jake,
problem.
on the current AI trend, which in social media is showing a fair amount of, hey, this guy programmed Claude to go do this, and he made X amount of money trying to take out lots of little things here or there. I know, like, my personal take on that is that these might be a little more flash in the pan, or works for now, may not work long time. Certainly brokers, I believe, are not going to allow individuals to really exploit the probabilities and allowing AI to work with that. But again, I think that they're a little more, they like the flash in the pan, the shiny object. They are here now. They may work temporarily, but I haven't seen anything be long-term yet. And as Jake was saying, AI can enhance the tradability of a current system on that one. But ideally, I really haven't seen AI pop up yet. And that may get there, but I haven't seen AI pop up and just replace what we're doing here. And I actually still would think it would be great if it does, but it's still in its infancy.
For sure.
Ryan.
All right. I appreciate both of you guys. Jake, what I liked about that is for somebody that's been trading for so long, you're still just working on how can I improve. I think that's so important.
We always want to improve what we're doing. Absolutely.
Never stop learning.
Very good. Yes. Well, okay. So I do want to talk a little bit about how to get this. It has been a super popular set of indicators and methodology system. So let me go ahead and kind of just talk it through it. When I introduced Brian and Jake, I talked a little bit about how I called it the Swiss Army knife of indicators. It does look at long-term trend and trend strength, short-term swing and swing strength, range, whether it's expanding, contracting. It'll give you support and resistance levels, so for bought over sold, divergences, and short-term breakouts. So there's a ton of stuff there. One of the things that I actually really like is the dashboard view that we came up with to kind of break this all down for you. Because at a glance, you can go in, you can look at it, you can see exactly what the recommendations are. And you can see right here, bullish, strong. What's the short-term trend? It's in an upswing, it's strong. What's the range? Do we have a breakout? What are our support and resistance levels? What is it over, bought, over, sold? It's all put together in such a way that you can see it. You can visually glance at it. You don't have to study through a whole bunch of text to understand it. The text actually does explain a lot if you want to scroll down and kind of read through it. That's important, but it's not important on a day-to-day basis while you're trying to make decisions about what you should do. So again, this has been a super popular indicator, a super popular methodology, and a lot of that has to do with kind of how well it's designed, and Jake and Brian, and how well they've put it together. Of course, with Metastock, you're going to be able to scan. Scanning, I think, is one of the things. Well, I don't think. I know that I've been using scanning, and I use it on a daily basis to find opportunities. And I love the ability to go through and just have Metastock take out the garbage, allow me to focus on the opportunities and ignore the stocks or whatever it might be that don't have the opportunities. So depending on what you want to scan for, whether it's like a bullish divergence or simply like a buy signal, or maybe you want to have a list of all the stocks in a long-term bullish trend, you'll be able to run the exploration. You'll be able to kind of get rid of the noise and focus on those opportunities that exist in there. I think it's one of the best things that we have. We do have a system tester as well. Kelly talked a lot about the system tester. You can kind of see how this works over a large degree or a large amount of instruments. And so there you go. That's what's all involved in there. We did sit down with Jake and Brian and me. We did an extensive boot camp when this was initially released. In the first part, Jake and Brian just talks about how to use a JBXC, how to implement it, how to use it. In the second part, I go in there and actually go, here's how you run a scan. Here's how you set up your test. Here's how you do all of the tools in Metastock and use them and utilize them. So that's available. It's available as soon as you purchase this. JBXC is normally $5.99. As part of the conference offer, we're going to do $4.99. We're going to do a money back guarantee on it so that you can try it. If you're happy with it, you're going to keep it. It's a very low risk, high reward offer. If you try it out, it's a one-time cost of $4.99, which is probably less than you spent on your last trade. If it works well for you, you can keep it. It will give you a money back guarantee on it. We will give you access to the training videos, all of that stuff that you need to get running. We'll even throw in a free trial to Metastock if you don't have Metastock. So you can, while you're evaluating this, evaluate the software that's been rated #1 in its price category for 30 years in a row. So to do this, you can go to metastock.com/JBXC. I just put the link in the chat right there. If you have questions, you can give us a call at 800-882. One of the chats. I'm looking for the other chat real quick. All right, here it is. You can give us a call at 800-882-3040. You go to metastock.com/sales chat if you have questions. Again, $4.99, money back guarantee. If you need it, you get a free trial to the Metastock program as well. So give it a go. Metastock.com/JBXC, 800-882-3040, or metastock.com/sales chat. And as much as I tried, I did not get it in both chat boxes. Let's go ahead and wait. This isn't exact. Okay. Sorry, Kelly got this a little bit messed up. Okay, there we go. First try. Thanks again, Jake, Brian. Appreciate you guys doing this. One of the most popular add-ons we've done for Metastock. Metastock.com/JBXC, 800-882-3040, or metastock.com/saleschat. All of those will get it for you. So before we go to our next presenter, and you are in for a real treat, I do want to invite you to join our online community. We do a lot of really cool stuff on the online community. If you go to thetradersforum.com, you can hang out with us for free, basically. We'll talk about the stocks that we're interested in. We'll talk about stocks that we like. We'll talk about how much we love Costco. We'll throw around some dad jokes from time to time. We do, on a very regular basis, have market guessing, like Jake Bernstein, or last week we had Brian and Jack and John Kosar. They did a really good session about kind of the markets and what they're seeing right now. We do sessions where we talk about indicators, how to use them. All that stuff is free. It's a free online community, a growing community. You can go to thetradersforum.com, sign up for a membership. I'd love to see you there. You should do it. It won't cost you anything, and you can come, and you'll potentially get a lot of knowledge if you hang out with us for a while. I've learned a lot there. So, all right. Any of the offers that we talk about, the extended trial, all of the stuff that we're going to be talking about today, you can actually get at metastock.com/conf promo. You go to metastock.com/saleschat. You can also give us a call at 800-882-3040. Our next guest, I just talked about him, is John and Jack Kosar. I like the way that they look at the market. I like how they evaluate, analyze their broad market strategies. They've actually had a huge impact on the way that I trade in some of the ways that they do their models and the stuff that they do. They were in here for a while. And well, I won't go into a lot of details, but they actually made me put together a list of country ETFs to look at when other countries were outperforming the US dollar. So John and Jack have had a huge impact. I love to hear what they have to say because it's always topical to what's going on in the market and what they're seeing with their models and with their 10 keys. So John and Jack, can you hear me?
I can hear you, and I'm just getting us online here. So
all right, I see
there
you.
We are.
All right. Let me go ahead and do this real quick. What I would like to do is I'm going to enlist your help, if you guys don't mind. As you might know, we do prizes. We give away prizes very, very regularly, and we're going to give one away. And what I will say is I'm kind of getting to the list of prizes. I thought I had it right here. Is in order to qualify for a prize, you need to register. So if you're watching on YouTube, there's a link that's pinned in the chat. If you click on that, it'll take you to metastock.com/ traders-conference. You can click on that, you can register, and you'll be part of the prize drawing. Johnny, you ready? Jack, you ready? Which one of you are going to pick out a number for me?
Okay. Any
All right,
particular range?
Yes, I'll give you a range. We're going to give the first prize we're going to give away is Buff Dormeyer's The Volume Factor. It's an
I know Buff.
Buff's awesome. Yeah, he's speaking this week.
Yeah,
so his Volume Factor newsletter is normally about $22. It's an ebook that we're going to basically provide. And what I need from either one of you is a number, and that number can be anywhere between 2, because there's a header row, and 4,359.
6.
All right, we're going to reward a early register, or that would be Stephen F. In the USA. Steve, I'm going to go ahead and send your information over to Buff and ask him to send you the ebook.
Buff's a smart guy. I'm sure whatever he's offering will be really interesting and very useful.
You know, it's interesting that you say that. I only invite smart guys and gals.
There you go.
All right. I can see you guys. I can hear you. I'm going to make you the presenter so we can see your screen too. It should ask you if you want to share your screen.
Yes. And
applications. Applications.
Okay. Jack's always got to do the technical stuff here.
Yeah. That's the advantage of having kids, right?
It sure is.
All right. I can see your screen. Thank you, Jack. I'm going to go ahead and get out of the way. It's your guys' turn.
Okay.
Take it away.
Okay. So we're back again. And what we're going to talk about today is, this really has to do with the evolution of me being in the business. This is my 43rd year, and I've kind of veered off the reservation a little bit in terms of being a pure technician. When I started, and back then, computers were not even on the trading floor at the CME, which is where I began my career in 1980. And, everything was by hand. I never ate when I was single. I never ate on my kitchen table because that's where all my charts were. And when the chart ran out of paper, I got some Scotch tape. And so back then it was all head and shoulders tops and bottoms and triangles and a lot of that. And then, 40 years later, once Jack came into the picture, we started doing a lot more quantitative stuff. We started to backtest our ideas. We started to backtest the indicators that I thought were the best indicators that I had found when I was on the trading floor. Sometimes what you think works really doesn't work quite as well as you think it does. So any kind of back testing that you can do, I know you could do it, with Metastock. That was a game changer for us. That was really a game changer for us. It kind of made the evolution between what I thought I knew and what I really knew. And then with that, we started to build models. So you can see I'm the trading floor guy for 17 years. I call it 17 years of college. Jack actually went to college. He went to Illinois Tech here on the south side of Chicago, one of the best technical schools in the country, and one of the best MSF, which is Master of Science. It's one of the top 5 MSF programs in the country. So he came out of there with all the academic tools that I didn't have. And I think putting us together, the sum of the parts is greater than the individuals. And that's really kind of helped us to take the next step, which is backtesting models that we've built using indicators that I have backtested, and we find out things about these indicators. You're going to hear us talk about maximum drawdown and beta and standard deviation, and we're going to talk about Sharpe ratios, all these wonky things that basically tell you if your model's any good. You know, I've heard for years, you know, people talking about a model they built that makes 40%. What they don't tell you is the drawdown is 60%. So there's all these nuances to find out what risk-adjusted returns are like. And risk-adjusted returns tell you if you've got something that makes a loud noise, but it really doesn't have anything inside of it, or something that's a sound idea that can make you money in the markets while also protecting you on the downside. These are just some of the spots in my very long career that I've been in. I guess when you've been doing this 40 years, you should have something like this. Moneyball approach to investing. Both of my kids, Jack and my son Brett, were very good high school and college baseball players. They played baseball since they were 6-year-olds. So we look at life through kind of like a baseball lens. And if you've ever seen the movie Moneyball, Brad Pitt played a guy named Billy Beane, who was the GM of the Oakland A's, which were a low budget team and couldn't afford to go out and buy all these players the way the Yankees could. So he hired a kid from Yale. He hired a statistician, an econ guy from Yale, who was able to take data on all of these baseball players that were coming up through the minors. How often do they get on base? Just all these nuances of the game. And he ended up finding all these players that nobody wanted because they were too fat, or they were too slow going down the first, or their muscles weren't big enough, or they weren't, you know, all of these kind of, you know, we call them the scratch and spit guys, you know, the old scouts. They would want guys that could run fast, that could throw the ball hard. They looked to see if they had pretty girlfriends to somehow judge their confidence. Well, this guy came in and looked and took all these people that nobody wanted, and he formed them into a team that just for a fraction of the money that the Yankees were spending, he was one of the best teams in the league. So that's the way that we kind of look at indicators. So we're looking at these indicators, and individually, they're all okay. They test out well. When you put them together as a team, that's when you start getting low drawdowns and outperformance versus the S&P. So we're kind of forming a Moneyball team with investing. These are the models that we built. So we're going to show you a little bit. You know, we're not going to give you the magic formula, of course, but we're going to kind of give you an idea of how we built our Moneyball team, and you might be able to do the same thing. In fact, I would encourage it. You have backtesting capabilities through Metastock. I would learn how to play it like a piano and find your best indicators, start putting them together, and see if you can build your own Moneyball team for investing and making money in the markets. This is how to find us. We have a Substack, by the way. It's free. .com. Sign up and you can get some of our stuff for free. We have a YouTube channel. What do we have? 4,600 subscribers. It's only been around for 2 years. A lot of free stuff there. A lot more details about what we do, which is different. What we're doing now is very, very different. We don't do any forecasting. Or if we do, it's very, very little. Forecasting to me is a euphemism for guessing. It'll get you on TV if you have a nice suit and hair on your head, but there's no need for me to forecast where the S&P is going to be at the end of the year. It's ridiculous. It's a parlor trick. It's better to have metrics that tell you what to do today or what to do this week than, again, a show business trick on, you know, where the market's going to be in September. Nobody knows. Glossary of terms. Jack's kind of the quantitative guy here, so I'll let him walk you through. These are the things we're going to use today in the presentation.
Yeah, so first one being max drawdown. So this is, you know, over a set period of time, what the kind of peak to trough is on a return chart. So as high as it gets versus as low as it gets. So that's the max drawdown. We indicate this is kind of a version of risk, you know, a maximum amount that you're risking on your particular portfolio. Standard deviation, the way I talk to our clients about it that may not be financially savvy is, how they're it's a roller coaster versus someone that's kind of driving over some low hills. The bigger the swings in the roller coaster, the bigger the swings you have in your daily returns of your portfolio versus, a nice light hills. You're not feeling it as much. You're not going to see that kind of movement. Lower standard deviation kind of suggests lower risk, because you're not your portfolio is not jerking around as much as you would expect. Beta is a measurement of volatility and kind of how your stock or your portfolio is going to react to the broader market. So a low beta item is going to be a lot more stable in terms of its movements relative to the S&P 500 versus, a high beta item like a crypto or a technology sector stock, which is going to have, when the market is up, theoretically is going to have a much larger move up on that particular day. Risk-adjusted returns, this is one of our most important things that we like to talk about, which includes Sharpe ratios. And it's basically understanding of how you're getting returns versus what you're risking. We kind of mentioned earlier that, some of these other guys offering, portfolios or indicators have these giant return numbers. But very often, if you look at it as a per risk unit, you're really not making that much money because you're setting yourself out for kind of outsized losses as well as outsized returns. So, we like to use the Sharpe ratio, which is basically your excess return over your standard deviation, really getting an understanding of what's your risk per unit, what's your return per unit of risk. And then annualized return, just the average yearly growth of an investment over a specific period of time. Just kind of a way to break down the numbers and let you know on a year-to-year basis how you do.
And by the way, we have no connection to them, but Investopedia.com, if you haven't discovered them, they are a wealth of knowledge. It's kind of an online glossary. There's videos. So if you're interested in any of this stuff, and I'm sure there's others out there, but that's one that I've used for years if I want to get a better understanding of something that I'm not familiar with. Our Asbury 6 is an indicator rather than a model. I built it because it used to be back in the day, if you looked at this is all we had back in the day. You could look at the S&P 500 chart, maybe look at volume, maybe look at some overbought, oversold indicator, and have a pretty good daily idea of what the condition of the market is right now. That's gone. Those days are gone. There's no open outcry anymore. Everything's faster. So what I found myself doing is being in the business for 25 years and getting faked out of my socks, let's say, with being bullish the market. The market's down 100. The next day it's down 60. The day after that, I get spooked out of a really good idea. And 3 days later, I'm buying new highs. So the Asbury 6 is keeping us, instead of chasing the tail of the S&P 500, we are looking at 6 different indicators that when you put them together, again, there's the Moneyball kind of concept. When you put them together, they give you a very good 6-sided view of what the market is. So this goes back to April of 24. So you can see if the market's noisy, the Asbury 6 is noisy, but it does a pretty good job of picking out the bottoms. We had April here of 2025. That was just off the bottom. I think this was maybe 2 weeks or so off the bottom. Here's April 6th of this year. We caught this nice move. So it's been a relative performer versus the S&P 500 since the Q4 of 2017, but with 2/3 smaller drawdown, 13.6 drawdown maximum versus 33.9 for the S&P, which was during COVID. We're going to look at 3 of these, but we have the rate of change in the S&P, which is the only one, by the way, that's directly related to the S&P. We have the relative performance of equity prices versus high yield bond prices, investor asset flows, volatility, trading volume, and market breadth, right? It's pretty diverse, but it's like, I always use the metaphor, if you go into an art museum and there's a piece of art in the center of a room, like an exhibition hall, if you want to really see what that piece of art looks like, you walk around it and you see what it looks like from various angles so you can understand it better. That's what the Asbury 6 does for the market. That's what it looks like in our research. The premium research subscription at asburyresearch.com is where this is housed. 4 or more green constituents are a positive read for the model. 4 or more red are a negative read for the model. It's been 3 and 3 for 3 days. The past 3 days, Wednesday, Thursday, and Friday of last week, 3 and 3. That means we still retain that April 6th shift over to positive that I showed you here. But now we're in balance. So nobody knows what's going to happen tomorrow. And anyone that tells you is lying to you. But what we do know is at 3 and 3, the Asbury 6 either has to get back to 4 or more green and stay there, or the model itself is rolling over, which means we'd have a near-term peak. Right now, I'm looking at the screens here in our office. The S&P is down 44. Chances are, and again, I can't tell you what the close is going to be, but if we go to 4 or more red here, that means that this chart is going to have a red arrow wrong way. It's going to have a red arrow up here suggesting that there's some kind of a peak here. So this is an inflection point for us. Here's the 3 that are negative. First one, rate of change in the S&P 500, monthly or 21-day rate of change. Note that it turned negative on May the 12th. So that is 1. You see here, it turned positive on April 6th, gave us all of that. It's turning negative now, which means that the rate of ascent here has slowed down to the point where the rate of change is turning downward. The second one is volume. Now, we use cumulative volume. It's a little less bumpy than looking at the raw volume. But again, April 2nd to May 12th, it was green. It was going up. Monthly rise above its 21-day moving average. That changed on May the 13th, which was last week, which means that is also negative. In other words, the market's still going higher, but the cumulative volume is starting to deteriorate. It's a bearish divergence of sorts. The third negative one right now is market breadth. We just used the nice CAD line, and you can see from April 2 to May 8, positive. Market went up. As of May the 12th, it's rolling over, even though the market is still, the S&P is still going higher. That means that it's going higher on fewer constituents to drive the prices up. So these 3 are negative. Again, we're going to see what happens, but it looks like this metric may be rolling over. Do you want to do CPM, or would you like me to take it?
Yeah. So our correction protection model is, similarly built in the sense that it is a collection of indicators underneath the hood. We kind of have a theme here on. A lot of times we see people trying to sell their one best indicator. Even a really good indicator that is good 80% of the time is wrong 20% of the time, and that means that can mean for some down trading or from missed signals. So we like to combine indicators to kind of normalize some of that missed percentages, so that we know that if we have a handful of indicators that we like and they're all pointed in the right direction, that we have a pretty good idea of where the market is headed. That's kind of the idea here. On top of CPM is a little bit of portfolio management tools that create a risk on, risk off portfolio. When we're risk on, we're in the S&P 500, and then when we're risk off, we're in cash or a cash equivalent like a BIL, which is it's like the 16-week interest rate for T-bills. So what this does is it creates a dynamic stock bond portfolio instead of having your traditional 60-40 always in bonds, always in stocks. We let the CPM model tell us when it's time to be in equities versus telling us when it's time to be in fixed income or in cash. This model has about 5 round turns a year, which is a buy and a sell, so about 10 trades a year. It does not trade on the calendar. It trades on the underlying indicators and the underlying data. So there are years where we have significantly less trades, and then years where we have more. No short positions or derivatives. And really what this uses is it's time for, again, when to be in equities versus when to be in fixed income. CPM has better risk-adjusted returns than the S&P 500 according to Sharpe ratio and Sortino ratio, meaning that we're able to give you the market with less risk. And then our traders use this as an indication for do they have the wind at their back for any kind of trades that they're making versus, if it's risk off, it might be a little bit more hesitant to put on something, put on a deal or a trade. And then the CPM model becomes an alpha generating model when we add leverage. We don't always encourage the use of leverage, but with the idea that the correction protection model has your back in terms of getting out of the way of market corrections or attempting to do so, you can put on some leverage to get a little bit of juice on your upward momentum, and then get out of the way into fixed income when the model goes risk off. Why is it important? Drawdowns are important. So this is one of our favorite charts to understand, and it's the idea of once a model or a particular stock draws down, what you have to make on the way back up in order to just break even. So, the S&P 500 has a max drawdown in the last 8 years of 33.9%. Our CPM model is at 20.2 through our hypothetical backtest. But what that means is that a 33% return, you need the market to then reverse an extra, call it 45, 48% on the way back up just to break even. And the larger drawdowns that you take, the more you need that particular stock or the market itself to gain. A 70% drawdown is going to require a 233% increase just to break even. So, we deal with a lot of older investors, a lot of investors that are looking to protect their lead and their capital. And these drawdowns are important. A little bit less so for my demographic. I'm a lot more dollar cost averaging and can ride through some of these drawdowns. But when you're investing as an older individual, drawdowns matter because you got to protect your capital. You never know how long it might take to get that 67 and 100% return back just to break even when you've kind of worked your entire life accumulating said capital. And what the CPM does well. So the CPM's max drawdown over the last 8 years is 20.2% for our hypothetical backtest, but on average, it's under the market. In some cases significantly. 2020 was COVID at that 33.9%. The CPM model only drew down 9% that year. So really does a great job of protecting your capital, and honestly does a better job during times where there is a larger market correction. 2025, we had that 18.9% max drawdown. That was Liberation Day, when many people were liberated from their money. In that case, CPM model did about half. So keeping that drawdown low on a year-to-year basis is what the CPM model does. Obviously, in years where there's less of a correction in the market, there's less of a correction for CPM to avoid, but does a relatively good job of getting out of the way of some of these larger corrections that we have. And with the market being on such a tear over the last 3 to 4 years, being a mean reverting animal, we're not predicting the next correction, but there is one that is due, and the CPM model does a really good job of keeping the onsides during those corrections. Yeah, just again how it's done. On the top chart here, we just have returns going back to our inception, and as you can see here, the CPM model sticks to the S&P 500 like glue, but doing so with less risk. 13.03% average yearly return for the CPM model going back to our inception. Trailing a little bit on the 3 to 5 year, and then actually outperforming so far this year. Due to the fact that we've had a little bit of market correction around the war in Iran and the energy shock. So again, when the market is going straight up, the CPM model does a really good job of sticking with that market. And when there are market corrections, that's when we can kind of get out of the way and again give you S&P 500 like returns with a much lower risk profile. And this is the most important page for us. On top, we got standard deviation. The CPM significantly lower standard deviation. Meaning when you're looking at your portfolio, looking at your trading, a lot less movement on the day-to-day, much lower beta. What's important is the Sharpe ratio. 0.85 is pretty good. Anything near 1 is a good Sharpe ratio. And obviously this year the model's done significantly better with 2.65 Sharpe. Versus 1.3 for the broader market. And then lastly, but not are probably the most important is that max drawdown number, 20.2% for CPM, 33.9% for the S&P 500. Again, S&P 500 like performance with much lower risk with this approach to investing.
So how do you do this? So how do you, each indicator, think of indicators like the ones that you get through Metastock. They're like tools in a tool case for a home builder, right? Each one has, you can't use a hammer to build a house. You got to use a hammer and a screwdriver and a saw and a million other things. Each one does a job. So if you're trying to build a model for yourself and you want the model to be more sensitive to drawdowns, you might use something like the VIX. It shows you when the market's afraid. If you want something to pump up your model and give you more juice, as we call it here, there may be another indicator to do that. It may be asset flows. So understanding your indicators, understanding how well they work, and you do that with backtesting, and then you start to assemble them as you might assemble a baseball team. That's kind of, that's really what we do. Just one little anecdote. We talk to a lot of people that contact us. We do managed accounts. We offer managed accounts through our model portfolios, and we also sell research. So these are people we've never met before. So it's usually, why did you contact us? What are you doing now? And if you could, what would you make better? And I've heard so many different times, older guys like me say, I was buy and hold for most of my life and it didn't bother me. But now I'm 60 or now I'm 67 years old or whatever it might be, and I can't sleep at night. I'm afraid I'm going to give back my big lead at the end of my investment life. It's like nobody takes chances. No good football team takes a lot of chances in the fourth quarter when they have a lead. Old people feel the same way. I don't want a 33% or 35% drawdown when I'm 70, because what if it takes 5 or 6 years for the market to get back to where I was and I'm on the ground? So that's why we put such a emphasis on how important it is to reduce your drawdowns. Unlike bonds, unlike commodities, unlike foreign exchange, the stock market has inherently been going up for 100 years. We take advantage of that by really trying to control our drawdowns. So I'll turn you this on. Let's see.
Yeah, so this is our SEAF model, our sector ETF asset flow model. It's a sector rotation model. What we're doing here is we're tracking the velocity of money through 3 time periods to let us know where investors are kind of voting with their feet. There's a lot of, intraday volumes and 0-day options and all kind of craziness throughout which has really, I believe, sped up sector rotation in terms of how money is flowing around the market. It's a lot more frictionless in terms of being able to move your capital. So we want to track how investors are voting with their feet and kind of keeping their money, and how that it's accumulating over 3 time periods. So this table is, kind of gone like a golf scorecard. The lower the score, the better here. So in this case right now, technology is our lowest score. It's actually the lowest score possible, with trading at 1, tactical and strategic also at 1. So that's as low of a score you can get, meaning that the most assets are flowing into technology through 3 time periods. From there we have materials and staples. This traded as a model, you always take the top 3. In terms of, equally invested in the top 3. So a hypothetical $100,000 account would have this 33% in technology, 33 in materials, and 33 in staples. We have a handful of traders that like to trade individual stocks or individual ETFs, and they use this table kind of as a filtering board in terms of what they're looking at. So they might say, okay, well, I'm going to change my filters on my stock screener to bring in technology and materials and consumer staples, because I know that through 3 time periods they got money coming in at the back, which means I got a little bit of whirlwind for the ideas that I like. On the flip end, money flowing out of these particular sectors, this might be time where if you look at your portfolio, you have some financials or healthcare, you either close a position out for a tax loss harvest, or you take some profits on a longer term idea, because money is now flowing out of those particular sectors, meaning that at some point there's a loss of confidence from investors on keeping their money in those rotations. These are our rainbow charts. So these are our visual representation of the day-to-day scores of CEF. So how CEF would score on a day-to-day basis. Up top here, we have our CEF scores, whether they land in favored, neutral, or avoid, versus on the bottom here, it's its relative performance versus the S&P 500. In general, it is a company-wide policy that we want to be invested in things that are outperforming the market. Otherwise, why not be in the market itself? So in this case, the CEF model got into energy in January 13th, pretty early, as we kind of crossed over from neutral to avoid. There's some really key points when you're looking at these rainbow charts as they start to kind of blend between avoid, neutral, and favored, and get the momentum to get into the next each tier, where you really start to see some aggressive relative, oftentimes see aggressive relative outperformance. We were in this idea through March 30th for a outperformance of about 40% on the S&P 500 during this time. So energy really kind of took care of us. But as you can see here, the minute it stopped, we jumped into a void, and then we were out of that idea. So we like to be in these ideas, not on a forecastable type timeline where I'm going to tell you that energy is going to be really good for the next 6 months. We are strictly following the money, and when the money leaves, so do we. And the CEF model transitions into something else.
So you see right here, another similar favored period may be emerging now, because now we're back up in the green. We're back in favored right here. Do we know what's going to happen next week or next month or next year? No, but we don't have to. People get hung up on having to make this forecast. The forecast becomes more, it feels like, to me, oftentimes the forecast itself becomes more important than making money in the market. I'm here to make money. I don't get paid anymore to forecast something that's going to happen between now and Labor Day. All I do is follow where the money's going. It simplifies my life. I sleep better at night. Here's another one, Jack. Maybe you want to.
Yeah. So kind of if you look at the way these kind of line up, one ends and another begins, and that's kind of how we see a lot of this rotation going on. Is there's a fixed amount of assets that are going around these 11 sector spiders, and as we often see trends where as money is leaving one sector, it seems to be entering into the next. Why this is, it's a couple of different reasons. I know a lot of investors cannot go to cash, so they need to be invested in the market. It's kind of their investment mandate. Plus, it's kind of market behavior. What's the next good thing? Where's the next good idea? In this case, money went from energy into technology around the same time that we had a quote unquote ceasefire, and things got a little bit more dicey over in terms of Europe in terms of energy costs, and money flew into something what looked to be safe, and that was into technology, oftentimes driven by what's going on in AI, as we're starting to see some returns on investment on some of that CapEx expenditure. So what happened here on April 10th, we got into technology, and we were outperforming the market by 12%. Now, the key thing to note here is the S&P 500 was also up 9% during that time. So not only were we in the right sector, but we were able to outperform what was otherwise a pretty strong market just by following the money. In this case, the money told us to go into technology. And then, we always like to show the flip case. This is really more for our traders. On the other side of this is when money starts to leave the sector. We head in from favored into that neutral down into the avoid. The avoid means that money is really strongly flowing out of this particular sector, in which case on April 7th, we've transitioned into that avoid territory, and through that time period underperformed the S&P 500 by 11%. So money was flowing out. Now, the confusion we get a couple of times is, we could still see slight price appreciation in that particular sector. This doesn't mean that price is going to go down per se, but it does oftentimes mean when we're in that avoid sector that this particular sector is going to underperform other sectors, specifically the ones that are toward the top of our CEF ranking.
Here's another cool one. May of last year through let's call it middle of July, latter part of July, got down into a void status in CEF and stayed there. It's kind of like a ping pong ball, bing, bing, but it stayed in there. Look at this steady relative underperformance by XLV. So do I know why it underperformed? Do I know exactly why? No, I get paid the same by the market. I don't have to know the reason. I don't get bonus points from the market if I know why. I know the money is leaving there to go somewhere else, and that's good enough for me. And that's really, so all we're doing is we're not trying to be Nostradamus and know every innermost thing about the market. It's impossible. It's not able to be known because it changes too fast. We need to know where the money's going and how fast, and that's what this does. Performance.
Yeah, consistently, throughout the years. Again, this is being a sector rotation model. This thing, what it does well is it does well with staying on top of the market. Of the last 8 years, it has been able to pick up the sector that was most relatively outperformed the most, was kind of where we got most of our money. So we more or less picked the top sector each time, outperforming on a inception basis by about 8%. And again, consistently doing so well over the 5 years, another 8 or 9%. Through 3 straight years of very up markets, I can tell you that having the market up that much during that time frame is abnormal. I think the S&P 500 normally has about a return of closer to 12%. So being able to outperform during that time frame is really been good for the CEF model. Again, just following the numbers, and then this year being able to outperform the market by we'll call that 7%. And again, just doing so through being in energy, but again, as soon as energy left, into technology and kind of being able to ride those waves of asset flows. Quick performance metrics here. Outperformed the on a max drawdown wise, you got 33.9% for the S&P 500, 29% max drawdown for the CEF model. So you're similar risk profile. So if you're comfortable with the S&P 500 risk profile, you can do that with CEF while also over time outperforming. Again, Sharpe ratio, anything over 1 is my understanding pretty spectacular. And through an 8-year hypothetical backtest look back, we've been up over 1%, meaning that per the unit of risk that we're taking, we're doing quite well in terms of picking up that extra bit of return. And also, again, doing so with a similar standard deviation, meaning, again, if you're comfortable with the S&P 500 and how it machinates throughout day to day, this is a model that you're comfortable with. And again, over time can outperform. Now, we don't know what's going to happen in the future, so we can only look back to see what our model has done in the past. But historically, done quite a good job of producing some relative outperformance when there is sectors that are outperforming, and otherwise keeping it tight to the market.
Again, underscoring, we don't have to make a forecast here. All we have to know is what's the market doing now. People get really kind of thrown off. You have to predict. If you're good at this, quote unquote, you have to predict. You always hear people, I call the top in 1987, or I call that was 30 years ago. That's great. Are you making any money today? You don't get any kind of residuals like if I made a hit song 30 years ago and I'm still getting, or like if I was in MASH or something, if I was in that series and I'm still getting the residuals 30 years later. The markets, what have you done for me lately? So I've had to learn to resign myself that I'm not smart enough to know where the top is and where the bottom is. I just want to know what's the market doing today, and is it an investable situation? It's made my life a lot simpler, and I've made a lot more money with that. This is a sort report. Jack actually designed this to be a quantitative sifter, to be able to look at a lot of different assets all at once. And we look at U.S. technology, crude oil, emerging markets, commodities, small cap, global equities, ex-U.S., crypto. I've never traded crypto in my life, and I never will, but we know a lot of people do. Gold, U.S. dollar, and U.S. interest rates. It's a big basket of a lot of different things that you can invest in. and we quantitatively look at them daily in the morning based on the previous day's close. So right now, US tech, crude oil, and emerging markets are all clicking on all cylinders, so to speak. Their trends are positive. Their relative performance versus their benchmark versus their parent is up. It's positive. And you have AUM, assets under management, are flowing into that ETF. So if you're a trader and you get up in the morning and say, all right, what do I want to invest in today? Well, this is a pretty quick and dirty, mathematically driven way to be able to see what is working. So now you could look at US technology. You could look at umpteen different ETFs. OIH is breaking out today from like a trend line that goes back 10 years. Emerging markets. It gives you places to start that already have the quantitative chops to be worth investing in. So this is still some of the traditional technical analysis that we still look at every day. This is the S&P 500. 7440 was our target as of April 15th. Why is that? Is because of the decline from January 28th to March 30th. If you take a Fibonacci projection, and that's part of your package in Metastock, and project outward, it told me that 7440 was the mathematical way to determine where your next stopping point or your next target may be, or how much higher this move goes, however you want to explain it. So what I've noticed after doing this for a while is when you're at all-time highs and there's no tangible resistance level anymore because you're making new all-time highs, these numbers work really well. So we've got the A6, the Asbury 6 is 3 and 3, right? So we know that we either have to get off the dime and make fresh highs here this week, or we're probably at a peak. Well, it's 3 and 3, and the market's down 45. S&P's down 45 as I look at our screens, and we know that we've got this target met. That tells me something. That tells me that this could be a place where the market starts a correction. Not until the A6 goes to 4 red, and not until the CPM tells me risk off, but at least I have something to go on without guessing. This is a weekly S&P 500 chart. There's a 7440 target met. 7002 is the high that we made back in January the 28th. Look at the last high, February 2025 was at 6147. We came really close to it, and the 52-week moving average, that was a bottom. Here's another one. January of 2022 was a big peak. The market went right to it on April 7th of 2025, and then it took off again. So this is just basic blocking and tackling. We know that a 7440 is going to be a peak. The next big support level that we want to look at is around 70,000 through about 6650, let's call it. And this 52-week moving average is going to continue moving higher. So I like to look at the big picture so I can say, what if? What if 7440 is a peak? Then we've got an idea of where it may go to. This is just overbought, oversold. I think this is a quarterly relative strength index. Up above 58%. Has given us some big tops and not so big tops in the S&P going back to 2020. So is this a sell signal? Absolutely not. You can go broke by trying to sell overbought conditions. You go broke very quickly trying to sell overbought in a bull market. But this does give me environmentally an idea of where we're at, and we're overextended. This is the Dow weekly. 50,000 is a big fat number that the Dow's been trying to break since the middle of February. He hasn't been able to do it yet. The Dow is at 49,427 right now. So another reason to say, hey, if the market was going to take a rest, it may want to take a rest at 50K. I would not sell independently either of these based on these metrics, but they are environmental ones that let me know that we might be at some kind of a turning point. Size and style. The S&P 500 has been outperforming since April the 14th. So large cap is outperforming since the middle of April. This is growth. Style is growth or value. Growth has been outperforming since April the 8th. It's outperformed SPY-V, which is value, by 5% since April the 9th. So if you're looking at the market and saying, what should I buy on a size and style standpoint, large cap and growth are where your outperformance has been. This is bonds. I just want to take a few minutes to talk about bonds. Bonds were really strong last week. The 10-year blew through its old high that it made at the end of March and now is closing in on the next level. 46.29 is effectively a 463 yield in the yield of the 10-year. This is a 10-year. This is a 10-year. It's the CBOE's 10-year Treasury Note Index, which is a blend of different maturities on the 10-year note. So pretty important breakout. Even bigger is on the 10-year. This is the 30. This is the CBOE index for the 30-year. We blew through on late last week 50.66, which is about a 507 yield. That was the peak that we made back in July of 2009. We made a slightly higher peak in October of 2023 at 51.22, or about a 512 yield. If we get above a 512 on a yield of the 30, these are new 15, 16-year highs, 17-year highs in yield. It's a big deal. When the bond market breaks these big levels, it tends to follow through. What does this mean? It means long-term interest rates are going higher, which usually happens when the market sees inflation ahead, some kind of a bumpy ride ahead where they have to handicap those yields. This means if you're looking to buy a house, if you buy it next year, there's a really good chance it might be more expensive than to buy it right now. Again, 15, 16, 17-year highs. This is not linearly correlated to the S&P 500, but if you're making new 17-year highs in long-term yields, the bond market is telling you something, and that's what we're seeing right here. These are our ETF trade ideas. We put these together. We've got about 3 years of data here. I'm going to jump a slide. So 3 years of data, we've had about 127 trades, well, exactly 127 trades. This is from 3/17 of 23 through the end of March of this year, about 4 trades a month. Maximum drawdown, a minuscule 3.7%. Sharp ratio through a 3-year series of trading umpteen different ETFs to have a 1.3 Sharp ratio. It's pretty good. 53% of these are winners. Our average winning trade is 5.6%. We're in it for about 20 trading days. Our average losing trade is less than half that at 2.6%. We're in it for about 8 trading days, or about a week and a half on the calendar. These are building blocks. If you're trying to build a stock picking system, that's going to make money. You need enough data so you can get a reasonably good idea on how well your system's working. And this is a combination of trend, relative performance, and asset flows. Very similar to what we do. We think those are the 3 legs of a profitable trading system stool. So you have to have more winners than losers, and your winners need to be bigger than your losers. If you can do that steadily, you're going to have a winning system. OEF is one of these 5 open ideas that we have going right now. You can see we bought it on April the 28th. OEF has gone up by 5%, and it's outperformed the S&P by about 1% since then. That's what we're looking for. We're looking for overall profitability, and we want to be able to outperform whatever the bogey is. Most of the time, it's going to be the S&P 500. So that's another part of our service. I think the takeaway for you as a viewer is when you're building a system, you got to know if it works, because your mind can tell you something's working and your P&L can be going, it's not working. So more winners than losers, low maximum drawdown so you don't get taken out of the game. higher, again, more winners than losers, and your winners should be significantly larger than your losers. If you can consistently do that over time, you're going to make money in the markets. These are our model portfolios, and Jack and I built these together, but Jack's was quantitatively the guy that really made sure that these work in real time. Back tested 8 years. If you're interested, contact us privately and we can show them to you, or we could do a Zoom meeting to look at suitability because we're a fiduciary. But they've been trading in real time now for almost 2 years by both individual investors and also by RIAs that are managing money for other people.
Yeah. So, the key here is, we want different flavors for different folks. Asbury Aggressive is going to use a little bit of leverage. They're all combinations of our flagship models, our CPM and our CEF model. And it's just bringing it to what you're trying to do with your portfolio. Again, aggressive being all of our stuff, is a little bit of a misnomer. All of our defensive metrics are all less than the S&P 500 with all of our model portfolios. But in terms of how much aggression you're willing to take, ultra conservative, has never historically had a drawdown of greater than 10%. That's really kind of a risk averse person's version of investing. You're a couple of percentage points under the S&P 500 every year, but you never really have any threat to your principal, or at least historically hasn't been so. With the idea on the aggressive flip side of the aggressive is trying to be able to outperform the market on a relatively consistent basis, but doing so still with slightly better risk-adjusted numbers than the S&P 500. And then just proof of concept, this is what we've done. Asbury Aggressive is in green, Asbury Balanced in blue. We put in the S&P 500 there, so being in our models has consistently allowed for people to outperform.
That's an orange.
Historically, and then on the purple on the bottom, that is your traditional AOR, that's 60-40 stock bond portfolio. So by following the money, by using indicators, by coming up with these systems that have picked kind of the best parts of all of your disparate indicators and putting them into a system, we've shown that historically you can consistently beat the market, with these strategies.
So what we do, real quick, we have investment research. That's what we started. That's what I started the business with in 2005. We've got premium subscriptions, 3 and 12-month subscriptions. The 3-month subscription is $499. It's expensive. It includes all of our models. It includes 1 30-minute one-on-one Zoom with us to get you up and running quickly. And we have monthly group webinars called Teach-Ins, first Saturday of every month. They're 90 minutes long. So we give you a lot of support in learning how to integrate these ideas and these models into what you're doing now. We've got a Substack, $25 a month or $250, I think it is, for a year. And we've got a free we have a free version of Substack. AsburyResearch.substack.com. It's a no-brainer to get the free one. I encourage you to sign up if you like our approach to markets. And then money management. We have 4 different model portfolios that we've built. It's available. Custodian is Charles Schwab, $250,000 minimum investment. We charge a 1% annual management fee up to $1 million under management. Then there are multiple breakdowns for accounts in excess of $1 million. And we've got about 3 minutes left. There's the lawyers. There's contact us if you want a copy of the PDF. That's how you do it. And let's see if we can get back to Jeff here. I'll let Jack take the wheel so I don't.
Yeah, I'm right here still. I was trying to get your AsburyResearch.substack.com. I was trying to put that in the chat, but it doesn't look like I have it spelled wrong, but it doesn't seem to be going anywhere either.
That's the right address. Asbury, ASBURY, research.substack.com.
Okay. I guess the difference is you can't use the www. It does work that way, though.
Really?
So yeah.
You know what? I don't go there very often since since we're the ones that write the research. So I can't give instructions on how to make it work.
We did have a question from Juan. Juan wanted to know if the research you do is applicable to the entire U.S. market or just the S&P 500.
The our universe, I guess, is SPY or Bill, right? For our risk on and risk off models, it's SPY or Bill. All of the 11 sector spiders, and then for our ETF trade ideas, which is the one that we went back 3 years and we showed you the the winners 2 times larger than the losers. That's the universe of ETFs that we track, which is about 6,600. So that's where the breadth comes in and the individual ETF picks. But our models, we keep it simple. We don't buy any individual stocks. We're buying ETFs because they're a little less risky. There's typically 20 or 25 assets involved in an ETF. Keeps volatility down a little bit. It helps us to control our risk better.
Right on. Okay, that was the questions. Thank you very much. I've got the Asbury Research link up to for the Substack in the chat, and you can also go to asburyresearch.com. Thank you very much, John and Jack.
Thanks, Jeff.
It's good to see you, Jeff. See you soon.
Yeah. It's been twice in a week.
Yes. Yeah. We're like, I'm going to be moving into your house next week.
I'll see you there. Yeah, I've got an extra room. We'll talk about rent.
All right. I'll see you later.
All right. See you. Cool. As we move on to the next presenter, I do want to say thank you to the guys at Stocks and Commodities that have been working with us for a number of years. I think like 14 years ago, I gave them a call and I was like, hey, I'm going to do this big online summit. Nobody was really doing anything like that at the time. They've supported us ever since. You can find out about Stocks and Commodities magazine if you go to traders.com. They've got 17,000 articles, 1.3 million subscribers. They've been publishing since 1982. Great magazine. We really appreciate the support over the years. And I said it earlier. I'm going to kind of say it. I'm going to reiterate my statement from before. I think in life you're either getting better or you're getting it worse. And I think that that's applicable to any skill that you have, whether you're a musician, an artist, a trader, whatever it might be. The thing I like about Stocks and Commodities is it sends you in the mail every month an article or a magazine full of articles that talk about different ways you can look at the market. And I believe the subscriptions are around $90 a year. Check it out, www.traders.com. So without further ado, I do want to also talk about Metastock. We've been talking quite extensively about Metastock. John and Jack have been using Metastock for a number of years. It's been rated the best software in its price category, and it's only won that for 32 years in a row. So we've talked about scanning, testing, trading ideas. We're going to be talking more about the forecaster tomorrow in Scott's session. We talked about real-time alerts, commentaries, all that software that's been rated so highly for the last 32 years in a row. Starts at $75 a month. That includes the data that we get from the London Stock Exchange Group, includes Reuters news with our real-time packages. Very, very cool. If you buy a month, we'll give you the second and third month for free. You can do that at metastock.com/conf-promo. If you want to get some more information, find out a little bit more about the package, it's huge. Give us a call, 800-882-3040. That'll work here in the US and it'll work in Canada. And you can always chat online with us at metastock.com/saleschat. So $75 will get you 3 months right now. That's basically $25 a month. That'll run until the end of summer, like August 18th. The end of summer is only 3 months away. So metastock.com/conf-promo, metastock.com/saleschat, or 800-882-3040. Give it a go. There has been a reason that it's been rated so highly for 32 years in a row. There's reasons that we've had such a good group of customers that have been using us for decades. Give it a go. All right. That's what I've got to say about that. AJ is our next guest is AJ Brown. AJ is right here, featuring a beard that I am highly jealous of. Look at that. AJ, what are you talking about today?
I'm going to be talking about hedging our whole portfolio with a VIX trade that I want to share.
Okay. AJ and I go way back. We both have some roots. I wouldn't say my roots are from the San Jose area, but I would say yours are, right?
Yeah, I definitely love that Bay Area, the Monterey Bay Area of California. Dreamy.
Yeah, definitely. So let's see. AJ really is a great options trader. He is a trapeze artist. And he's going to talk to us a little bit about the VIX strategies.
Yes.
So without further ado, let's get you going. And I'm going to try and use the word to do more today. Let me go ahead and make you the presenter.
Thank you. All right. There we go.
I don't think you shaved that beard since I saw you last time.
No, in February. No, and I probably should because I'm back on the East Coast. We're outside of Washington, D.C., and today it's 92.5 degrees with a lot of humidity, and this beard isn't feeling good outside. So maybe I should. I'm about 6 months off. I should have been doing this in the fall ahead of winter.
Yeah. Well, that's fine. You look great. I'm going to get out of the way. Your turn. Take us away.
All right. So, folks, I know a lot of traders who have heard me speak have been sending me things in the messages. The market is really, it's been difficult for the last couple of months, if not more than a couple of months. There's been a change from finding a lot of technical entries, right, where support and resistance is a given, right, where people have seen it tested multiple times, and that's what they're making their trading decisions to a lot of people watching the talking heads on TV, in the mainstream media, in the business, in the stock trading media, or following the latest social media posts, right, by the powers that be, by the folks that are playing. And it almost seems like, a lose-lose game. In fact, some of the messages that have been coming to me, I just want to share some of these. By the way, my presentation is not as much slides. I'll be showing you a lot of different things in the actual charts and stuff like that, but I have a couple of slides here. These are things that people keep telling me, and I'm not going to repeat all of them, but I just want to, you might resonate, and because people are taking this personally. They're saying, hey, listen, I'm not making any success. I don't have a real strategy. I keep Frankensteining ideas from presenters and hoping they add up to an edge. Or how about this one? I keep breaking my rules, or I never really had rules to begin with. Some people will say, I don't know how to pick candidates. I'm basically guessing. I size too big when I'm desperate to make back losses, and I size too small when I need to commit. What else have I heard? How about this one? I don't know how to plan a trade. I'm entering without knowing what my exit should be. Or I don't understand risk. I think I'm managing it, but I'm probably not. I keep hoping the market will bail me out instead of taking responsibility for my trades. I'm jumping from one program to the next, trying to fix mistakes that I don't understand in the first place. I hate that I'm trading emotionally, but I feel powerless to stop. How about some of the more personal things? I'm terrified I'm going to blow this up again. Or what if I'm not meant to be a trader at all? There's a lot of crazy stuff going on in people's minds because of the scenarios we're in. What if I'm the kind of person who's always going to sabotage myself? People are taking this stuff personally, right? What if I'm a dreamer pretending to be a doer? These are actual things people have been writing to me. Maybe I'm too old to finally get it. I got another page, but I'm not. I feel like everyone else gets it and I'm the only imposter, or I'm afraid of disappointing my family again. I'm scared I'll always be chasing someone else's system because I just don't trust myself anymore. Or maybe I don't deserve to win. Here's the, oh my gosh, I have another page, but I'm not going to go. What if I can't fix what's broken in my trading? What if I never build actual financial freedom? Just more courses and more disappointment. What if I'm trading becomes just another thing I quit? All right, so here are the true facts. Right now, I'm not going to even sugarcoat this. There's so much uncertainty with what's happening in the world right now. But when you really break down what's happening in the markets, if you play it right, you can set yourself up for months, if not years to come. And that's really understanding that the markets are not, despite what the talking heads will say to us, like, oh my gosh, this many trillions in the markets disappeared today. Or money is not created or destroyed in the markets, right? It simply is going to move from one person's hand to another. So the key is figuring out how that money flow is working and putting yourself on the right side of that transaction. And that's what I'm going to share with you today is a transaction. Now, I'm going to be honest, I haven't put this transaction on since the winter holiday because it hasn't rolled around, but it looks like it's about to roll around again. And this is a transaction that I put on, a trade that I put on in addition to trading my portfolio that hedges my portfolio. And this is a VIX, particularly a VIX trade. So I want to explain that to you today so that you can come along with me the next time it sets up. And it looks like it's close to setting up in the next week or so. So let me give you a quick disclaimer, and I give this now the legal disclaimers. If you ever go to the tradingtrainer.com website, you can go to the bottom of the page and read all of our different lawyers. But I just want to be completely honest with this particular type of trading. You're just not going to do as good as me or even my long-term program participants trading these trades that I've traded until you've been doing it as long as I have, right? Because they call me the greatest of all time when it comes to being a disciplined options trader, right? Because I've been doing this coming up on 30 years. Next year, it'll be 30 years that I've been doing this. I may not look that old, but I'm 53 years old, and I've been doing this for a very long time. This has been my full-time profession as we've been talking about. I've been using Metastock since, the turn of the millennia. And I've been eating and drinking and breathing this stuff since 1997 and teaching it since 2003. So that's why, you can follow what I'm doing, but you'll probably not get the same results as me, at least not until you've been doing it for a hot minute. All right, so let's talk about, I'm going to break this down into 3 parts, right? There's the VIX index. I want to make sure you guys understand kind of what that is. And then we're going to talk about the trading strategy we apply to it and then how it works, right? And how to tactically do it. Because that's really, one of the reasons that I got attracted to options trading in the late 90s was because as an end of day trader, right? I'd had a full-time career. I was working for Hewlett Packard in Silicon Valley, right? And I only had the evenings to be able to do this because I was very busy. They kept me very busy at the HP campus right there in Campbell. So with that said, I wanted to be able to not just trade when something went from low to high, or shorting it, I could maybe make money when it went from high to low. But I wanted to be able to trade things like time passing by and all of that good stuff. So when I think about my options trading, right, instead of having 1 or maybe 2 strategies, option traders have 27 different ways they can profit from all the different patterns in the markets, right? So my tool chest is very big. My key thing, and I have, yes, I said I was 53, but I have a 4-year-old, right? And so, yes, I have a 4-year-old. The 4-year-old, right, she doesn't do it as much anymore. She's kind of outgrown it, but she had this kit where she had the blocks, right? And the blocks were in the shape of a circle or I should say a sphere, a cylinder or a cube, right? And she had the board and you'd put the right shape. That's really what this trading is all about, right? It's identifying a pattern and being very sure about the pattern you're identifying, and then matching the appropriate tool in your tool chest. And with an options trading, you've got 27 different tools. That means you can profit from a lot of the patterns that most traders have to leave behind, right? So with that said, being able to apply the right pattern to the VIX when we see it is going to help us when everything else seems like it's gloom. So what is the VIX? All right, so the VIX measures implied volatility on the S&P 500 options market. Now, what does that mean? Well, it represents the market's expectation for volatility, not real volatility over the next 30 days. So how do we interpret that even more? Well, okay, so options are basically a type of insurance, right? In fact, the big market movers, the ones that own big positions in the markets, they use options in order to hedge, right? If we're afraid that our long position is going to go against us, we'll buy some protective put options, right? And when we buy those protective put options, what happens? It creates kind of a demand for those put options, which in effect raises their price. And if you factor out from the option price the amount of days to expiration and what the underlying symbols affect on it, which you can do pretty easily mathematically, you're left with this raw buying and selling pressure on the price, right? And so that buying and selling pressure actually represents how many people or how much interest there is in insuring our position. Simplified, it measures how much fear versus confidence is in the market, right? And it's not fear over anything tangible, it's perceived fear. Sometimes it does, it does correlate. And actually, let me pull up a chart here. I'm going to just pull up a quick chart here of the VIX, and I'm going to go back as far as I've got data here. So I'm going to pull all my data. And so this goes back to January 1st, 1986. So when we take a look at this VIX chart, each one of these bars that you can see on my screen represents a month. Okay, so you can see here in 1987, that was Black Friday. That was when we had the change in the tax code. All of a sudden, all the investors lost a lot of their safe havens. And, you might remember if you were around in 1987 that all hell broke loose. Then you've got over here the S&L crisis. If you remember when Bush Sr. was the president, there was the S&L crisis. Then we fast forward a little bit, and right around here, we start to get the dot-com boom and then the dot-com bust. And then a couple more years in the 2000s. And then in 2008, we got the huge financial crisis. You see this big spike in fear. So a move up in the VIX is a spike in fear. A move down in the VIX is confidence. It's when people don't feel like they need those options anymore to hedge their big positions, as you can imagine. So then you've got a lot of tumultuous in the 2000 teens. Then, of course, right here, you've got your pandemic where the whole world economy shuts down and borders up in their houses till they think that they're safe. You've got a couple of stuff happening in 2022. Then you've got a calm. And now all of a sudden, all recently, if I bring us, for instance, to the most recent 2 years, let's see if I can pull that up. There we go. If you look at the most recent 2 years, you could probably see where we've got, this is the whole trade war and the tariff stuff that happened last April. And now, of course, we've got this conflict in Iran and the building tension with China and all that good stuff. So you can kind of see how the VIX represents how people are feeling. It's a fear versus confidence gauge, right? And now we got to go back to the idea about human nature, right? When we think about human nature, we're wired, right, to be ready to pounce, right? We're wired to not trust, right? At the first sign of disloyalty, we don't trust, right? I think it's from when we used to have to sit behind a rock ready to go after that woolly mammoth, right? We have this tendency to be able, at the first sign of trouble, we want some sort of insurance, right? We're going to jump for survival, fight or flight. Whereas, to get somebody to really trust you and to, talk to anybody in sales, to get somebody to know, like, and trust you, that is a lot of work, right? To get that confidence, to get that belief in something is not an easy thing, right? Especially when that thing has kind of gone against you. And that even makes it harder to trust. So our confidence comes very slow and calculated, whereas the first time the proverbial poop hits the fan, our fear goes through the roof and we're ready to like duck for cover, hedge, buy insurance, whatever we need to do. And that's kind of what we see when we look at the VIX. In fact, mathematically, if I pull this chart back up, I'm going to now come to a 6-month chart. Mathematically, if you take a look at this, there's actually this dotted line you might think that I've got drawn here is just a horizontal line. It's actually not. It's a best fit trend line from the beginning of my data in 1986. So what you find out here is that fear versus confidence actually kind of mellows itself out. It actually cancels itself out. There's times where we're fearful, there's times where we're confident, and actually comes out to pretty much a horizontal line across time at about $18.90, $19, something like that, right? In fact, let me go back to that all-time chart really quick, because something you should also pay attention to is, again, that confidence is very slow, and you'll never see that we get a spike in confidence. Like all of a sudden we wake up and we're like, I'm going to trust everybody. No, that doesn't happen. That's not human nature. But when it comes to all of a sudden something is on the horizon, our fear shoots through the roof. So you'll see that there's these extended amount of times where we have confidence, but we never really get that overconfident. In fact, I've never seen the VIX go down into single digits more than, I can count it on one hand in the last 30 years that I've been doing trading and watching the markets on a daily basis, that the VIX has actually dropped down into single digits. We can spend, extended amount of times somewhat confidence, but compared to the times where, oh my gosh, I think that the sky is falling, you'll see these huge spikes. So we spend more time in the confidence region, but when we get afraid, we're not afraid to go off the rails in the fear. We don't go off the rails on the confidence side, but we do go off the rails in the fear. So it's kind of an interesting how we get that average at about $19. It's these extremes of fear with these long-term amounts of somewhat confident, if that makes sense. Okay, so again, back to the current thought of things. Let me bring us back again. I'm going to just look at the last 6 months here. Okay, you'll notice as well that on my chart, I've got some lines at $12 and at $26. $12 is my line of overconfidence. And again, very rarely, especially since the pandemic ended, or since the pandemic, have we gone down below the 12 range. Now, the 26 range is where we get over anxious. Now, for option traders, we love it when it's above the 19 but below the 26, because that's usually where people are a little bit anxious, right? And they're willing to pay higher prices if we're going to be the sellers of options. Think about those ideas of like covered calls or buying cash secured puts, all of that good stuff. People are willing to pay more for that protection, but it's usually because of something they perceive, not something actually that's going to happen, right? Because again, the VIX is a measurement of more of our anxiety level, not necessarily that crap is going to happen, like there's actually stuff going to happen. But we find that above $26, when the VIX is trading above $26, that's where that founded, unfounded fear threshold is. Above $26, there, it's like you're buying insurance, right? And you'll buy insurance because around the area that you live in, they have hurricanes. Say you live on the East Coast of the United States, anywhere from the Outer Banks in North Carolina down to Miami, right? You probably buy some hurricane insurance because it's Hurricane Alley, right? But when the VIX is above $26, it means that you're out there buying hurricane insurance because you can see in the Atlantic a hurricane and you need to be insured before that thing makes landfall, right? There's something founded, there's something real out there that is messing up. Like most recently, this is the war in Iran, right? And the you know, fear that might escalate into something even bigger, right? And the last time that we had that kind of happen, let me look at about a year. I think that's more of the trade wars that have been happening back in 2025. Yeah, so you've got all these like rhetoric around China. China needs to, you know, lower their tariffs, or we're going to have 100% tariffs on China, and all that good stuff, right? So these are the things that get investors kind of upset most recently. All right, great. So you get an idea of what this VIX thing is. Again, the VIX only gets so confident and then it kind of caps off, and we never get these spikes in confidence that's going to the downside. But on the other side, when we have anything that might proverbially, you know, poop hit the fan, our fear goes through the roof. That's what the VIX measures, right? And it can get more complicated at that, but that was a good primer. All right, so markets are driven by human emotion. Fear moves faster than confidence. Fearful markets cause investors to seek protection, driving up option prices and driving up the VIX. Confidence builds slowly. The VIX rarely drops as sharply as it spikes. This asymmetry creates the pattern that we're going to be trading, that volatility tends to rise faster than it falls. So there's an option strategy that we can use to apply it. Now, aren't options risky, right? I don't know. Are you guys option traders? Because I hear this all the time when I come and speak about options. They're like, but aren't these things risky? Probably because somebody who, you know, a retail investor, probably a small person, decided to put a sure bet on some long options, right? They were going to trade some stock pattern, and they decided to use a long call or a long put instead of the stock, you know, going long the stock or shorting the stock, and it went against them, right? And if you're using an option that way, especially a near-term option, it can go against you big, and it can wind up losing. And if you don't know how to size your positions, you could lose a big chunk of your portfolio. So you get these people who are like, oh, I tried options and I got my ass handed to me, right? So here's the scoop. This is the truth about options. First of all, like I said, if you trade stocks or commodities or foreign exchange currencies or crypto, usually you've got one strategy, and that's to buy low and sell high. So you have to like wait it out, time it perfectly to buy low or sell high. That's the one tool you have in your tool chest. If you have the ability to short, well, then you have two tools. You can sell to open and buy to close, right? Sell to open high, buy back to close lower. And then you've got two strategies. So you can do it if the market goes up or market goes down. But with options, you get this flexibility that, in my opinion, outweighs the little bit you need to learn about options, the complexity of it, that allows you to make money if the stock goes sideways. It allows you to make money if all you want to do is, you know, work on the clock going, right? Because options have an expiration date. They're an expiring asset. So you can make money on the fact that time passes by. And like we're talking about today, you can make money in the case of fear or in the case of confidence, right? Volatility rushes and crushes. All right. Just let me look at the clock. I don't want to spend too much time, but I know a lot of you haven't, even though I've been in this game since 1997, you may not have heard of me. So let me just tell you a couple of things before we go on with fitting the right strategy. I founded a company called Trading Trainer. My peers call me the world's most disciplined option trader. I actually think behind the scenes, they call me the world's laziest option trader. I like to think of myself as the most efficient option trader because, again, I'm an end of day trader. I love, you know, Jeff hinted that I like to do trapeze. In my late 40s, I decided to walk into a circus school and fulfill my dream of learning how to be a trapeze artist, right? And in my late 40s, I decided to have a little one. So now I've got to, you know, talk about something to keep you young. I've got a 4-year-old running around, right? So these are the things I like to do during my day. And earlier in my life, I had a big career. And so I had to learn how to trade in the evenings. And so I'm very efficient, you know, at 10 p.m. in the evening after my little one's well asleep. I sit in front of the computer, spend anywhere from 20, 45 minutes figuring out, what my hot list is doing, which candidates need me to give action, and then I pre-program in conditional trades into my trading platform, right? And then I don't open the computer again, at least when it comes to trading, until the next evening. And I see which of my trades went, which of my trades didn't go, which need to be reset. And then I look at the hot list again, and it's all about a 20 to 4. So I'm very disciplined, very efficient with what I do. I've been doing this since 1997. I've published daily insights for my trading trainer participants 5 days a week since 2002. On a lot of successful option traders, you'll find my ebook that I wrote in 2005. You'll see on their bookcases my home study course that went out in 2008, still out there. And just so you know, I'm a learner just like most of you. I've got a whole bunch of engineering degrees. I actually never did engineering. I went right into marketing at Hewlett Packard when I got out of college. I've got a strong background in commercial business and investing. And in the last 15 years, I've spent most of my time taking courses on how to be a better teacher, especially accelerated learning methods and techniques, because grown-ups don't learn the same way as kids. We don't have as plastic brains in some directions, but there are ways for us to learn. And I want to be somebody who's very good at communicating those ways. And just so you know, in 1997, when I started, I was going to these hotel conference rooms. They really didn't have these multi-speaker events that were on the web. So you had to get in your car on the weekend on a Saturday, spend a half day at a hotel, listening to somebody talking about trading. And then you had to decide to pay a little bit of extra money to come for all day Sunday. Next thing you know, at the end of the Sunday, you've got plane tickets and you're going to be spending like a 3-day destination event with somebody. That's how it was in 1997. And when I started, I actually lost big. Not only did I spend more than my 2 bachelor's degrees and my master's degree combined, I spent $27,000 on seminars that first year, but also in trying to follow what those folks did. In that first year, I gave $85,000 back. That was way more money than my college education cost for all those engineering degrees. It was a good thing I was working at a pretty big company in Silicon Valley, and I was living with a bunch of guys. My rent was really low, and I didn't have a family. If I was to do that now, I don't think it would be possible. It's funny to look back like that. Let me tell you how to speed up this process, right? How to crack the code, because this is exactly what I did. That actually, from that first year in 1997 to when I started to actually show a profit, this is exactly what I did. Please take some notes. I stopped chasing shiny objects, right? In other words, I looked back and I said, what kind of trading do I want to do? Not just because it was like fancy and sexy, but because it would fit with what I was doing. I loved my career at HP. I loved working on printers and computers. We just had acquired Compaq at that time. So we were like doing this merger, and it was really cool. And so I didn't want to spend time trading during the day, right? So I couldn't be a day trader. So anyway, find out what, ask yourself, be really good, take inventory on yourself, figure out exactly what type of trader you can be right now to be successful. And that's what you pursue, right? Settle on one type of investing and then learn it well. I picked options because I liked the flexibility and I didn't mind the tiny bit of added complexity. I liked being an end of day trader. If you want to be a day trader who day trades Forex, at 1 a.m. in the morning, more power to you, but learn it well. Don't get distracted by somebody else, telling you exciting things. Number 2, hire a mentor who is currently doing what you want to do, but also more knows how to teach it. I hired somebody in 2001 who obviously I could see their portfolio. They had opened up their books to me and they were showing me their trades as they did them. I knew that they were successful, but this person could not teach me whatsoever. We just couldn't communicate on the right levels. They didn't know how to, and I got nothing out of it for the amount I spent, right? So it's called learning by guided discovery, and it's so much easier and less costly than learning by trial and error. So number 2, find a mentor who is currently, not has done it in the past or knows how to theoretically do it, but somebody who's doing what you want to do and they know how to teach. Finally, you want to, not finally, this is number 3 out of 4. Number 3, join an investment group. Don't do this Lone Ranger, right? This is something that they're already trying to teach my little one. They're saying, hey, don't look over the shoulder of your neighbor and you know, do your own work. Don't copy. But in reality, and again, I draw back to my experience at Hewlett Packard. We used to buy, like when Epson or Canon would release a new printer, we would buy that thing and we would bring it back to our labs and we would take it apart and we would find out what makes it tick. And then we would incrementally improve on one piece, put it all back together and sell it as our printer, right? So the truth is in the real world, we do look over each other's shoulders. It's called leveraging with pride. And that's how we move forward as a people and as individuals. So join an investment group so you're not doing this by yourself. Look over each other's shoulders, and please, if somebody is in your group and they're having a successful trade, don't sit on your rusty dusty and just, like, you know, flick your bic. Go do that trade, right? Follow along with what's working, and then of course contribute to the group yourself. When you're doing a good trade, let other people follow you. And last but not least, surround yourself with like-minded investors. When I started trading, especially that first year where I lost, you know, so much money, I had all these little people around me saying, I told you couldn't do options trading. They had never tried it themselves. They weren't successful themselves, but there's a lot of naysayers out there, and they're going to convince you that you're doing this wrong. What you got to do is, in your group, have people that'll celebrate your wins, but will also pick you up when you have a losing trade, because that's inevitable. I'm glad you got those 4 things down. A lot of people don't play with the mindset enough, but you know, this is how I jump-started my trading career. And just last but not least about me, I take historically underserved inner city kids. I started this foundation in 2003 with 9 kids in a pretty rough suburb of Denver, Colorado. You know what? These kids all went on to, well, at the end of the 6 months, and we were in a library where they only gave us 30 minutes of access to something called a DSL line per day. And so we had to be very efficient and plan everything out and then get on and do what we had to do in that 30 minutes. At the end of that 6 months with them, I each gave them $2,000 thinking I'd never see that money again. They all paid me back. And fast forward now almost 25 years, one of them is a professor at Denver University. They all went on to get their own computers, their own DSL lines back in the day, all very successful. We've been running this every year. I've since partnered with the Chicago Board of Options Exchange, where they take all of my material and they offer it to kids in the south side of Chicago, kind of a joint venture there. And so this is where, for instance, I'm running Trading Trainer, the school. You know, folks who pay me to teach them, this is where all your money is going. It's going to these underserved. We only took a break during the pandemic. We're back up and running. Last year, we graduated about 127 kids from the south side of Chicago from our investing program. If you need to know anything more, or you'd like to know any more, you want to get a copy of some of my free indicators or check out some of our free material, you can just go to links.tt4.me. I know it's funny, but links.tt stands for Trading Trainer. Links.tt4.me, and you'll find all my quick links. You can go check out all you want about me. All right, let's get back to this VIX hedging strategy. So what are we going to do to profit from that pattern? We're going to do something called a dual vertical spread, right? And I don't know, there's a tool that I really like to, and I'm not, what is it, sponsored by these people. They don't even know that I talk about their tool. I haven't seen in any of the platforms something as good. It's called optionstrat.com, and they let you construct these option strategies and simulate what's happening. So let me just show you this dual vertical spread. So if you can think about the way that the VIX works, and I'll see if I can turn on my screen's magic marker here so I can draw that in. But the VIX stays between these prices, right? And so most of the time when you put this VIX hedging strategy on, it's actually just going to break even. And I like to put this trade on every time that it presents itself, because then look at what happens when all of a sudden the proverbial poop hits the fan, which more recently it has done. It pays back, a huge amount to one, if that makes sense. So I use this as a hedging trade usually, and I've been putting this trade on for about the last 11 years. Every time it presents itself, I put between 5 and 10% of my portfolio into this trade. Lately, I've been putting closer to 15 to 20% of my portfolio in the trade. So as you can imagine, if we overlay what the VIX does, right, the VIX never gets that confident. It spends a lot of time down here at the low range, and then whenever there's a spike in fear, it shoots up in this high range. This high range is where this trade profits, and we take advantage of the fact that we never really have a spike in confidence. So people say, well, what if it goes down below this level? Well, we just don't go down below that level. This isn't like a stock. This is the VIX. This is a measurement of our overall confidence. We just don't spark into confidence. So now let's talk about, and I'll bring back my slides. We pair two bull vertical spreads, one debit and one credit. So I do a debit spread and a credit spread, and I enter them simultaneously, or you can leg into them. I actually now have been programming my conditional trades, my contingent trades, to put the first one on, and then also send me a notification that the first one got put on, and then I'll come in and match the second one. Expiration is typically 2 to 5 weeks out. So these are near-term VIX options. They align with this short-term volatility cycle. And the goal here is, whether you set the debit spread or the credit spread first, is to match that debit or credit. Usually it's between anywhere from 70 to about 90 cents if you're doing a dollar spread. So if you do a debit, like the last time I did this trade, it was an 81-cent debit. So then when I pick the credit spread, and you can pick the credit spread by moving the strike prices, you pick the same credit spread. I picked it so that it was a couple pennies more, so that if the trade broke even, I'd still wind up with a couple of extra pennies that could pay for your commissions, or in my case, it also pays for taking my significant other out for a nice dinner at date night, a couple $100, right? So that's how, again, we expect this to play out, is to just break even and to cover itself, and also cover commissions and maybe give us some spending cash. But when we do have it go off the rails, when we have the VIX spike up, we can then take advantage of those huge paydays. And that's why typically when the VIX spikes up, other trades in our portfolio, the other 80 to 90% of our portfolio that's invested other trades, usually are under stress. And that's when you have this trade that's paying 10 to 1, 30 to 1, whatever is your credit. That's when this trade really shines. Okay, so how do we time this trade? I use something called the fast MACD. Now, it's not anything I made up. If you talk to the Appel father and son team, Marvin has been talking about the fast MACD for 15 years, right? So when you pull up the MACD on your charting software, instead of using a 12-26-9, which is the standard MACD, you substitute in for the fast moving average of 6, the slow exponential moving average of 19, and the average for the difference line of 3, right? And so I want to see a crossover. That's a typical lagging indicator. I want to see that crossover going up to tell me that there has been a bottom in the VIX. The other thing I want to do is I want to make sure that the VIX is trading near that bottom. And right now, we want to wait for the VIX to pull back to between 14 and 15. And that's why I said it's not right now, but it's coming up. This whole Iran conflict has had, traders on edge, but we've been seeing the VIX peel back. It's currently at about 18. I want to see it come back down to 14, 15 again, because I want it to be at that place where our confidence is really not going to get any better, right? For the 2 to 5 weeks that we hold this. So I want this to pull back to 1415, and then you can see here's my fast MACD on my charting software. It's the 6 and the 19. So I'm going to wait for a pullback to 1415 around that range. And then when I get a nice crossing, and I've got, thanks to the beautiful way of programming these indicators, you can have the crossing show up with an arrow. So I'm just going to show up with a nice little arrow there, and that's my entry, okay? The strategy activates when volatility appears poised for re-expansion and avoids premature entry into ongoing sell-offs, right? So most of the time, trades result in near break-even or modest gains. That's why, most of the time when this trade presents itself, I never miss an opportunity to put this trade on, but it'll be about 5 to 10% of my portfolio, and it just sits in the background, and most of the time it just breaks even. Again, pick the credit so it slightly offsets the debit so that you still come out a little bit ahead, cover your commissions, and maybe get a couple of, depending on the number of contracts you do, a couple of hundreds of dollars back in order to do something special. But during market panics, when implied volatility spikes, that trade pays off significantly, right? It acts as a hedge, right? This gains from this position often offsets when the rest of our portfolio is under stress, and it provides peace of mind. And that's really, all those people who are sending me those words that I shared in the beginning of this presentation, I want them to feel some sort of comfort that they've got this trade in the background working, that if their trades don't work out, this thing's gonna, shoot forward in gains. I'll cover why it works. Just a summary. Volatility is inherently mean reverting, but it spikes sharply in crisis. Fear reactions create short-term mispricings in option premiums. This structure of this dual vertical strategy, it captures these short-lived surges while minimizing cost exposure. This makes this particular trade an efficient portfolio hedge, not a speculative bet. So here's the takeaways. VIX is a measure of market fear versus confidence. This VIX hedge trade, it uses a dual vertical spread set up to exploit volatility behavior, and we use a debit spread and a credit spread in order to cancel out the cost. We use strategic timing via the fast MACD at the channel bottom to enhance our edge and our consistency. This provides a built-in safeguard for premium sellers during anxiety-driven markets, which is right now. So here's how you do this. Should you, want to participate with us in doing it together, you come to one of my workshops. If you want, on that links.tt4.me site, there's my YouTube. We're on a podcast, and we're just about to do our 5th year of doing this Friday podcast. Subscribe to that YouTube channel, and you can listen to our podcast, whether you catch us live Friday mornings, 11 a.m. Eastern time, or you can watch the replay anytime after that. We talk about the VIX trade every week. You can come to a workshop, or if you're part of my program, I specifically tell you when to put on the VIX trade and what strike price options to choose. Get those specific strike prices for the vertical spreads. Get the specific timing signal. If you're part of one of my programs, you can send in, we have this thing called trade review. We have a way through our website for you to send us the trade plan you've got. We'll make sure we flip that to you by the next morning, tell you whether you're missing anything, any details. That's optional, but I think everybody should take advantage of our trade review. And then you place the conditional or contingent trade order, and that's it, right? Rinse and repeat every time this pattern shows up. So one of my questions as I'm kind of coming to the end of this is, how would you like to never miss any of these picks? Not just the VIX trade, but we talk about all the different options trade. We really like to focus on premium selling, but we talk about the other types of trading as well. How would you like to never miss a pick? Minimize the time you spend away from your loved ones or your loved careers or your loved, if you've got something that you like to do. One of our coaches, He loves to golf and he loves to curl, right? You know, that thing that's in the Olympics with the brooms and the, I'm not sure I understand it, but and that's what he does during the day, right? And then at night, he helps us with our coaching and he also does his own trading. And also, how would you like to have support whenever you need it? Because that's what it's all about, isn't it? It's all about saving time and creating clarity and, of course, getting results. So would it be okay if I told you in the last, maybe 5 minutes of this presentation, tell you a little bit about what my materials, training, and tools might be to see if it might be a fit? Thanks. Because this is for someone who doesn't want to pay for a whole bunch of different data subscription. They want everything they need in one place. They don't want to miss any of the opportunities. They want to spend more time doing other things than just sitting there watching their trading screens. They don't want to do this alone, and they want the step-by-step instructions on how to do it. In summary, this is someone who wants to be consistent and reliable with their results. Charlene's a good example. Charlene came to us. Charlene was in the profession that I think is highly underrated, especially as I have a little one growing up and we're starting to think about schools. Charlene was a teacher. She was a teacher for 29 years. She got sick. She didn't write it in her email that she wrote to me at 2:10 in the morning, but she got sick. She wound up actually getting cancer. She was ordered out of the classroom because all the treatments really made her weak. She still had 13 years left to work to qualify for her full retirement, as well as 13 years left before she could collect any sort of government assistance. She actually thought, though, she was a goner, and she was at peace with that. And this is where kind of things are weird here in the United States. She had a recovery. Her cancer went into remission. She got it canceled. And what was she left with? No job and a heck ton of medical bills, and no retirement coming in. And she wasn't able to collect Social Security this time. It was for 10 years because 3 years it took her to beat this disease. She got interested in the stock market. She heard me speak, and yeah, that's how so all she does is she reads a daily table. She finds a stock or an equity, an ETF that she's interested in. She follows the strategy. She uses it along with other strategies like this VIX strategy. She recently made 14% by just spending about 15 minutes reading about the company, following the chart, and then waiting for expiration. This is one of our time decay positions, selling premium and just letting the clock run out. Love that story. All right, this is what you're going to do if you want to, how you're going to get your first trade in the first 7 days. You're going to do your onboarding call. Anybody who comes work with us gets an onboarding call. Then they're going to go to the screener and pick a symbol that's in your price range. Bring that symbol to one of our weekly workshops and submit them. Plug that symbol into that worksheet that we give you and put in your portfolio specifics so the worksheet does your trade plan for you. Send us the trade for review. We have this trade review for all program participants. Send us what you're going to do and what you're looking at, and we'll make sure you've crossed all your T's and dotted all your I's. And then trade the trade. And if you're in doubt of everything we're saying about option trading, you're new to it, paper trade it. Prove it to yourself. And then rinse and repeat that process often. So let me ask you what it's all worth to you. We've got video tutorials right there in our website that you'll get access to. You get monthly live classes and all of their replays. We have them going all the way back to 2010. These are our lecture series. A lot of people say the replay section of our website is one of the most in-depth options encyclopedia ever anywhere on the web. You've got all of our proprietary screeners that help you find the underlying symbols you trade on. You've got planning tools that help you plan your trade. We have weekly live workshops that you can bring your picks to, and we can plan out for you during the workshop. You've got the trade review. So what is all that worth to you? Think about that value. Because I'm going to add some bonuses. if you come work with us, I'm going to give you a double your money back guarantee. So I want you to work the same amount of times that I work with those underserved kids in my charity. I want you to work at least 6 months with me. And if at the end of the 6 months you're not turning a profit, I'll give you all the money back that you paid for my program times 2, a double your money back guarantee. Also, we have coaching for those folks that are higher end and they want to not, they want it more done for them. They want to have somebody who they can talk to at a moment's notice. But I want to give you a complimentary session with one of our coaches. So these coaches have been watching people for years go from point A to point B. So you're just going to tell them where you're at, where you want to be in 6 months, and have them help you create that plan to get there. And then this is a bonus just for this Metastock event, and that is I want to give you a trading audit session. A lot of you I know have already been getting involved with some other trading, and trust me, I've done pretty much anything that you've tried. And so I want to give you an audit session with me. So if you sign up from this event, if you're here listening to me now or listening to the replay of this event, you'll get a 1-hour session with me. Now, it might be scheduled a little bit in advance, but it'll be within the next 6 months. And we'll go over your trades. We'll go over anything you want, but I want to go over what you've got in place now and help you tweak it to make it better. Okay. So with those 3 added bonuses, the double your money back guarantee, the strategy session, the trading audit, what's it all worth to you? If you go on my website, this program is $600. That's for 6 months. It's a flat fee. We're not going to, there's no reoccurring. It's just a flat fee of $600. But for this Metastock event, I'm going to give you $100 off. So it's $497. This is how you go and take advantage of that. And I'm going to test it right now. You basically go to that website, optioninvesting.org/Metastock. I've actually got that up right here. If you want, you can take your phone and scan the QR code that I'm showing you on the screen. That'll bring you there as well. And then it says $597. I'm going to put in the 100 DISC for 100 disc to the promo code. We'll see if my programmers have this working. Whew, sometimes that doesn't work. All right, so that's how it gets discounted down to $497. So yeah, it works. Go to optioninvesting.org/Metastock or scan this QR code. And what you'll be getting is not only details exactly when to put on the VIX trade and what option strategy, strike prices you should be using, but also we'll be talking about all the trading we do in the meantime, especially premium selling. So how to sell options to those people who are willing to pay, a lot of money for them, especially when fears are higher, and how to let the clock work to count down and wind up. That's your investment. It's almost as easy as like putting your money into a treasury bill. But these, instead of paying, whatever treasury bills are paying per year right now, 3% per year, our trades are doing 6, 7, 8, 9, 10% per month. So, growing your portfolio 6% per month, growing your portfolio 3% per year. This is a better way to do it by learning how to make options work for you. So that's it right there. Optioninvesting.org/Metastock, promo code 100 DISC. And that's all I've got. Jeff?
Thanks, AJ. I've got that in the link. We had a question or two. Let me go over to them. Actually, we had Paula wanted to know, do you look at IVR of individual names?
We could definitely trade this on the volatility of individual names. In fact, we do. It's a different strategy though, simply because the VIX being so diversified. The VIX is basically a measurement of the implied volatility on the S&P 500. It definitely has that lower boundary, whereas individual symbols, I think that we would trade those differently. And should you come work with us, I think you should throw those names into one of our workshops so that we can talk them out and talk about the different ways we can trade them. Because again, we've got 27 different option strategies in our tool chest. We can find the right one to take advantage of that volatility rush or volatility crush.
Cool. We had another question from Pernand, and I hope I said that right. If not, my apologies. Pernand says, options is risky for retailers. Is risk calculation important?
Absolutely. So that's another thing, and that's one of the reasons why we use planning tools the way we do, because position sizing has to be established, and what we like to do is simulate what the worst case scenario is. And in some of these option strategies, the worst case is that the trade could be a complete loss. So then you have to compare that to how much of your portfolio you want to risk, so you size your position accordingly. And a lot of times all of that math is redundant and sometimes error prone. So we program it into worksheet tools so that we could just put in some parameters about our portfolio and it spits out the size of the position. But it also gives us price targets. So when we're legging into these positions, if we beat the price targets that our plan gave us, then guess what? We're going to wind up with a better trade than the worst case scenario, higher rewards, less risk. So that's, that's risk management 101. But that's the beauty part of doing it kind of this way, is to plan it out. You've heard it a million times. Plan your trade and then make sure you trade your plan.
All right, and I think we'll end with this one. I love AJ's candor. Everything he said is so true about when he started. So there you go.
True.
It's a compliment. Thanks for the presentation today, AJ. We've got the links in the chat. Make sure you click on them.
Good to see your face, Jeff.
It's good to, man. I'm still jealous, man.
Yeah, it's gray though. It's gray.
Oh, well, unlike mine, right?
My wife puts shoe polish in my hair.
All right. Good to have you, AJ.
All right. Take care.
You too. All right. Let me do this here. We'll just move. Go ahead and move this over here before it gets a little bit weird. Do want to say, hope you're enjoying everything today. I've been looking at the lineup that we still have, and we've had so many great speakers, but we have so many coming as well. So, including Larry McMillan, Jeff Tompkins, AJ just finished. Laura Blocker is right. I'm getting a little bit of, let me go ahead and kind of reset right now. Alla Peters Blocker is what I was trying to think of. I want to say I hope you're enjoying the session. Hope you've learned some things. Hope you're entertained. I hope that you've already joined the tradersforum.com, which you can do for free. And there you'll be able to chat with other traders about the markets, learn about the markets. It's designed to be a community of traders helping traders. We do all kinds of really cool events up there. There's a lot of really cool educational resources. You can chat about the markets all the time when it's open. I've learned a lot of stuff up there. It's been very, very helpful for my trading, and it's free. So join us, thetradersforum.com. We've got about 1,500 members now. I want to see that community continue to grow and thrive. And a good way to get there is to get you there, thetradersforum.com. So there's that. We've been talking a lot about the offers here at Metastock. All of the offers that we're going to talk about all week can be found at metastock.com/conf-promo. I've told you already how valuable I find scanning the markets. I ran my market scans, found a couple of stocks I wanted to trade, was able to trade them. Didn't take me a lot of time. I was still able to kind of do everything else I needed to do to keep this whole thing going. But what a great toolbox. There's a reason it's been rated #1 for 32 years in a row. It's going to help you scan markets, test trading ideas, identify and forecast probable price movements. We're going to talk a lot about kind of the functionalities of Metastock, but it's a mature product. It's something that we've been working on for over 32 years, and it's helpful. So $75 a month is really all you had to pay to kind of get started. If you buy a month, we'll give you the second and third month for free. That's going to run you till August, and it's going to be $25 per month. Find out what you've been missing. If you really feel like something can help you with your trading, whether it's stock selection. Kelly talked a lot about strategy selection a little bit earlier today, whether it's the lack of education, not knowing what you're doing in the market. Metastock can help you with all of those. So metastock.com/conf promo, metastock.com/sales chat. If you want to get some more information or talk to us about the offers, 800-882-3040 as well. Our next guest is Alla Peters-Blocker. Alla talks a lot about Fibonacci. She does a great job. We keep bringing her back. We really, really like her here. And Alla, I can see you're in there, or in here. I think I need to actually kind of send you an unmute request, maybe. Okay, there we go. Let's see if we can get you kind of talking. Alla? Well, she is in the room, ladies and gentlemen. Oh, I see some movement on her thing. Not great movement. All right, Al, I just don't see your audio is connected. It looks like it was, but I've got kind of a weird icon that I haven't seen before. What I might have you do is actually re-enter the room and see if we can get you running that way. Okay, it looks like she's doing that. While we do that, while she does that, let me go ahead and open up the chat. We'll look for her to kind of come in here. While she does that, what I'd like to do is give away a prize. So I usually have Alla help us do the prize. But since she's not here.
Can you hear me? Hello, hello.
I can now. Yeah, welcome. It's good to have you. I can hear you now.
Amazing.
Okay.
Not sure what
I can hear you
happened,
so well that
please.
you just made me jump out of my desk.
Thank you so much. And allow me to project, please.
Oh, I will. Yeah. Let me go ahead and turn on the. Let me go ahead and make you a
was.
presenter.
Thank you.
Yeah.
Okay, almost there.
I do have a small request for you, if you don't mind. When you have a
Very
chat.
simple. Here we are. Fantastic. Amazing to be with you. Hello, everyone.
I've got, I can see your screen. I can hear you. Everything looks like it's going to work from here on out, Alla. I have one question for you.
Yes.
We give away prizes throughout the week. I want to give away a prize from John. I just keep getting from the Mad Hedge Fund. I want to give away a 6-month subscription. It's normally John Thomas. Geez, why am I having a hard time thinking today? John Thomas. I have a 6-month subscription that we're going to give away of his service. All I need from you to help me determine that prize, Alla, is a number between the 2 and 4,629. Are you there?
Yes.
Okay. All right. So any number between 2 and 4,629.
Let's pick Fibonacci number.
Okay. I knew you'd do that.
Something incredibly simple. 8.
Okay, 8 it is. All right. So the winner of that prize is Steve F. And I will get that information over to Mad Hedge and have him send. Alla, I can hear you. I'm sorry we had an initial problem with your audio. I'm glad we can hear you. I can see your screen. I'll be here if you need me, okay?
Absolutely. If you could please allow me to post the links. So far looks like I can share only to you.
Let me go ahead and, yeah, I'll make you the organizer. Make sure that I dismiss you.
Yeah, perfect.
Okay.
Beautiful.
All right.
Okay, thank you so much. Let's start. Hello, traders. It is my joy and honor being here with you today to present how Alpha Fibonacci precise simplicity will improve your trading across all instruments, all time frames, all platforms. But first, an extremely important reminder. Please remember to trade with risks you can personally afford to trade, and absolutely recognize that nothing in this webinar constitutes and investment advice, everything to educate and empower you. All software systems trading strategies shown as is without any guarantees, and no student had ever been paid for their testimonials. Past performance does not guarantee future results. These are required disclaimers. In this webinar, we will cover how Alpha Fibonacci simple predictive proprietary system had been traded by traders of all levels, from complete beginner to hedge fund manager in US and globally since 2011. How system identifies institutional buy and sell points, including the ones playing out right now live. How you can trade with absolute confidence with simple, precise entry stops and targets across all instruments, all time frames or platforms, with a very special lifetime system offer with savings up to $8,000. Briefly about myself, I live and breathe what I do. I'm very proud of our global community. I hold multiple degrees, starting from classical piano, originally from Ukraine. When I arrived to US, I became RN. I'm licensed in behavioral psychology. I worked with top psychiatrists on the planet at Johns Hopkins Psychiatry and Research. Later on, after launching very successful multiple businesses during financial crisis, I witnessed how proprietary system I developed identified crashes and rallies before they happened. 2011, I chose not to work for financial institutions. I launched Fibonacci trading website and YouTube channel, and ever since, for the last almost 16 years, I've been teaching in live online classes and developing my own trading system. 2004, when I started developing my very first system, I saw very, very clearly something extremely important. I recognized that every single instrument is exactly the same. It was absolutely a mind-blowing discovery. It was absolutely shocking to recognize that the only difference was trade hold time and risk management. But price action remained absolutely identical across various time frames, across all the instruments. So if I'll bring to your attention in just a second a very powerful test, you absolutely will be blown away when you will see that you would never know what instrument this is, but what binds every single one of this instrument is price action. So let's start with extremely simple test, shall we? When I will show you something extremely important and ask you a question, please ignore the label at the bottom, because in front of you, every single one of these instruments based on this, based on S&P 3-minute chart. But this is not S&P 3-minute chart. This is entirely different instrument. This is not S&P 3-minute chart. Take a look. And please recognize, my goodness, what is this? This is not S&P 3-minute chart, but this is exactly what played out almost 22 years ago when I started developing my system. No one knows what this is, but it's extremely clear. This is pure price. So when I bring to your attention that this is in fact S&P weekly chart, but it looks identical to S&P 3-minute chart, 2-minute chart, any chart you choose to trade, what unites every single one of these charts? Pure price. So when you trade pure, the sky's the limit. And this is what Alpha Fibonacci system based on, and why traders all over the world, trading Apple, Tesla, Euro, Pound, Bitcoin, trading NASDAQ, because pure price is identical on every single instrument, every single platform. Only difference, risk management and trade hold time. When you trade pure, the skies are the limit. And this is the reason top financial institutions respect my work. And as greatly as I appreciate Goldman offer, I continue working for myself, teaching traders all over the world how to trade proprietary Alpha Fibonacci system that's playing out right now live. Here we go. Did you know that S&P would reverse from this level? This is proprietary Alpha Fibonacci reversal zone. This is bottom. But S&P sold off from the top. This is retail reversal zone. You knew if you traded Alpha Fibonacci system many days in advance where S&P would crash from. So let's take a look on S&P on May 13, shall we? S&P heading higher and higher. Hours and days in advance, no matter what chart you trade, you know where price heading to. Price moves one step at a time. Doesn't matter if you trade 5, 10, 15, any chart. When you insert proprietary levels on the platform you choose, including Meta stock, you knew extremely well where S&P would crash from. Here comes the selling pressure. Again on May 14th. Doesn't matter if it's 5, doesn't matter if it's 15. All in advance, never after the fact. So when you insert proprietary levels and proprietary strategies on Meta stock and apply very simple rules that children of my students can trade, you knew to short S&P from 75.40. No matter if it's tick, if it's range, no matter what minute chart this is. But right now live, S&P reversed from the bottom, from critical key Alpha Fibonacci buy point. And again, if I bring to your attention S&P to 3 days before, on Friday, you knew all of these days in advance. So here is S&P playing out live. If I was presenting an hour ago, you would have seen how flawless this is. Again, this is prior. This is now in front of you live on Monday afternoon. That's it. So buying the bottom and selling the top where your power lies. Doesn't matter if you trade S&P hourly, daily, weekly, monthly. Doesn't matter if you trade Tesla, Euro, Pound, Bitcoin. Predictive simplicity is what you apply to your trading and making a personal decision on the instrument you want to trade. But if you choose to trade daily as an options trader, in my absence, I was gone for a month. This was breathtaking, as my students knew. Take a look. This was last week in March. I will take you further before the start of phenomenal rally on S&P. How about March 20th? Pay attention, please. If you're an option trader, this is your favorite chart. All in advance, never after the fact. Here is the last week in March. And again, you knew this weeks in advance when applying proprietary rules. Here's March 31st. This is the start of the rally from 6,400 level. This is ultimate institutional buy point. As an options trader, as an investor, you're buying from this level. As a retail trader, as a day trader, you're buying from this level. That's it. Nothing less, nothing more. Stunning and flawless. Institutional point of entry months and a half ago. Today, May 18th, as price spelled out weeks and months in advance, We reached critical key target. We're sitting at the identical level, except this level at the top. Critical key targets have been reached. So if you spend 5 minutes trading at the end of March as an options trader, as an investor, as a day trader, multiple variations of S&P, VOO, index funds, day trader, option trader. Here we are. This is S&P in front of you. More than 1,000 points later. Absolutely 100,000% your choice on the time frame, on the instrument you trade. Simply insert the levels and strategies and make a personal decision how you want to trade this. Pay attention to identical level in April 25. Despite tariff war, rules are met, take a trade. Flawless Alpha Fibonacci buy point from 5,000 level reached critical key target in October 2025. And here we are, April 26th. In my absence, bullish rally skyrocketed again. And that's massive numbers of charts from micro to macro, from retail playing out in front of you live, from tick chart to range chart to small minute chart to option chart, long-term position chart, long-term investment chart, leaps, and multiple other derivatives you can trade. Selling pressure is on, and it's absolutely critical to see what will play out at this level. We're in bullish correction, but this is institutional buy point. When it correlates with retail buy point at reversal zone, this allows you flawless, bottom lowest, least expensive long entry. And that's S&P for the last year, since April 2025 until now. Stories of my students all over the world is the reason I live and breathe what I do. From Florida to New Jersey to North Carolina to Switzerland to Germany to Dubai, I traveled the world meeting my students, London, of course. I live and breathe what I do, and I adore our traders who are serious about trading. And that's the reason fathers bringing their children to the course who trading the system. Husbands bringing their wives, brothers bringing their brothers, friends bringing their friends to the course. And one of the most shocking events, William brought his accountant who was blown away by his returns and purchased course for his accountant. I will walk you through the website where you can find all the detail. Alpha Fibonacci trading system removes complexities, removes noise, allows traders to focus on predictive institutional reversals. And simplicity absolutely is the core of the system. Here is the legendary trade on NVIDIA that you could have taken with Alpha Fibonacci system. I'm taking you back to April 2025. April 25 was spectacular and breathtaking, as I always encourage my students to backtest the system, going back to as many years as you have data for. So here's April 1st, 2025. Tariff war. But intelligent trader who trades Alpha Fibonacci system understands rules are made, take a trade. This was a phenomenal and breathtaking event. By the end of April, exponential number of stocks skyrocketed. As you will see next, it played out on Tesla as well. Has anyone expected that despite tariff war? Have you seen what just played out on NVIDIA a year later after the pullback? Have you taken advantage of that? That's very pure and very simple. You make a personal decision on the instrument you want to trade. So here's NVIDIA in December 2025, after reaching critical key target, NVIDIA in correction, selling off from reversal zone. But as we discussing every day with my student, this is critical key level to the downside. Rules are met, take a trade. I am in Japan meeting traders. In my absence, a year later, NVIDIA skyrocketing again, reminding you, hand-holding does not work. Knowledge with Alpha Fibonacci system does. NVIDIA picked up bullish rally after minor correction, but correction lasted 8 months, traders. So if you understand the power of this, you understand quite well why NVIDIA, despite very successful meeting in China, it's pulling back right now. Correct? We are at reversal zone, pullback zone. But this level must remain intact. This is the most important level on NVIDIA right now. But NVIDIA reached institutional reversal zone, bearish pullback in play. And that's proprietary strategic Alpha Fibonacci chess. Pure and simple. So from micro charts on S&P, from micro trades to VOO to S&P index fund to options on any instrument you choose to trade, my favorite event in the last 2 years is Tesla. Here's why. Pay attention, please. I'm taking you back on Tesla. With the Alpha Fibonacci system 2.5 years ago. So if you love playing chess, if you have a strategic brain, it's very easy for you to trade the system, as proven by traders all over the world. Here we go. October 2024, Tesla. Bullish rally picking up this team, correct? No one knows if Trump would win the election or not, correct? But Elon Musk rallying for Trump. So if you buy Tesla at the bottom, you understand price moves one step at a time. And again, if you're trading on Meta stock as a charting platform, all you need Fibonacci retracement tool, but you can place trade on any platform you choose. Absolutely. Fibonacci retracement on Meta stock is a phenomenal opportunity to trade Alpha Fibonacci system. So here is Tesla, reaches critical key target after Trump wins an election. So what happens by the end of January? The friendship between the wealthiest man on the planet and the most powerful man on the planet, while Tesla reaching reversal zone, comes to an end. Oh no. Here starts a tariff war. Tesla in free fall. Shorts on Tesla come to an end. But while Tesla being burned across the world and earnings are catastrophic on Tesla, if you traded Tesla with the Alpha Fibonacci system, you are buying Tesla at the bottom. Rules are met, take a trade. Tesla more than doubled in value despite catastrophic earnings of 2025. So what has happened this year? Have you seen spectacular earnings in January? So how is it possible Tesla sold off on January 6th after finally great earnings? Because Tesla was at reversal zone. So if you understand the predictive and intelligent and strategic chess, this was Tesla after excellent earnings. But this is how Tesla doubled in value despite catastrophic losses. So when you start using your limitless brain, you knew to expect pullback on Tesla until this level, where Tesla just reversed from. And that's strategic intelligent chess with Alpha Fibonacci system playing out in front of you live on Tesla. Tesla sold off from reversal zone despite very successful meeting in China. That's it. Tesla extremely high. So whatever instrument you will choose to trade is 100,000% your decision. But when you come to the website and you fill in your name on the website, you can come to the trading room and ask me any question you choose. Invitation is available for tomorrow. And when you listen to our students' podcast, who are trading not just futures, but stocks and Forex and crypto, and you're listening to traders from 11 to 86 plus years old, you see very clearly, if these traders can do this, if complete beginner traders can go from prop firm traders to, from beginner traders to prop firm traders, anyone can. Pure price for entry, alpha, Fibonacci for exits. So let's review multiple other instruments, shall we? Because precise simplicity gives you freedom to trade anything you choose with institutional entries and institutional exits on all instruments, not just futures, but also Forex and crypto. ETFs, mutual funds, of course, if the instrument has a price, Alpha Fibonacci system applies. So here's a chart on euro. Here's a stunning reminder of the catastrophic events in Europe and how euro doubled in value despite war in Ukraine, despite Middle East war. Is everyone seeing this? One of our students left Saudi Arabia and brought home in South France when euro was at the bottom. Jamal is my dearest friend for life, now in France. So here's euro selling off, stock in correction, but it doesn't crash. This is a critical key level on euro. And again, I can take you back on euro 4 years to the start of the rally, 6 months after war in Ukraine played out. So if you understand the power of this is exact same identical event that's playing out on S&P and on NASDAQ live right now. So here's November 2022, correct? Let's go to that date, shall we? Let's go even further. Let's go to October 3rd. Do you like to buy the bottom? Do you understand the power of this? But my goodness, this is euro almost 4 years ago. This is 5 minutes of work looking on a weekly chart, 4-hour chart, hourly chart of day trading Forex. But this is exact same strategy playing out live right now. Do you like to trade 3 minutes on S&P? Do you like to trade 5? Do you like to trade tick charts? Identical event playing out now, as played out on Tesla in April 25. Absolutely 100,000% is your personal decision. Use charts on meta stock, but place your trades anywhere you choose. Of course you can. So if I bring to your attention NASDAQ right now, this is NASDAQ Live. Identical trade as on euro, converting the chart to 5. Your mega power lies to buy as low as possible, correct? That's it. Choice is yours. This was the mega power of buying NASDAQ at the bottom. This was NASDAQ on May 12th. But if I convert this chart to any chart you choose to trade, you absolutely can. This was breathtaking and stunning and spectacular. Not everyone can day trade. Life happens to all of us. If you're working through a stressful part of your life, Walk away from day trading, please. Use system long term. This is Nasdaq. You can trade on daily, looking at the chart once a day. This is Nasdaq reversal in my absence. I'm gone. My students have done just fine. Here's March middle. March 23rd, Nasdaq oversold. Again, April 25th was breathtaking. Here's April 26th. Day trading, not your cup of tea. Use options, use long-term positions, use QQQ, use various derivatives. Nasdaq no longer at 23,000 level, correct? But it's identical trade that played out first week in April versus now. It's identical trade on Euro. It's identical trade on Tesla. It's identical strategies with very different risk management. So many of our students work full-time on different time zones. Simply apply the rules and the sky's the limit. Today, more than a month later, Nasdaq reached critical key target, selling off from reversal zone. This is a critical key institutional support playing out in front of you live, correlating with retail buy point. That's it. And that's your mega power with trading Alpha Fibonacci system on any chart you choose to trade, from micro retail to institutional charts on Nasdaq. But if you like to look on the chart weekly, once a week or once a month, this was breathtaking point of entry. 17,000 April 2025. 8 months later, Nasdaq reaches critical key reversal zone and selling off. And we discussing this is critical key buy point on Nasdaq, where Nasdaq skyrocketed from a year later. That's it. So when you start using your limitless brain, all you have to do is make an effort and trade markets as predictive, simple, strategic, intelligent trading chess. You can day and position trade on any chart. And you can absolutely use MetaStack charting platform. Because identical trade that played out on Nasdaq, playing out live right now is what played out on Euro. But that's 5 minutes on Euro once a week. Here's Euro 4 years later. Absolutely overextended 1112 is a critical key level on Euro. If that level remains intact, Euro simply overextended, stuck in correction. US dollar is entirely different story, traders, completely different story, and it's essential you understand and respect that. US dollar in free fall. It's no longer cheap for us Americans traveling the world, correct? Not even in Japan. Here's US dollar. This catastrophic sell-off identified months and years in advance. All independent of election, all independent of politics. So I bring to you this chart well before the election you knew quite well, not to buy, but to short US dollar. So if you love trading Forex, if you love trading crypto, whatever chart you like to trade, after the election, you shorted US dollar. This is December 2024. Here we go. Bullish rally overextended, correct? This is the reason I named this level proprietary reversal zone. US dollar in free fall and buyers remain so weak on US dollar. This continues. So what we should be doing right now is traveling inside US, inside our magnificent country, because everywhere else is quite pricey, even in Japan. That's it. So if buyers cannot break through 142, bullish rally on US dollar is extremely weak. Collapse from 148 until 136. That's it. But again, if you understand the mega power of shorting the top, take a look. This was S&P a few days ago. On May 14th, you shorted the top, correct? Identical trade as on US dollar, as on Tesla, as on Nvidia. Day and position trade, of course, from 75.40 until 73.70 level. Spectacular crash on S&P. That's it. Identical strategy. So when you make a personal decision on the instrument you choose to trade, it's 100,000% your choice without any delays. As we already reviewed S&P across multiple charts, correct? As we already reviewed NASDAQ. Strategic intelligence, simple chess allows you to trade without pain, without stress, without confusion, without chasing markets and losing money. This system appropriate for all platforms for traders of all levels. A strategic, precise trading chess. We already reviewed Nvidia, correct? So why don't we take a look on Apple? Shall we? And Amazon. This was Apple in 23 at the bottom. Stunning, flawless, bullish point of entry, correct? Spectacular and breathtaking. This was Apple in 25. And this was Apple here. So again, let me take you back to March 2025. That despite tariff war, when you use your limitless intelligent strategic brain with the Alpha Fibonacci system, you knew to buy Apple at this level. This is more than a year ago. Apple selling off, moving one step at a time. This is what Apple have done by the end of April. Bullish rally started with vengeance. So when you see Apple skyrocketing a year later, it's black and white. Bullish rally on Apple is vertical and breathtaking. That's it. So 100,000%, it's your decision. If you want to trade Apple, or if you want to trade Nvidia or Tesla or Euro, US, Canadian, dollar, how about Bitcoin? Has anyone expected Bitcoin to collapse more than 50% despite all of the hype? But did you know where to buy Bitcoin after the pullback? This is April 2025. Let's go back to March, shall we? Strategic intelligence, simple, predictive, chess, stress-free. You're looking at the charts once a week. Here's March 2025. You are very well prepared. You're monitoring this level, understanding quite well. Rules are met, take a trade. Bitcoin remains pretty high, but this is crucial key buy point. By the end of April, Bitcoin skyrockets. But what happens in the months of January, despite all of the hype, is a stunning reminder. If you're trading Bitcoin, you need to know where to exit your position. As I always said for many years, Bitcoin will keep swinging between 24 to 86%. So if you don't want to be stressed out, you need to know where to take profits off the table. Here comes collapse on Bitcoin. 50% plus, correct? What happened at this level again is a stunning reminder. Price struggling, absolutely struggling immensely. Sell-off continues. Absolutely no long point of entry. So what played out on Bitcoin in April was stunning. Again and again and again. Rules are met, take a trade. This is critical key target on Bitcoin to the upside. This is very important event. Absolutely a personal decision. The instrument and time frame you will choose to trade. And that's predictive simplicity of the Alpha Fibonacci system, traded by traders all over the world. And of course, absolutely, you can trade Amazon. The answer is yes, yes, yes. This is identical event as you saw played out on Bitcoin. Bitcoin skyrocketed from proprietary buy point and selling off right now because it reached reversal zone. That's it. And that's rule-based, simple, strategic system traded by JP Morgan traders, traded by beginner traders all over the world, across all time frames, all platforms. So if you decide to trade euro, of course you can. If you want to become a prop firm trader, absolutely. So many of my traders came to me, as you will see next, such as Terry, who struggled for so many years, but not anymore. Marcia just joined Fibonacci Trading Institute. Such a joy working with her. Such an incredible lady, struggled for so many years. This morning I worked with her, and she absolutely enjoys her trading. As she says, it is truly amazing. No other program out there that will make your dreams come true as a trader. I thank Alla and her Alpha Fibonacci Trading Institute. And this is very big words, and she's always sending me texts. This means the world. And the reason I live and breathe what I do. So if you want to become an accomplished trader, I look forward working with you. All you have to do, make an effort, and you can trade any instrument you choose with predictive, simple, rule-based proprietary system, which consists only of pure price for entry and proprietary Alpha Fibonacci retracements for exits. Michael been with me for 15 years. He brought his daughter to the course. When he came to me, he's been a struggling trader. Now he's a prop firm trader trading multiple accounts. This picture, 15 years old, as we joke, we need to take photo to show that his daughter is grown up. Now she's trading crypto. That's it. Very different instrument. Father and daughter trade. Terry, when he called me, he was almost in tears. He was so stressed out as a trader. Not anymore. It's a game changer. Time and time again. This never gets old. And again, when fathers bringing their children to the course, this was even during COVID. I adore Dominic. You can hear to his voice. That show you. If 14-year-old can do this, anyone can. Pablo, complete beginner trader, was stressed out attorney, had no idea what trading was. I just spoke with him the other day. He's a prop firm trader trading futures, stocks, options. He was looking for a prop firm that allows options. He's maxed out on prop firm accounts on futures. Complete beginner, complete novice trader. Suda, my dearest friend for life, also was incredibly struggled trader. So every single one of these traders is a very similar story, either complete beginner or a whole lot of struggle. None of that matters anymore. As Patrick says, Patrick in his 70s, I consider you the genius of Fibonacci. I have lots of observations of price movements and fees, but none work as consistently as yours. Very powerful statement. And when CEO comes to classes in the middle of the night in Australia, he's a legend. Absolutely adore CEO. tens of thousands of emails from traders all over the world. This is the reason I live and breathe what I do, and I wake up at 4 a.m. to be with my traders. So when you are serious about trading, I look forward working with you. Please review all the information on the website and recognize if these traders have done it, so can you. Private mentoring allows you to trade across all instruments, all timeframes, all platforms with savings up to $8,000. It's a lifetime system. All you need Fibonacci retracement tool on the platform you choose to trade, and absolutely charting for meta stock allows you to do that. This is option 4. The most popular option, less expensive option, is a group course, option 1 and 3, of course. So please review all the information on the website and make a personal decision on what's appropriate for you. And of course, feel free to contact me anytime or send me an email. Simply click on Contact Us section or pick up the phone and call. +1 925 257 4298 or info@fibinstitute.com. But when you come to the home page and you see the very gentle pop-up, enter your information and you will be invited to the trading room where you can ask questions about the instrument of your choice in the live market. So while I'm still here, please do ask me questions. Thank you, Jeffrey, so much for having me. Always joy and honor being here with you. Any questions, trader? So this is all I have for today.
Okay, sorry, Alla. I could not find my mute button. I was looking all over the place for it. Let's see. I don't see any questions. One question we usually get is how pertinent can this be towards options?
Of course, absolutely. As we reviewed S&P, we reviewed NASDAQ, QQQ, we reviewed Tesla, we reviewed Amazon, all predictive for options. It is so powerful. Let me show you a very important post from one of my current option traders that you can find on the website, who purchased course for his accountant. Here we go. William right now in the course. So if you love trading options, absolutely. Because you understand the price and you know where price moving to.
All right, very cool.
This is a student who purchased the course for his accountant. That's it. And you can listen to traders on the podcast and see traders' performance. Because if you know far in advance where price moving to, it is extremely powerful to trade options, correct? As we reviewed, you could have bought the bottom on S&P on NASDAQ, correct? Since first week in April this year. And you could have bought the bottom on Tesla, despite catastrophic earnings and Euro. So many options on IBIT, correct? So yes and yes and yes to options with Alpha Fibonacci system. Absolutely. Yes.
Okay. Very good. How have you had any students that are in India?
Yes, Sue. When you're looking at this lady that I shared, she's spending a lot of time in India and she's from India. Let me click. And so is Deepak. And so is the other students on top of my head. This is Sue. Yes, she lives between India and US. Of course.
Okay. Well, I
Yeah.
do want to say thank you for coming in and joining us. I appreciate the time you spent with us today, and we've got all the links put in the chat, so give it a click.
Thank you, Jeffrey.
Thank you,
My
Alla.
pleasure being with you. Have a magnificent day. Thank you so much, everyone. Thank you.
Okay.
Take great care. Bye-bye.
Bye. Okay, let me go ahead and do this. I'll turn on my camera. Go ahead and go to the share screen option. Okay. Okay. All right. As we kind of move on, I want to say thank you to our sponsors today, Stocks and Commodities Magazine. You can find them at traders.com. We've talked about Stocks and Commodities before. It's a great magazine. Absolutely love the work that they've done over the years. The support that they've done for Metastock. They've made almost 17,000 articles and 1.3 million subscribers. They've been publishing since 1982. A subscription for a year, I think, is around $100. You can find out for sure at traders.com. A big thank you to Stocks and Commodities Magazine for sponsoring the events that we've done. And they've been consistently sponsoring them since 13 or 14 years now. So we do appreciate all the work that they've done with us over the years. If you haven't yet, make sure you join the Traders Forum. One of the things that we do is that's pretty cool in the Traders Forum is we'll bring in a special guest and we'll just do a podcast style interview. In fact, our next guest, Larry McMillan, has done one. We had one with John and Jack Kosar a couple weeks ago. I asked Jake if he'd come back in and do one with me. Again, it's been a little bit of time since we've done him. We just talk about the markets. We talk about what we're seeing in the markets. We talk about all kinds of really cool stuff. In addition to that, there's live market chat. You can come in and talk to other traders about what you're interested in. There's all kinds of market education, and all of that is absolutely free. And you can go there and do it at thetradersforum.com. So if you haven't done it yet, I'd recommend that you get a membership. It's free. It won't cost you anything, and you can come to the next podcast we record. So in terms of Metastock, we've been talking about Metastock all day. It's been rated the best software in its price category for 32 years in a row. It'll help you scan through markets. It allows you to focus on the opportunities. You can test trading ideas. Kelly did a great job of showing that earlier today. We've got a forecaster. We're going to show that off on Wednesday. You can get real-time alerts, commentary, signals. It's a great toolbox. Again, 32 years in a row it's been rated as #1. The pricing starts at $75 a month. If you pay for a month, we'll give you the second and third month for free. That means it'll literally cost you $25 a month to get started. And you'll be running until August 18th. We'll sit down with you. We have a one-on-one service. We'll sit down with you. We'll track you through the software. And if you don't like it, there's no commitment to keep it. So to do that, to join all the other customers that have been using Metastock for decades, metastock.com/conf promo. If you have questions and you want to get some more information, give us a call. If you're in the US and Canada, you can do it at 800-882-3040. You can go to metastock.com/salespchat. I wouldn't trade without Metastock. There's a reason it's been rated #1 in its price category for 32 years in a row. Now's a really good opportunity for you to try it at a very low risk, $75 for 3 months. So during that time, we're going to give you our training. We're going to give you one-on-one. We're going to give you unlimited access to support. We're going to invest in you. We want this to work for you. So again, metastock.com/conf promo, metastock.com/salespchat, or 800-882-3040. So our next presenter is here. His name's Larry McMillan. Larry has been a big friend of mine for a number of years. He's spoken at the conferences that we do for a long time. He wrote what a lot of people consider one of the cornerstone books about options trading, options as a strategic investment. He runs some advisory services. He does a really good job, and I'm interested to see what he has to say today. Larry, how you doing?
I'm good, Jeff. Can you hear me all right?
I can.
All right, good.
Before you sound great too. Before I let you go on and talk to us, I was wondering if you could do me a small favor.
Mm-hmm.
I have, as you know, we give away prizes routinely. I have this book right here. I'm going to send to somebody. I just need you to tell me who it will be. And by the way, the book is Around the Horn by Dr. Adrian Matz. It's a great book. It's hardcover. I will go to the post office and send it to somebody. Larry, what I need from you is I just need a number between 2 and 4,629.
All right, 1,393.
1, 3. Oh, I did not do that right. 1,393, right?
Yeah.
Okay. That is J-nth R. So J-nth R, if you're listening, you just want a book, I'm going to email you as soon as I get Larry going right now. And just if I need your address, I'll print it out and take this to you. Take this to the post office, and then they'll take it to you next week. Larry, I'm going to go ahead and make you the presenter now. So it's going to pop up and ask you if you want to share your screen.
All right. I'm not seeing that. Am I on the wrong place or something? Oh, I see.
All right.
So, share.
Perfect. I'm going to go ahead and turn off my camera. I can see the screen presented, the current state of the markets, predicting option indicators. I can see it.
Okay. So
I will get out of your way.
All right. Let me just see. So if I draw on the screen that way, no, you can't see that. What if I draw on the screen? Oh, I see. Maybe I had the drawing tool set. Do I have to do them over again, or?
I can see where you're pointing at your screen.
Yeah.
I don't see anything actually being drawn though.
Yeah, it's like PowerPoint is sort of subservient here for. Let me just see if it's not advancing the screen either. So,
I think I know what's going on. I think you're looking at the preview screen that GoToWebinar shows you and not the actual PowerPoint.
What am I supposed to be looking at?
I think you're looking at the preview screen on GoToWebinar if it's not advancing. So I think maybe hit Alt Tab and go to the actual PowerPoint instead.
So can you see that?
Mm-hmm. It's now animated, which it wasn't before.
Wait, can you see that line I drew on there?
Yes, I can see that too.
Okay, great. Oh,
correct.
Super.
And your artistry is amazing.
Right. Okay, so we're going to spend a little time talking about the market. Just a little bit about our company first. Started out as a derivatives research firm, which we still are, selling research, publishing newsletters, selling data, that sort of thing. We moved into money management around 2008 after some pretty good calls around the financial crisis, and we still are a CTA and an RIA with a pretty specific option-oriented strategy. And then we also do a certain amount of option education, seminars like this, and also mentoring. I will come back to this later, but we will be sending you the PDFs of the presentation. And by plural, I mean one is in black and white, or grayscale, I guess, and the other is in color. So if you want to print it out, you can use the grayscale one. I'll come back to the special offer later on. So we're going to take a look at our favorite indicators. The foremost one being the chart of the S&P 500. That is the market. So if that says one thing and your indicators are saying the other, you need to rely on the chart more than the indicators, at least at that point in time. We'll also look at put-call ratios, both on the broad market and on individual stocks and some futures. We'll look at market breadth, which has just given us a new signal recently. And then we'll spend some time with the volatility indices, VIX, and various things regarding VIX, including the term structure and of the futures, which can also be a good indicator. So I have a couple of rules of thumb. One is oversold does not mean buy. So we don't really have anything that's oversold right now. But a corollary is overbought does not mean sell. So this market has been overbought for some time. And it only now, just a day or two off the highs, is actually giving sell signals. So if you sold the first time it was overbought, maybe like in really almost early April, you'd be buried by now. So You don't, just because something is overbought, you don't really want to take a bearish position on it until the indicators or the market rolls over, the indicator rolls over, and you get a confirmed signal. So you'll see several examples of that along the way. So here's a longer term chart on S&P, just so you kind of can gauge some things. This, we started out, much lower a couple of years ago. We had a nice big rally all along the way, and then this last rally here has been amazing. Since the end of March, we've really rallied over 1,100 points. It's a huge amount for the S&P. You can see though, last April we fell drastically in just a short period of time. So volatility does spring up, even in what appears to be an ongoing bull market. There's been a couple of more modest corrections. The one that just ended there in March was about a 9.5% correction, and then we had one back in on the left side of the chart here in right here, another 9%. So we've had a few corrections along the way, but the market really has been quite bullish. And if you were going to sell, you had to be quick to buy back in most of these cases. Here's a 1-year chart just to examine a couple of other things. These circles are gaps on the chart. Now, not all gaps are filled, and otherwise we'd have some. There's some. If you look on the left side of the chart, there's gaps way back here. I don't think those are going to be filled anytime soon. But we do have these gaps here, and sometimes when the market does fall back into a gap, it'll find support near the bottom of the gap. So the very first support level would be the bottom of this first gap, right about here, about 72.75. Then we had a little working area in here between 70.50 and 71.50. And of course, the major previous top at 7,000. That had been tested several times back there in February and March, or January, February actually, and then it held. So it made this correction, but when we came back up the next time, we broke right through there. So that's a very significant area. If we pull back to there, people who missed the first time will certainly be jumping in the second time. But if it should fail and fall below 7,000, then that would be really negative because everyone who bought up here would be trapped. And so I don't think that's going to happen, but it's definitely something worth keeping an eye on. And as noted, that 1,100 point rally in 6 weeks, it's rather unprecedented, and it created a bunch of overbought conditions. And you read things in the media all the time about, oh, the S&P has never advanced this far, while 5% of its issues are, whatever, declining. It doesn't make any difference. They're all just examples of an overbought market, but overbought does not mean sell. You have to wait for confirmed sell signals, which in the case of the S&P chart is really a break of some support, depending which level you want to talk about. Clearly, a break of 7,000 would be very negative. So earlier, maybe a gap that doesn't hold and you fall below that, maybe you close below 71.50, that sort of thing. But right now, this is a bullish chart. It's still rising, and even after today's action, where it rallied back on the close, it's still a bullish chart. So this pretty much just says the same thing I was just saying. But remember the examples of the indicators we're going to talk about. This is the first one, and this is the most important one, and it is bullish. So that is something to that's where you pin your basic strategy from, and then go from there. So another thing we do with the chart is we draw what we call modified Bollinger Bands. Regular Bollinger Bands use as their definition of volatility is the standard deviation of daily closing prices. And that's logical, but not what the math guys use. So Black and Scholes and other mathematical models use a standard deviation of daily percentage price changes, and that's what's producing a slightly different Bollinger Band. So we use that because our definition of realized volatility has to line up with the definition of implied volatility that's coming out of the Black-Scholes model, and it would just, it would be a mess if we didn't do that. So we draw these bands around the chart, And if the market moves outside the plus or minus 4 standard deviation band, then that sets up a signal. If it moves back inside, you have a chance to get an actual buy or sell signal. So here's the chart going back a year. The red letters are successful signals. So you can see most recently here we moved below the minus 4 standard deviation band. That's this one right here. And then move back inside the minus 3 standard deviation. That's that one right there. And in doing so, so that's minus 3 sigma. This is minus 4 sigma. In doing so, that created a buy signal. And once you get the buy signal, your target is the opposite band, and it rose quickly all the way up to the plus 4 standard deviation band and completed the buy signal. Then it kept on going and had a fake sell signal. The blue letters came outside the 4 sigma band, went inside the 3 just briefly, and came back outside until today. And so just today, we got a new sell signal right here. We were outside the 4 standard deviation band, and then we moved inside. We didn't. It's not a closing price. It's just where it trades during the day. So this is a new sell signal that we have here, and it will. Its target is that minus 4 standard deviation band, which you see is down here. It's around just below 7,100 now. But it's rising very rapidly. So by the time we get to it, might not be all the way up in here somewhere. It could be a short-lived signal, and it would be stopped out if we went back above the plus 4 standard deviation band. But right now, our services, our various newsletters that follow these signals, have taken a short position based on that. So that happened this morning, actually. And so, as I said, the target is that lower band. We have a long and profitable track record here. You can view it on our website. We've been using this system for 20 some years, and it's up substantially in that amount of time. And so I don't ignore these signals. They don't all work out. I don't think there's any indicator that all the signals work out, but this one is newly bearish. Now, we also can apply this same logic to any chart, stock, futures, index. And so we have a subscription service where we send out every day a list of anything that's giving a new, buy or sell signal based on this indicator. So if you're interested, when you poke around our website, just look for the MVB service, and you'll see some examples of that. And it's, I believe, a free subscription is available. So the next thing I want to talk about is put-call ratios. So put-call ratios are based on a contrary theory discovered by Marty Zweig back in the 1950s, and that was if there's too much put buying going on, then that's actually bullish for the market. If there's too much call buying, then that's actually bearish for the market. So he used to get his call volume and put volume out of the ads that ran in Barron's every Sunday, placed there by the broker, put and call broker dealers at the time. And it was just a few hundred contracts of each. Now we have thousands of contracts trading in the first minute of trading every day and millions trading in the week. But the concept is still the same. Most of it's noise, but if we get a too much situation, then it's worth looking at. So defining what too much is of course, the crux of the matter here. If we're looking at the broad market, we use the equity only put call ratio to protect the broad market. I'll show you why in a minute, but that's all stock options that trade. So, millions of them really every day. So the standard put call ratio is very simple. We just, at the end of the day, we sum up the volume of trading in the calls of the stock, and we sum up the volume of trading in the puts. We divide the, down here. Why do I keep losing that thing? There it is. We sum up the volume of the puts and sum up the volume of the calls. Divide the two. That's the put call ratio. So since puts are in the numerator there, heavy put buying generates higher put call ratio numbers. And since calls are in the denominator, heavy call buying generates lower numbers for the put-call ratio. It moves opposite to the stock price. We keep a moving average 21 days just in case there's something to Fibonacci. And in theory, it looks like this. So if the stock is moving down every day, people will be buying puts, and they're right, and that's forcing the put-call ratio higher. Eventually, the put-call ratio though reaches a local maximum, and that is a buy signal for the stock. So then the stock starts to go higher. People are buying calls at that point. That forces the put-call ratio lower. Move to the left side here. Put-call ratio is going lower as people are buying calls. Eventually, you get to a local minimum on the put-call ratio, and that's a sell signal for the stock. So that's the theory. We publish on our website in an area called the strategy zone. We publish over 1,600 put-call ratio charts every day, and each one of them has the stock price chart and the put-call ratio chart, so you can compare the two and look for this inverse symmetry. If the inverse symmetry is not there, then something else is going on, usually arbitrage or dividend arbitrage, something like that. This is not a current chart, but on the top is the S&P 500 index, and on the bottom is the put-call ratio of all stock options that trade. So you can see the inverse symmetry that exists there, and that's why we use the equity-only put-call ratio, the bottom ratio there, to predict the broad market. So where are we right now? Well, we had a buy signal from a pretty decent level of height on the chart. So that's right here. We see we got the local maximum. That's the buy signal right about the time the market was bottoming. And it's been on this buy signal all the way till now. And you can see the rate of descent is starting to slow here. But according to, we have a computer analysis programs that look at these, look sort of like a chess playing tree, trying to predict where this is going in the next 10 days or moves or however you want to think about it. And so that the computers are not yet counting that as a rolled over or sell signal. So this is still in a buy signal, still declining ratio, but eventually it is going to decline somewhere down here and roll back over. Now, this low levels on this chart would be overbought conditions in the market. So we're getting into an overbought condition there. And high levels up here are oversold condition. You can see last April, that was the big, the taper tantrum in the market. Then we get the buy signal coming out of that, and that was a good buy signal. So that's what we call the standard ratio, just using the volume of puts and calls. With the advent of computers getting more involved in everything, we were able to compute the dollar weighted put call ratio, where we try to find out how much money is being spent on options, puts, and calls. So for each option at the end of the day, let's say it's IBM, I take the option price and multiply it by the volume traded that day. You could do that on a tick by tick basis. That's a pretty expensive data set, time consuming and power consuming, whatever. This seems to work just as well. We tried it the other way, and it was just a lot cheaper and faster. And so we do that for each of the options, and we sum up that dollar volume for all the puts, and then separately we sum it up for all the calls, and we divide the two, just like we did before, and that gives us the dollar weighted put call ratio, or just usually called the weighted put call ratio. And now we're measuring the dollars spent on bearish opinion versus dollars being spent on bullish opinion. Typically, the timing of this ratio and the one we just looked at is pretty similar, but the extremes can be more extreme. So we had this local maximum buy signal again near the lows, and then we've come all the way down, and we got all the way down here. So where this is actually the lowest, that is lower than all of last year, and lower than since early 2024. And now you can see that it started to curl up here. So to the naked eye, that might not yet be a sell signal, but to the computer analysis program, it is a sell signal. Personally, I would like to see a little bit more with the naked eye, because the computer analysis program uses a sort of return reversion to the mean theory, and we're down very extreme level on the chart now. So it obviously thinks it's got to revert to more of a higher level. So, but this is certainly signaling caution. It was in an overbought state. It is in an overbought state, and that now may be turning to a sell signal right here. We couldn't quite see it on that chart. It doesn't go back to March of 2025, but we had a similar sell signal back then. And by April, the market was heading swiftly down. So, we're cautious based on this signal right here, just in terms of whether it can give a confirmed sell signal or not. We should know in the next few days. So what option do we buy? Whether we have, let's say, a put call ratio signal or a modified Bollinger Band signal or whatever those signals, we typically buy SPY options, 1 or 2 strikes in the money. And the reason I buy them slightly in the money is because I want to have a delta that's larger than a half. A delta of 0 means the option doesn't move at all when the stock moves. And a delta of 1 means the option is so far in the money that it matches the stock price movement exactly. You don't need that. But I do like to have a delta up around 70 or so, meaning that if I'm right about the direction of the underlying SPY in this case, then I'll make money. It's not like I'm going to buy some deeply out of the money option and find that, yes, SPY went up, but not far enough to make money for my option. So typically do that. If I'm going a little longer term on some of the put call ratio trades, I might go up 3 months or so. Then I might buy an at the money option. But even that, a call has a delta slightly above a half. And of course, the delta increases as the underlying goes up in price, the delta of a call. So when do you spread? Most of the time on TV, if you see them recommend an option trade, they're spreading it. They're buying a call at a low strike. They'll buy a call at this strike and sell a call at this strike. And I don't know why they're so enamored with that, because that's not something you should normally be doing. Because what happens is, as the underlying moves up, you're making some decent money along the way, along here. But as soon as you get to the higher strike, you cut off your profit potential. Well, that's not good. I mean, either you need to make some adjustment there or something, but that's just not worth it. Now, when it is viable mathematically, statistically, is when the options are expensive. And so S&P options, SPY options have been on the expensive side for quite some time now, really since the market began to fall a year ago. They've really never gotten back to what I consider a cheap level. So we do spread SPY options. I'll talk more about that in a minute. But the proponents of spreading like everything say, oh, well, you're risking less. That's not true. You're risking 100% whether you buy a call or you buy that spread. The broker is going to ask you just to put up enough money to pay for the call or enough money to pay for the spread, and you could lose it all. So that's 100% risk. So yes, maybe you have a different dollar risk, but that's adjustable by just trading a different quantity. So instead of buying 5 spreads, you might buy 4 calls or something like that. If you own the calls, your profitability lies along that red line. And of course, the advantage is here, where it breaks out to the upside and you're still making money. You're not cutting your profit potential off. So if you do spread, there are a couple of ways that you can mitigate the negative aspects of the spread. One is to widen the difference in the strikes. So currently, if we're trading SPY calls, if I'm trading an expiration less than May 29th, I'm not going to spread it at all. They're not that expensive. But after May 29th, I do a call bull spread 20 or 25 points wide. If I'm thinking about doing puts, I have that be 40 or 50 points wide, because out of the money puts are more expensive than out of the money calls. That's just the way the indices have behaved since really since the crash of '87. The other thing you can do to mitigate the negative aspect is to roll if the short strike is hit. So what do I mean by that? So today S&P's or SPY is around 740. And let's say you wanted to buy a spread expiring in June. So you buy the 740 call and you sell the 765 call 25 points apart. That's great. So let's say you're fortunate enough, and this should read 765, and SPY trades up to 765. You sell the spread you own, and you roll both sides up 25 points, and now you're in a new spread, 765 to 790, and you continue to keep doing that if it keeps going up. So you're kind of doing this. You started out in the black bull spread. They're the black lines, and it was a 765 cap on that spread. So when you get up to 765, you rolled it higher, and now you moved onto this red line, and now your profit potential, instead of being cut off here, would eventually be cut off here. But if you get up that far to 790, you do it again and move it higher as well. So this I like this concept a lot because you're taking profits along the way. If for some reason the market falls back, you're only going to lose what you spent for the last spread, not the entire amount you spent initially, and you're pocketing credits all along the way. So that's we do this in all of our positions. Even if it's not a spread, we still roll up when we hit a deeply in the money strike. Let's say 10 or 12 points for S&P, SPY. And so one thing I did want to point out here, though, that the way that option prices are aligned right now isn't all that favorable. If we bought that June 740 call right now today, we pay $12.20 for it, and we get we get $2.40 for selling the 765 call. So we're paying $9.80 debit, and the max our spread can widen out to is 25, the difference in the strikes. Well, that's okay. You'd like to pay $9.80 for something that becomes 25. But as far as option trades go, especially spreads, it's not all that great. Let's look at the put side, though. On the put side, again, with S&P or SPY at 740, if we were going to do a put spread, we'd buy the 740 put and sell a put that's 40 points out of the money, the 700 put. So I mentioned earlier that we had that MVB sell signal. That's what we bought today, the spread 40 points wide in June. So here, now we're paying $8.80, but this could widen out to 40 points. Well, that's a much better max to initial ratio. So the puts are more favorably priced than the calls right now. It has something to do with interest rates, etc. And in this case, we do the same. If it went down to 700, we take the profit on that spread and set up a new one 40 points lower on each side. I want to show you some interesting individual put call ratio charts before we move on here. So this is Netflix. And again, when we're looking at the individual stock charts and future charts, we only trade the real extreme signals. So like a signal that's sort of in the middle of the chart or kind of, halfway around in the chart, I'm not that interested in that. Like that one right there, I'm not that interested in, or even this one here. But the ones at the extremes, I am. So Netflix gave a buy signal right here. That was a little bit premature, so that's marked with a blue. That means a losing trade. But then it came right back and gave another local maximum. It gave a buy signal there, and that was a good trade. But now there's been heavy call buying in Netflix all the way down, forcing the ratio down to very low levels, some of the lowest levels we've seen in the last year. And now the ratio has finally turned higher over the last few days. And so that's a sell signal for Netflix. So we bought puts on Netflix today, and we'll see. We'll see how it works out. That sell signal, by the way, once I do that, I don't really look at the stock chart so much anymore as I keep watching the put call ratio chart. So if it's still rising, no matter what the stock price is doing at that time, I'm still going to stay long my puts until it rolls over like that. And even in the middle of the chart, that would be a stop out for my long puts. But we keep you informed of these things daily or weekly, whatever kind of newsletter you're subscribing to. Another one is Hershey. This gave a buy signal late last week. And here, I'd like to see it get above that red line there. I believe that's 197. So if it can get above 197, that'd be great. And I'd have a confirmation of the chart with the higher highs and higher lows, along with the put call ratio buy signal. So today, Hershey was up almost 5, but it's still only at 191. So it's not ready yet to break out to that new relatively high. But if it does, we'll be buying calls. Air Products, this is another one that just got down to really, really extremely low levels on the put call ratio chart. A lot of optimism was going on. And now it's given a sell signal. So we have bought puts on this last week. And it's moved down a little bit, but you can the last sell signal way on the left side of the chart there was good, but only for a short period of time, sharply down, and then that was sort of it. There were a couple of decent buy signals in the middle, but those don't really concern us at this point in time. Duke Power, Duke Energy is given a buy signal. This is the third one in the last year from roughly the same level. 90 means that $90 are being spent on puts for every $100 being spent on calls, which for a utility is quite a bit. And this has a pretty good track record. You can see the red letters that are all pretty successful signals. The one blue S is not successful. And of course, the newest signal is marked in green. LabCorp Holdings, this is another one, just gave a buy signal, broke to a new low on Friday, even though it had just given a buy signal. But today, I think the stock was up. Let me just check. Yeah, the stock was up 6 and 5. So there's a new buy signal in that one as well. That's an expensive stock, but you don't have, you can buy. We typically, even with these, try to buy an at the money option just to keep our delta fairly high. If the option is too expensive for you, then you might consider spreading. Now, crude oil, this is a chart of crude oil put call ratio based on crude oil futures that trade, I think they trade on the COMEX. But this blue line down here is based on put call ratios of crude oil futures options. So you can see it came down to it wasn't doing anything while the last few months were going on until the war started, and then of course the market took off and people started buying calls and forced the ratio all the way down here to extremely low level, and then it bounced. So that's a sell signal. It's a local minimum sell signal. That was right at the peak, but really it was pretty short-lived, and now we're kind of coming back up here. And what's happened is the ratio rose along with that for a little while, but now it's formed a little local maximum there. That cancels out that sell signal. So I doubt if you really could have made much, if any, money on that unless you got out somewhere in between. But if you're just using the put call ratios, you could do that. Now, the interesting thing here is there is an ETF, that is the same as the price of crude oil. And they trade the futures. So the chart of USO looks just like the chart of the continuous futures. And so even if you didn't have a futures account, you could trade this one. Now, this one you couldn't. This is cotton, and it just now is given a sell signal here at a very low level. You can see that there was a really strong bullish move in cotton over the last couple of months. And now we've reached a local minimum and a sell signal. It dropped sharply on Friday. Here, though, there is no corresponding ETF that trades on CBOE or anywhere else. You must trade, if you want to trade this, you must trade the futures options that trade at the ICE. And let me just say, trading futures options at the ICE is not a fun thing to be doing, but you might be able to buy some anyways. Let's move on to market breadth. So market breadth is simply advances minus declines every day. This is stocks now. The number of stocks that advance minus the number of stocks that decline. You can keep a cumulative total, and you can also keep an oscillator. So we do both. Our oscillator value, today's value, is 90% of yesterday's value, plus 10% of today's advances minus declines. Now, the interesting thing about breadth is what data set do you use? So, there's the old New York Stock Exchange data, which is everyone's familiar with that, and it's pretty readily available for free. But there's a lot of things on the New York Stock Exchange that are not stocks. There are a lot of convertible bonds and other things that trade a few ticks here and there, and that can distort the advances and declines. So we also like to have a stocks only oscillator. And while the New York Stock Exchange does put out a operating companies only data, we realized we had a much better data set. That's all stocks that have listed options. There's over 6,000 of them now, and it's a very robust data set. A lot of NASDAQ, big stocks, small caps, whatever. Everything's in there. So we use that, and we keep the oscillator, and we keep the cumulative totals too. So here's the oscillator chart going back to 2018. When it's in the red area there, it's overbought. When it's in the green area, it's oversold. You see, it hasn't been oversold all that much since 2018 because mostly the market's been going up. But there was a period of time there in 2022 when we had the bear market, and there was a lot more green at that time than there was before or since. But anyway, recently when we sold off, we did get to an oversold condition in late March. Now remember, oversold does not mean buy, so we don't buy until it stops being oversold. So we bought on March 31st, and then we held it, and it got very overbought then, this red area up top here. And we finally just now come back down out of the red area. And this was the first indicator that we had that gave a sell signal. This was last Tuesday, I think, Tuesday or Wednesday. So that gave a sell signal, and we took a bearish position based on that. So we actually have now two indicators that have confirmed sell signals. This one and the MVB that would just occur today that we showed you the chart of earlier. So again, breadth has not been all that great in this whole, this part of the bull market. It was earlier on, but it hasn't been recently. And so that's it. I don't know. You can't use that as an indicator, but it's just sort of an indication that there's a lot of stocks that aren't keeping pace, and the ones that are leading the market are fewer than you might expect. But I don't think that's a real surprise to anyone. You all know that the AI stocks and the semiconductors are just cranking here, and a lot of other stocks are having trouble. But in any case, these breadth oscillators are very short-term signals in our arsenal, the shortest term, in fact. And so they are subject to whipsaws, but that's this Thursday, May 11th. May 11th, not Thursday. I think it means it should be Tuesday. Anyways, this is on a sell signal, and we've acted on it. So we're holding a position there based on the bearish oscillator signal. Now, the other thing you can do with breadth, I said, is accumulate it. So you just keep a running total, and running total on New York Stock Exchange breadth to reach an all-time high on May 6th. In fact, same thing for stocks only breadth. Same thing for volume too. So if we take a volume on advancing issues minus volume on declining issues and keep that cumulative total, those all reached all-time highs on May 6th. And so did the S&P. So that was like everybody was in the party room having a great time. Since then, these have not kept pace. The one with the stocks only has, but not the others. So there's a very minor divergence taking place here where S&P went on to make a new all-time high a couple of times since May 6th, but not these indicators. And the 2022 bear market started with a pretty wide 2-month divergence from these indicators, and if we were to see that, that would be alarming. But this doesn't really mean much at all. It's just a tiny little divergence, and besides that, not every bear market starts with a negative divergence, anyways. So another thing we keep track of is new highs versus new lows. There's 3 sets of data shown here: the New York Stock Exchange, stocks only, and NASDAQ. We use New York Stock Exchange for our signals, and you can see on the right here our signals have been they're infrequent. So, but you hold for a fairly long period of time in some of these cases. We were long at the bottom of this column here on the very lower right. We were long on April 9th, and that position was stopped out on May 13th, which was last Wednesday. And so that signal was a pretty good one. Made some money on that. And now we're waiting. So this indicator right now is in a neutral state. We're waiting to see will there be 100 new highs 2 days in a row, or 100 new lows 2 days in a row. Either one would create a signal. And so far, it's been kind of bouncing back and forth. We had, I think today, let's just look here. I didn't really see the final total. But now it didn't look like either 100 new highs nor 100 new lows today. So this indicator is in a neutral state waiting for its next signal. So let's finish up by talking about VIX and what's going on there. I think VIX is interpreted George Bush thing there, interpreted many times. But the trend of VIX is very important if we look at the chart of VIX. And also spike peaks are important as buy signals. So here's the 1-year chart of VIX. And the red, we have a system based on these spike peaks. So the red letters are successful signals that we traded. The blue letters are signals that we traded that were stopped out for losses. And the yellow ones are we did not trade. We don't trade a whole bunch of them in a row. If we're in one, we just stick with that one. So right now there's not been a spike peak in VIX for quite some time. A little bit surprising. I'm assuming that if this market were to sell off halfway sharply, we start to get another quick rise in VIX. But perhaps more importantly, there's no trend to VIX either. So that pink circle there shows you that the 20-day moving average, which is this one right here, and the 200-day moving average with this one right here are like right next to each other, and so is VIX. They're all just bunched in there together. And so there's no trend out of that. What we define as a trend is if the 20-day and VIX are on the same side of the 200-day moving away from it. So if they're moving above it, that's a sell signal for stocks, a buy signal for VIX, I guess. And if they're moving below it, that'd be a buy signal for stock. So either one could happen here. It's unclear. Today, VIX spiked up to 19 and change, and then came right back down and closed negative on the day. So even though the market sold off pretty sharply in the middle of the afternoon, VIX wasn't buying it. But then on the other hand, normally when S&P is making new all-time highs, as it has been, VIX would be down around the 14, 15 low. You can see last December got all the way down to almost 14. So the fact that it's hanging out here around 18 is an indication that big money players who trade SPX options, which are based on the full 4-digit SPX contract, are somewhat nervous. And so they're paying up for puts, even though I'm sure they're buying stocks, but they're buying puts as well. So they're buying puts, that elevates the price of those puts, that elevates the price of VIX. VIX is based on the price of these S&P options, SPX options. So there's really no conclusion here either. This is basically a very neutral situation. There's no spike peak and there's no trend, but there will be. And so this is something we watch every day. And VIX has been a very good indicator for us over the years, and when things get really crazy, there's some very interesting strategies that can be employed. None of those are apropos at the current time, but they will be. Next time we head down quickly, something will start to happen. So you can't trade VIX, but you can trade VIX futures. And so one of the things we can do is look at how the VIX futures line up with each other. If they look like this, the farther out you go in time, the higher price they are. That's called an upward sloping term structure. And that's bullish for stocks. And that's the way things are most of the time. But occasionally this happens. It happened in April of 2025 pretty badly. It happened in February of 2020 in the pandemic really badly. It happened in the crash of 2008, the financial crisis, really, really badly. And so when that happens, it's time to head for the hills. So when you start to get this inversion in the term structure. Where are we right now? So May, the futures, May is the near-term future, but it's expiring tomorrow morning at 8:30. So that's marked in white. I wouldn't pay too much attention to that. It's done. VIX itself closed at 1782 tonight. So here's June. So June futures closed at 2026. If we subtract VIX from that, that's $2.44. So that's the premium on the future. And that's going to be the front month futures beginning tomorrow. You can see that each futures contract is slightly higher priced than its predecessor. So that's a slightly upward sloping term structure, and all the futures are trading at a big fat premium to VIX. So those are all bullish things. Maybe you'd want to see the term structure be a little steeper, but in any case, that is a bullish, what we call a construct. Here, if you don't, the futures prices you can get from the CBOE futures website, or you can just look at the indices that the CBOE publishes. They publish these 6. They publish a 1-day VIX. That's mostly useful if you're trading the 0-day expiration options. They publish a 9-day, a 30-day. VIX itself is a 30-day volatility estimate, a 3-month, a 6-month, and a 1-year. You can see here now these slope upwards even more steeply, and again, that's bullish, upward sloping term structure. So the term structure is right now telling you no problems, everything's sloping upwards. As I said, the front month is now June, starting tomorrow. So we'll be watching June versus July. If June should rise above July, that would be a problem, at least by any significant amount. Maybe a couple of pennies doesn't mean much. But right now, July is well above June. And so that's that's still bullish for stocks. We did have this thing invert this past March when stocks headed down, that 9% correction, but it was fairly short-lived. And even last fall there was a slight indication of it, but again short-lived. So I think there's some people that are trying to exploit this just to see if people will jump in, and when they don't, they reverse their positions. So here is a summary of everything. So anything on the left side here is bullish. Well, we saw the S&Ps are making new highs, not far from new highs, so that's bullish. The only other really bullish indicator we have right now is the one we just looked at, the construct of volatility derivatives. We have some negative indicators that we saw today. We got this sell signal from MVB. I just showed you we had a breadth sell signal. And the put call ratios are kind of moving that way. We saw, they're very low on the chart and beginning to turn upwards. So that would be a sell signal as well. Everything else has no signal. New highs versus new lows. We just looked at that, and there's no signal there, waiting for 100 issues one way or the other. Realized volatility, we didn't really talk about that, but it's in a very modest place right now, not giving a signal. No VIX spike peak. No trend of VIX. So we got a lot of neutral, a little bit of bearish, more newly bearish than anything else. But the chart of S&P is still bullish. And as I said in the very beginning, that if you have some mixed indicators, you rely on the chart of S&P, it's usually right. So that's what I would suggest doing at this point in time. So if you can take these signals as hedges or short-term trades or whatever, these sell signals, but I would be I would not be in agreement with just going completely short the market right now. Another thing we do, as I said, with those spreads, we roll them up when they reach the higher strike, but we also roll any calls up or puts down when they become deeply in the money, which for us is 8 to 10 points for a SPY option, usually the same amount for a stock. So we do a lot of that as well. And again, that just keeps locking in credits along the way. Well, now I'm going to return to the offer. We're offering our 1 month each of our top 3 newsletters for a total price of $99. Typically, that would cost you about $640. We will send you the PDFs of the webinars, whether or not you take up on our offer. But if you go to this website, optionsstatus.com/metastock, you can see the offer. You can look at the newsletter. So the first is daily volume alerts. That has all the indicators that we talked about today, plus an occasional takeover that might be spotted with unusual option volume. There used to be more of that than there is now. There was enough of a crackdown, I guess, in negativity associated with tipping the trades in advance. It hasn't been that way too often. We did see some activity in eBay last week. We saw pretty good activity in Warner Discover before that was taken over. And so occasionally it still happens, but mostly daily volume alerts. That comes out every morning. I write that one myself, and covers all as a market commentary every day, and then a summary of these indicators. The Daily Strategist is our premier newsletter. It comes out twice a day. In the morning is a regular report, has a market comment in it that I write, but I don't really write the rest of this newsletter. That's one of our other traders. And it covers a variety of strategies, pretty much all the strategies that we have talked about in our newsletter. So it could be straddle buying, momentum trading, put call ratio signals, naked puts, any of that sort of thing. And also then the second report that comes out every day is what we call the volatility report. So that looks for differentials in volatility that might be exploitable in terms of either option spreads or just trading VIX in the market like that. And then the third newsletter is the Option Strategist, which is our oldest publication. I think we're in our 37th year. It probably says on the next page. Anyway, that comes out once a week. And I try to write an article or two, an educational article in there as much as I can. Last week we talked about some longer term aspects of the put call ratios. On those put call ratio charts we showed, we got down to very low levels. Well, what happened the last time we were at those low levels? Something like that. And then sometimes it's more educational. There's a strategy out there where people are doing boxes and taking credits out of their accounts, and so we explain how that works. And anyway, whatever could be of interest, more than just the ordinary, how do you buy a call or something like that. So you can take these consecutively if you want, because there's a lot of information. So if you're going to take a trial and make a decision, you probably don't want to take all 3 at once. I guess it's our 35th year publication. There's a full track record on the website or in the newsletter. The Daily Strategist has a track record on the website. So does volume alerts. Keep in mind that past performance is no guarantee of future results, and there is a risk of loss in all of our trades. These are often pretty aggressive trades. So we recommend, each small portion of your portfolio goes into each trade, and not heavily leveraging up or anything like that. I have a YouTube channel. We record a YouTube market comment every Monday morning. You can subscribe to that if you want. We also have a newsletter that strictly focuses on riding deeply out of the money puts with high winning percentage. Obviously, when it's what you do with the losers that counts, but it has a good track record too. And we also have a letter that deals with special situation alerts. So I mentioned this longer term put call ratio. I'll just talk about it for a second. So that square on the right hand side there, that's the weighted put call ratio chart, equity only weighted put call ratio chart that I showed you earlier. Remember, I showed you it was at the lowest it had been since all of last year. And in fact, going back here to this point A, which is point A is right here. That's in 2024. But you can see that it's very near that same low. It keeps when it gets and makes those lows. It eventually gets to a sell signal, here, here, and way back here, various amount of times. And sometimes we got a huge correction out of that, a pandemic, the bear market, sometimes a modest correction. But in any case, when it turns upward, which it seems like it's about ready to do, you really can't ignore the signal. So you have to take it, even if you're bullish or the S&P is bullish, the chart is bullish as it is now. These trades can develop well, and if they're not going to develop, it'll turn right back down again and stop you out. So it's not like we're in these trades for months on end and just staying short the market or something like that. We buy puts, and that limits your risk right away. And then, if we get stopped out, hopefully the puts still have some value, and you would have a limited loss on a losing trade. In any case, I was going to wrap it up. This is my contact information. At the bottom there is our money management URL. If you're interested in money management, I just want to tell you that our minimum account size is $100,000. So, Jeff, how do I turn it back to you?
That's my job. Okay. I'm just putting we did have a couple questions. I'm just putting the coupon code in as well. Let me go ahead and look at the questions real quick.
Hopefully you won't need the coupon code, but you never know.
Okay. Let's see. John wants to know, does an increase in volatility always help an option regardless if it's a put or a call, short or long?
I'm sorry, I missed that. What did you say?
He wants to. John wants to know if volatility goes up, does it always help an option price, whether it's long or short?
Yeah, if it drops, you said.
If the volatility increases, does that help the price of an option?
Okay. So, well, yeah, obviously, if volatility is increasing, all options can get expensive. In fact, one of the classic examples was in the crash of '87. The volatility went up so high that some of the out-of-the-money calls actually gained value, if you can believe that. But it was true. I talked to a market maker at that time. He was like, he had some deeply out-of-money calls. He wasn't even paying any attention to them. He happened to look at them, and he realized they were up in price. Not a huge amount, but volatility increased so much the calls went up. So, but it can hurt you on another way too, though. If you buy calls on the S&P 500, let's say at a real bear market bottom, you're paying a pretty high volatility for those calls. And as the market starts to rally, that's good for you. The market's rallying, but volatility drops, that's going to hurt your calls. So it's like you're a salmon swimming upstream. So yes, the volatility can change and can affect your long or short position.
One wants to know, is there a website where he can find the put call ratio?
So as an individual figure, CBOE puts out what they call the equity only put call ratio for all options that trade in the CBOE. And that's somewhat useful. But for individual stocks, I think all that you can get it on our strategy zone, and it's a pretty cheap service, like $25 a month. But I'm sure anywhere else that you'll be able to get it, you would have to pay for it as well.
All right. That is the end of the questions, Larry. I appreciate you coming in and spending some time with us on a Monday afternoon.
Yeah, thanks for having me.
Of course. All right. I'm going to go ahead and kind of take over the screen share, and we'll get a move on, if I can. Okay.
Do I have to click something or no?
Yeah, I'll. You can just actually just exit if you'd like, or I can eject you as well.
All right.
All right. Okay. All right. As we move on, I want to say thank you to Stocks and Commodities Magazine for sponsoring the events that we've done. Again, I've said it probably 15 times today, but I appreciate all the work that they've done. I appreciate the fact that every month I get a magazine that talks about different technical strategies. Very, very good magazine. They've been publishing it since 1982. Pricing on it is, I think, about $100 a year. You can get a copy sent to you if you go to www.traders.com. One thing to mention about the membership is once you have a membership, you have access to all of the articles they've ever released. Well, 17,000. I don't know about all of them, but you'll have access to 17,000 articles. So in addition to that, I'd like to encourage you to join the Traders Forum. You can do that at thetradersforum.com. It's a growing community of traders where we talk about the markets, we talk about trading, we talk about technical analysis, we learn a lot, and we talk in an unusually large amount about how much we like sampling Costco goods. So if any of that sounds appealing to you, you can sign up for a free membership at thetradersforum.com. And I do want to reiterate all of the specials that we're talking about throughout the week, including the extended trial for Metastock. You can get at metastock.com/conf promo. You can call us at 800-882-3040 or go to metastock.com/sales-chat. I'll make sure those gets posted in the chat in just a second here. Our next guest is Jeffrey Tompkins. Jeff is a friend of mine. I think he's been doing business with us, if I'm not mistaken, for 8-9 years now. So an established partner. When we started to do business with him, he was doing a lot of training with people on how to trade on a website service called udemy.com. He was one of their most valuable partners. In the time that I've known him, he's become one of our most valuable partners. In addition to that, he has opened up his own hedge fund, and he's just doing great. He's also a great guy, very easy to understand, and like the speaker after him and me, has a great first name, Jeff. So without further ado, Jeff, before I get you started, I'd like you to help me out with something, if you don't mind.
Yeah, great to be here, Jeff.
Yeah, good to have you here, Jeff.
I'm at your whim. Let me know what you need me to do.
Now, I'm curious, do you prefer like Jeff or Jeffrey?
I go by Jeff.
Yeah. Now, if somebody calls you Jeffrey, does it get your attention? Like you're in trouble with your mom or something?
I probably think they're talking to somebody else. No,
okay.
I don't think anyone's ever called me Jeffrey.
Okay. Is your official name Jeffrey?
It is. My legal name is Jeffrey. Yeah.
All right. I'm going to introduce you by Jeffrey from now on.
It works for me.
All right.
What are you, Jeffrey?
Yes. But REY.
Yeah. REY. Yeah, I'm REY also.
Right on. Okay. Yeah. Well, I'm glad the audience knows. All right.
So we have a third Jeff on. You said there's three of us.
Yeah, Jeffrey Scott is after you.
Oh, there you go.
Yeah.
All right.
And you're going to help me give away a prize. We're going to give away a TechnoTrader course. There's only 3 of these that are available. It's a course. It's an actual seat of a live course, I believe. It's an advanced market structure course. Using professional money management, but move behind the scenes and recognize footprints in your charts. Support and chart and analysis toolkits are included. So you actually get some Metastock tools as well with that, if you're lucky. Now, Jeff, what I need from you is I need a number between 2 and 4,629.
Oh, okay. Let's go with 2,727.
And that would be Bill H. In the USA. So I'll send that information over to TechnoTrader as soon as we get done here, and I'll ask him to get you set up. I had something else that I was thinking about that was, it's gone. All right, let's go ahead and get you started here, Jeff. I'm going to turn over this the presentation to you. And you should be able to share your screen.
All right. And you should see it.
All right. Crack the hidden code. Crack the hidden code. All right, Jeff. I can see you. Oh, I can see your screen. I can hear you. You sound great. I'm going to go ahead and get out of the way for now.
Excellent. All right. Well, thanks again. Great to be here. And welcome, everybody. Pleasure to have everybody on today. I'll be revealing a very simple hidden number that can help us reliably forecast markets. But more importantly, I'll show you how we can actually use this to make more accurate, confident, informed trading decisions. So before we dive in, I'll just cover a quick risk disclosure and disclaimer. Trading securities and options involves risk. Prior to buying or selling an option, an investor must receive a copy of characteristics and risks of standardized options, and of course need a broker to trade securities and options and must meet suitability requirements. We will be covering some various results on our session today. Anything that I do share in terms of results, just know that due to the time critical nature of trading, brokerage fees, activity of other traders, so on and so forth, don't guarantee that anyone will mirror that performance. So past performance is not necessarily indicative of future results. All right, with that out of the way, by the end of our session, you're going to discover one simple statistic that has the power to transform your trading. And the secret number is hidden in every options trading platform. I'll show you where to find it, how to use it to stack the odds in your favor on every trade that you place. And this really applies even if you don't trade options to equities, ETFs, any optionable security. So this isn't only for options traders, but if you are trading options, this is a must-have. So whether you're just starting out or you're a seasoned veteran, this is must-have information for today's markets. All right, so you're going to discover on our session today one simple number hidden in every options trading platform. I'll show you where to find it, how to use it to stack the odds in your favor on every trade that you place, how to make more confident options trades and generate consistent results. So you can actually use this number for any option strategy, right? There are dozens and dozens of option strategies out there, from directional to non-directional or market neutral. And really you should be using this number in all of those. But it's gonna help us uncover short-term high probability options trades that target 50 to 100% returns in under 2 weeks. So we can use this to generate, well, first identify and then generate high probability trades that have the potential for high percentage returns in short duration. So that's where it starts to get really exciting. And then we'll look at one simple indicator to accurately forecast trend direction. Right, so we're going to kind of be combining a couple of tools here on this session. So before we go any deeper, I'll just give you a brief high-level background on myself. Again, I'm Jeff Tompkins. I have over 2 decades of experience trading the stock, options, and futures markets. And I started trading on the resale side back in the late 90s. So I was trading my own account. And then in, I think it was 2003, it was 2002 or 2003, I got my first glimpse into the institutional side. As an intern at the trade desk at Morgan Stanley. And, that's where I quickly realized there's a huge gap or difference between retail and institutional. And now I trade on the institutional side as well. So I do still trade my own account, but as Jeff mentioned, I manage a hedge fund as well. And so my main goal is to really narrow the gap and get institutional level tactics, strategies, tools, indicators into the hands of the retail trader. And so for that reason, I launched Altos Trading a little over a decade ago. So I think Jeff mentioned we've been working with Metastock for like 8 or 9 years. It's hard to believe it's been that long, but they've been a great partner. And yeah, so it was pretty close to when we launched Altos Trading. But we've rapidly grown to over 60,000 members in over 100 countries across the globe. And so I continue to trade my own account and work with a lot of retail traders, but I also manage money for my clients at Altos Capital. So, I trade pretty large position sizes. I trade 7 figures on a regular basis and manage money and all this stuff. But a lot of it is what I do in my own personal trading account. And so again, that's kind of my goal here, is to level that playing field. And as you can see, and largely why I'm here today, is I like to get out and educate the retail trader. So this is me at one of the recent International Traders Expos. I've done some keynote talks there over the years, and really just enjoy teaching people and answering people's pressing questions and getting them from where they are now to where they ultimately want to be. Trading's a lifelong, ongoing journey of learning, right? So you should never stop. But enough about that. So let's get into the strategy. I generally start out by laying out a problem, because it's easy to find a lot of stuff out there that's sugar coated and makes things sound so easy, but the reality is trading is not easy. There are problems that we have to face, that we have to acknowledge, and that we're going to encounter when we trade. And so if you don't recognize those and figure out a way to overcome them, it's going to be very difficult to be successful. So when we look at trades, right, it doesn't matter what the trade is, what the market is, the asset class. A lot of people are surprised to find out that they're often entering trades with the odds stacked against them from the start. Sometimes you'll hear conspiracy theories that the market's rigged, it's rigged against you, all this stuff. I don't know if I'd go that far, but there are a number of things that do stack the odds against you if you don't know what you're doing. And so when we're placing directional trades, we have some important questions to answer and some problems around those. So number one is how far is the market expected to move? So we don't have a crystal ball. We know the market does move. It's not static. It doesn't stay at one number. But we don't necessarily know how far it's going to move, right? You are going to know that by the end of our session, but most people don't, right? Which direction is the market going to move? Most of us trade directional strategies. Some also market neutral, but even if you're a market neutral trade, the market's still going to move around, right? So you have to have some idea of which direction it's going to go. Where do I take profits and how do I define my risk? Those are huge questions and often become problems for people in what we call the trader's dilemma. If you're in a successful trade and it's going in your favor, there's a bunch of questions that come into play. How much further is the market going to run? Am I going to get out of the trade prematurely and miss out on additional profits, or is the market going to reverse on me and my profits evaporate, or worse, turn into a loss? How do I set realistic, stop levels to reduce the risk of getting stopped out of my trade? Most of us have encountered that, right? Where you pick a direction, maybe you buy a stock, you think it's going to go up, and instead it goes down, and you get stopped out. But then shortly after, the stock reverses and goes up as you initially anticipated. And had you been able to stay in that trade, you would have made money. Well, I'm going to help you solve that problem as well. So how do we avoid getting stopped out of trades that would have otherwise been profitable? Which strategy is the most appropriate? So in the world of options, this is a critical question to answer. It's a problem a lot of traders face. Probably one of the biggest mistakes I see options traders make, because we have all these strategies to select from. You could just buy a call or a put. You could do a vertical debit spread, a vertical credit spread, a butterfly, a calendar. And it's a blessing and a curse, because again, it's probably one of the biggest problems I see with retail traders is they're selecting the wrong strategy for the market environment. I'll show you how to select the right strategy on the session as well. But we have all these choices to make, right? And so we'll answer that question. What strike price and expiration cycle should I use? So options trading, of course, is more complex because we are not just hitting the buy or sell button. We have to select a strike price or multiple strike prices. We're doing spreads, expiration cycles. So it becomes a lot more complex very quickly, but we'll solve that problem. So here's what I'll give you today to make it easier. Number one, you'll discover one simple statistic that will stack the odds in your favor once you know how to use it, right? Like anything else, you can misuse it. I'll show you how to find it, how to use it to make more confident and consistent trades, how to build trades that can profit regardless of market direction, how to forecast stocks, ETFs, futures, Forex up to 3 days in advance. So for anybody that follows me, you know that I'm a big advocate of forward-looking information and using that in our trading decisions, and not using a bunch of lagging indicators. Okay, so we're not going to use MACDs or stochastics or RSIs or any of that stuff. Okay, how how to apply this to any market in any time frame. So most of what I share is time frame agnostic, it's market agnostic. You can use it across anything. We'll look at some actual trade examples, and then I'll show you guys how you can get the trade signals that I use to make a living in the markets. So I do still trade for a living, and as I mentioned, I manage money for a living as well. So let's go ahead and dive in. So we're going to look at why volatility is one of the only leading indicators of impending trends, how to identify when markets may be primed for a big move, how to build a high probability trade that can profit regardless of which way the market goes, how to set accurate profit targets with limited defined risk, how to play smart money trades. And by that, I mean, we're going to use institutional level tactics here. So this is stuff that is underutilized on the retail trading side. So most retail traders out there are not using this or using it appropriately, and a whole lot more. So we're going to start with volatility. All right, and there are two main types of volatility: historical volatility and implied volatility. As the name suggests, historical volatility looks at what's happened in the past. Implied volatility is a true forward-looking predictive indicator. It's forecasting what the market expects to happen in the future. So that's what it is. When we look at implied volatility, it's a forecast. Right? It's largely how options are priced. And it tells us with a high degree of accuracy how much an underlying asset's share price is expected to change by a future date. So good information, right? You can do all kinds of things with this information, even if you're not trading the option. Okay, you can use it to set realistic profit targets, define your risk, and we'll look at a lot of ways to use it. So we find this in the options chain. It's readily available, okay, on any option broker platform, and it's going to tell us the exact number of points the market is forecasting the asset to move up or down. So again, hopefully some light bulbs are going off here, because there's all kinds of things we can do with this information. Right? So I'm going to start with implied volatility and using it to predict moves. So probably a good chunk of you out there are familiar with implied volatility. You've sure heard the name or have used it to some degree, but it's heavily tied to how options are priced, right? So we have this very complex formula called the Black-Scholes model that determines the option pricing, but it really can mostly be boiled down to implied volatility, and there's a direct correlation. So, right, so it measures how much the market expects the price of an asset to fluctuate in the future, and it's a key factor in determining the price of an options contract. So when implied volatility is elevated, options are more expensive. When it's low, options are relatively inexpensive. Okay, so we use IV, or implied volatility, to gauge whether options are cheap or expensive, but also to determine the possible outcome of an options trade. And it's influenced by supply and demand, as well as the market's expectation of the amount of stock will move. So I think an important way to kind of visualize it is that it tends to increase ahead of a major announcement or event and then decrease after the event has passed. Right? So if a company's reporting their quarterly earnings and you plot implied volatility below the chart, you're going to see it ramp up or increase going into that quarterly earnings announcement. Why? Because that information, I call it a known unknown. We know what's coming up, but we don't know what that information is going to reveal and how the market's going to react. And so that creates uncertainty, and uncertainty drives up implied volatility, because when there's uncertainty or fear, there could be a bigger move in the underlying stock. Okay, and remember, there's that direct correlation. Right, and then after that information is known, implied volatility drops off a cliff, and we call that vol crush. So vol gets crushed. So keep that in mind, because it'll be important as we dive a little bit deeper. And there are different ways to measure it. So when you look at IV percentile, we measured it on a scale from 0 to 100. So my interpretation of different kind of intervals of implied volatility is that an IV of 0 to 20 is extremely low, 20 to 40 rather low, 40 to 50 in the medium range, 50 to 80 moderately high, and then anything above 80 extremely high. And remember, there's that direct correlation, right? So we have a implied vol percentile of like 90, right? You probably don't want to be going out there and buying calls and puts. They're going to be relatively expensive. So IV forecasts the expected move up or down of the underlying security with remarkable accuracy. So over a large sample size, if you look at these implied volatility numbers, they are incredibly accurate. And you'll often see markets reverse right around these levels. Okay, but it's not perfect. It doesn't have to be perfect. Okay, we have a lot of wiggle room or flexibility in the way we're going to use it. Now, it doesn't tell us which direction the underlying stock will move. Okay, it gives us a number, and it could go up or down by that number. We're going to incorporate another tool that's going to give us the direction. Okay, so we're going to be using kind of two things here. So let's visualize this, and I'll show you where to find it. So this is a past chain of the S&P 500 ETF, the SPY, which at the time was trading around 573 a share. Okay, and this is out of the Thinkorswim platform. Obviously, every broker platform is a little bit different, so it might be located in a different spot on your platform, but it should be there. I can show you a way to estimate it if you can't find it. All right, so we're going to go over to the right of the expiration cycle. So we're just looking at the October 7th expiration cycle. Okay, we go over to the right, and there's a percentage and a number. Now that percentage is a vol percentile, annualized vol percentile, and we're going to ignore that. We're interested in that number that says plus or minus 3.98. So that's what we call the expected move or the implied move. They use that interchangeably. So, okay, great. We have, and we'll round here to keep things simple as well. So, okay, we have a plus or minus roughly 4. So what? So this is the expected move by October 7th. And I am referencing from the day prior, October 6th. So this is telling us that over the next 24 hours, the SPY at this point in time, right, this is in the past, not current, the SPY is expected to go up or down by roughly 4 points. So the option market prices in, right, the expectation of the magnitude of a move. So again, light bulbs should go off here because we can do all kinds of things with this information. Like even if I'm not trading the option, if I'm just day trading the SPY, right, and I buy shares of the SPY at 573, would I want to place a profit target up at, let's say, 578 or 579? Well, that would be outside the expected move. So I'd have a low probability of reaching that price level by October 7th. So it'd be an inappropriate profit target. Or if I'm defining my risk and I place a stop loss, would I want to place that at, say, 570? Well, if I'm day trading and I want to be flat the market by end of the day, October 7th, right? I would have a high probability of getting stopped out because it's inside the expected move. A high percentage of the time, this expected move is reached or exceeded. Okay, so you want to be very careful placing stop losses inside an expected move because you could have a high probability of getting stopped out. All right. Now, I mentioned there's a way to estimate this, and that's simply to add up the at-the-money straddle. So you just take the strike price in the options chain that's closest to the current underlying share price. So again, SPY's trading around 573. If we go to the 573 strike and we add up the premium on the call and the put side at the offer, that'll give us a pretty close estimate of the expected move. Okay, but that's what that number is. And we're going to start using this to build some strategy. Okay, so I'll show you some, there are a whole lot of ways to use this, but I'll show you some of those effective ways to do it. So we're going to incorporate something else here. So when I first started trading options, like most people, I just bought calls and puts and quickly realized that's a difficult way to make money over the long run. Obviously, all options expire, they have expiration dates, and options decay as you get closer to expiration, right? So you have to be pretty precise in your timing. And it's not to say I don't buy calls and puts. I've built up the knowledge and tools and strategy to be able to do that effectively, but it's not easy. And so the natural course of progression for most people is then go from buying a call or put to vertical spreads. So people will often go to credit spreads or debit spreads. And here's another big mistake I see people make is, well, really two things. They're selecting the wrong strategy. So credit spreads, for instance, are more neutral to bullish or neutral to bearish. So you have some wiggle room, and depending on your deltas, where the strike selection, right? The underlying could move against you a little bit, and you could still make money. But then you could also do debit spreads. So like you could do, for instance, a bull put credit spread, which is neutral to bullish. So you think the stock's going to not drop too much or go up. But you could also do a vertical call debit spread, which is more of a bullish strategy. So they're both kind of aligned for an upside move in the underlying stock, but they're very different, right? One you pay a debit for, one you collect a credit for. But the reality is, one of those strategies may be highly inappropriate for the market environment, while the other might be perfect. And there's a way to determine that. So like if I'm bullish, let's say Apple stock, or maybe I'm like neutral bullish. I think it might go up, but maybe not for a while, or it's not, I don't expect it to go up a whole lot, right? I could choose either strategy. I could do a bull put credit spread or a bull call debit spread. But again, one of those might not be appropriate. So what we're going to look at is volatility skew. So this is simply the difference in implied volatility across option strike prices. And we're going to use that to determine the correct strategy to use. Okay. There's different types of skew. So a normal market will often show higher implied volatility for out of the money options than at the money options, which forms a curve when you plot it on a graph. And it can help us understand market sentiment and value pricing. Again, we can use it in all sorts of ways, but in the interest of time, we won't get into those. This is what it looks like. So on the put side of the chain, if we look at the implied volatility column, we notice that what's happening. If we start, let's say just start at the 660 strike, okay, it has a vol of 16.19. What's happening is we go lower in strike or further out of the money. The vol's going up. This is what you typically would see on the put side of the chain. All right, it's increasing. So, okay, great. What does that mean? Well, that's very important. Okay. Remember when we started out talking about implied volatility, the direct correlation between that and the price of the option. So like if we look at the 660 strike puts, okay, they're bid at 412. Okay, they have a vol of 16.19. Let's look down at 10 points below at the 650 strike. They're bid at 142. They have an implied vol of 18.7. So notionally, the 650 puts are less expensive, right? $1.42 versus 412. But this is what you have to kind of wrap your head around. Those are actually relatively more expensive. So you would actually be overpaying for those relative to the 660 strike puts that have a lower vol. And if you've ever bought a call or a put option and the stock actually moved in the direction you forecasted, so you buy a put, you think the stock's going to go down and it does, but you don't make very much money or any money or maybe even lose money on that move, it's because of the implied volatility. You very likely overpaid for that option contract and you got caught in vol crush. Okay, so keep that in mind. Now, there are kind of two main types of vol skew. There's vertical strike skew, that's what we just looked at, okay, where we're measuring skew across different strike prices. And then there's horizontal or time skew, sometimes called term structure, which compares volatility across expiration cycles. Okay, so this is where we get into like contango and backwardation, right? So generally, the shorter duration options are less expensive because there's less time and less can happen. You go further out in expiration, right? The premiums are more expensive, more can happen. That's contango, right? You have short duration options that are priced higher than backdated options. Okay, you're in backwardation, and that signifies that something could, a significant catalyst could have a major impact on markets in the near term. Okay, so always good to know, but for selecting the right strategy and building a trade that actually has edge in your favor, we're going to use vertical skew. Okay, so let's look at some actual strategy and how we do this. And so we'll start with debit spreads. It doesn't matter what the strategy is. We do this with credit spreads, anything. Okay, let's look at how we use this for a debit spread. So This is simply an option strategy where we buy and sell options on the same underlying asset, same expiration, but we're going to use different strike prices. And it's a directional strategy. So if we think a stock's going to go up, we do a bull call spread, right? We buy a call option at a lower strike, sell a call option at a higher strike. Bear put spread, right? We buy a put option at a higher strike, sell one at a lower strike. We expect the underlying asset to go down. So here's the key. We want to build a spread with favorable vertical skew. And again, one of the biggest mistakes I see traders make is trading with the skew against them. Once you start to trade with a skew in your favor, especially if you can build a trade that has heavy skew in your favor, you're going to immediately notice a huge difference. In the sense that you could be wrong. Like you could do a call debit spread, think the stock's going to go up, and maybe it doesn't move, maybe it goes up just a little bit, right? If you just bought a call, you're probably going to lose money. You have to get a significant directional move to make money on that call. The way that if we have vol skew in our favor, and the stock just goes up a little bit, we could make a lot of money. You'll see a big difference. And if you get an adverse move, so the stock moves against you, but you started the trade with very favorable vol skew, you might not see much of an impact on that trade in terms of your P&L. You might not see it lose that much money. So it makes a big difference. Now, the long strike and the spread should have lower implied volatility than the short strike. So always think buy low, sell high, like anything else you would buy or sell, right? You always want to buy low and sell high. You don't want to go out and buy a house for $1 million and then resell it for 500,000, right? You always want to buy low and sell high. Same thing with options. So we're going to use the expected move to select strikes and define profit targets. And then we're going to incorporate a proprietary buy sell algorithm that will help us determine whether to use a call spread or a put spread. Okay, so very simple. It's not complex, and the best strategies are simple. Okay, those are the ones that you're going to stick with and you can make money with over the long run. All right, so let's start to apply all of this. How do we buy low and sell high with options? So the key again is to buy low implied volatility, sell high implied volatility. All right, so if we look at this option chain that we just referenced, right? Let's look at the 660 strike. Again, that has a vol of 16.19. Okay, let's look at the 655 strike. So if we want to do a 5-point wide vertical spread, we want to first, probably one of the first things we look at is the implied vol. Okay, that has a vol of 17.1. So here's where it's going to help you select the right strategy. Because again, there's all kinds of strategies we could use here. We could do butterflies, we could do credit spreads, debit spreads. If I think the stock is going to go down or stay flat and not move a whole lot, right? I could do a bull put credit spread as long as it doesn't go down too much. I could do a vertical put debit spread, right? And even just goes down a little bit, and I have vol skew in my favor, I could make money on that trade. Or if it goes down a lot, I could really make a lot of money. Okay, but which is the right strategy here? It would be a vertical debit spread, because if I did a credit spread, I'd have to sell the 660 strike and buy the 655, and I would be buying the higher vol and selling the lower vol, the opposite of what you want to do. So by buying the 660 strike and selling the 655 for a vertical 5-point wide vertical put debit spread, the vol skew is in my favor. And it's heavily in my favor, almost a whole point. Okay, so again, regardless of the strategy, keep that in mind. Okay, now we're going to incorporate the expected move. So let's look at a chain. Okay, again, these aren't current chains, these are from the past, just to demonstrate and teach what we're doing here. So all the same would apply to a current chain. Now, I'm going to look at one of NVIDIA. Okay, and we'll look at how to use this information to build a spread. Now, again, we want the strikes in the option spread to be inside the expected move. Why? Because expected moves are exceeded. Okay, and that's fine, because that would help our trade here. But we don't want to go outside the expected move because they're not exceeded a lot. So most of the time, they're pretty accurate. So if we want there to be edge in our favor, we don't want to be setting up spreads outside the expected move. They'd be low probability trades, right? So first thing we do, we look at the expected move, okay? And it doesn't matter what the expiration cycle is in this case. I left it out intentionally because I want you to just focus on that expected move. So it's 16.2. And again, we can round here 16, right? So if we are, and we're looking at the put side of the chain. So if we're bearish at this point in time on NVIDIA, and we want to set up a vertical put debit spread, thinking the stock's going to go down, okay, would we want to do a 150, 145 strike spread? Well, if we subtract the expected move, 16, from the underlying share price at that point in time, 177.75, okay, that gets us down fairly close, just above 170, right? Well, a 150, 145 vertical spread is well outside that expected move. So we'd have a pretty low probability of getting down there and achieving a max profit potential on this trade, okay? Whereas if we did a 170, 165 spread, okay, now we're starting to get in around that expected move. So I at least want my long strike in the spread to be around the edge of that expected move or inside of it, okay? And then if I'm right in the direction, I've got a very high probability that we're going to trade down to that level. In fact, there's a probability of touch column in this options chain as well. It's third from the left. And there's almost a 70% chance of touching 170 by expiration. Okay, so I've already got an immediate edge there. Okay, that's number one. So let's incorporate a little chart analysis into this. Okay, so you'll notice buy and sell signals on this chart. I'll get to these in a minute, but let's just focus on one of these sell signals from back in February. Okay, a sell signal comes in, forecasting NVIDIA to go down. Okay, so if I want to build a trade around this using options, okay, again, there's a number of things I could do. I could do a bear call credit spread, okay, defined risk, defined reward. I could do a bear put debit spread, okay, which would have more favorable risk reward. Okay, but the vertical skew, the vol skew, has to line up with the trade, selecting the right trade, right? So let's go over to back over to the chain and build a trade around this. So we'll go out to the March 21st expiration. We'll reference the current underlying share price of NVIDIA. At that point in time is at 140.11. Probably a lot of people wishing they bought it back then, that price. We'll go over to the right of the expiration cycle. We'll reference the expected move. At this point in time, it was around 20. It was 19.43. So we can round it to 20. Okay. We're going to go over to the put side because we're expecting the stock to go down. We got a sell signal. And we're now going to subtract that expected move from the underlying share price. Okay, that would be 140 roughly minus 20. We get us down to right around 120. So we want to build a spread around or inside that expected move, right? Because if we're right on the direction, high probability that expected move is reached. Okay, so we could do a 5-point wide, 135, 130 vertical spread. But first, we need to reference the implied volatility and make sure we're not trading the vol skew against us. So the 135 strike has a 58.08 vol, and the 130 strike has a 58.72 vol. Remember, we want to buy low, sell high. So are we doing that? Yeah, it's not a huge vol skew, but it's not bad. Okay. So the correct strategy here would be a vertical put debit spread. So what does that trade look like? This is the order screenshot. So we're buying the March 21st 135 strike put and selling the March 21st 130 strike put for a 5-point wide. And this one could be done for a 185 debit. So these can be done inside small accounts. You could put this trade on for 185 bucks. Totally scalable. So you can see I have a 10 lot or 10 contracts on this trade. So that's an $1,850 investment. So our profit potential is our max profit potential is the width of the spread minus the debit. So like for instance, if you're doing a 5-point wide spread, like in this example, you pay a $2 debit, our max profit potential is $3, so greater than our risk. Now I'm going to give you my kind of time horizon profit target tiered system, and that is that I look at the total time to expiration. So here we're going out about a month. Okay, and I'm looking to make 50% return on my investment at 1 quarter DTE. So that means 1 quarter of the time to expiration, days to expiration. So if I'm doing a trade 1 month out, I'm looking to hit a 50% ROI, return on my investment, in the first week. Okay. 1/2 DTE. So if I'm doing, again, 1 month to expiration, in the first 2 weeks, I'm looking for 100% return. Holding all the way to expiration, we're looking for max profit potential. And the risk with these trades is always the debit that you pay. It's defined risk. You can't exceed that. Okay. So we'll go back over to the chart. Okay, we can see what happened, right? We got a nice accurate sell signal in February. And what happened to the spread? Remember, we traded with the vol skew in our favor. Okay, we structured that all correctly. We got to move down in the stock. And that 10 lot, right near expiration, had a profit potential of 3,150. So about 100% return. Let's look at a long example. So this one's on Alphabet. Okay, again, we have a well-defined uptrend in the stock, and we're getting a series of nice buy signals along the way, a couple counter trend brief sell signals. Those are tradable as well, but let's focus on one of the buy signals. Okay, we'll look at the most recent one on this chart from August. Okay, we get a buy signal, and we can build a trade around this. So it's telling us that we should take a long trade if the stock trades up to 209.10. Okay, so let's go over to the options chain. And what's the first thing we're going to do? We want to know, what's the stock price? Did it reach that algorithmic entry price level? 209.16, yes, it did. Okay, what's the next thing we do? We look at the expected move. Okay, what is it? It's 13.54. So remember, this is going to help us select our strike prices. We don't want to be trading strikes way outside the expected move, okay, around it or inside. Okay, we're going to go over to the call side of the chain now because we've got a buy signal. Okay, and we're going to go out 17 days to September 12th. Okay, then we want to add that number, okay, to the underlying share price, so the expected move number. So 13, I can round it up to 14, but it's going to get us, pretty close to like what, 223, 224. Okay, so again, we want to build our spread near or inside that expected move. So we'll look at the 220 strikes. They have a vol of 34.17. And then we'll look at the 225, so 5-point wide spread again. Okay, they have a vol of 34.48. Okay, so what's the appropriate strategy here? It's a call debit spread. So even if we think the stock's going to go up, but we are trading low delta out of the money calls, we could do a call credit spread and maybe the stock just doesn't exceed that, but it would be the wrong strategy because the vol skew would be against us. So we're buying the lower vol, selling the higher vol. This is what the trade looks like. Okay, September 12, long the 220 strike, short the 225. This one could be done for a 92.5-cent debit. Okay, so you're just doing one contract. You could put this trade on for $92.50. 10 lot, you're investing $925. All right, go back over to the chart. As we can see, we got a nice buy signal. The stock went up, and that $925 investment on expiration day had a profit potential of $3,900. So very simple. Just using straightforward buy or sell forecasted signals and using the expected move and vol skew to select the right trade and build a trade around that. So let's get to the signals. So how do we identify the buy and sell zone? Okay, that's the trick, right? Whether to use a bull call spread or a bear put spread, or if we're doing like credit spreads, for instance, do we use a bull put credit spread or a bear call credit spread? So I spent a lot of time on this. I I was just very, I started using MACDs and stochastics and all that stuff early in my trading career. And I just got so sick of the terrible lag behind these signals that I went to work and focused on strategy and signals and algorithms that can actually accurately forecast future price movement. And this is where our partnership with Metastock started. So we partnered with Metastock and developed an algorithm that gives us forecasted buy or sell signals. So when you see the arrow, right, and if I have time, I'll get over to the platform and show you the signals. Symbology is a little bit different, but it's a diamond. But when you see that, it's the forecast. It tells you the algorithm expects the stock to go up or down. If it's a up green arrow or a down red arrow, respectively. And then it gives you a suggested entry price. Okay. So you can apply this to any asset class. It's adaptable. Okay, you can use it on any time frame, and it gives you buy and sell signals up to 3 candles in advance of the move. So if you're using this on a daily time frame, a daily chart, you're going to have up to 3 days of advance notice. If you get a buy signal, it's valid for the next 3 days, and it's going to give you an exact entry price to the penny if you want to take a long trade and where you should get in, like we looked at on the alphabet chart. Okay, so this is built into our trade trend algorithm. Okay, so the trade trend indicator is available on Metastock, and it gives you up to 3 days of advance notice. Now, if you're using it to day trade, right, let's say off a 5-minute chart, you have up to 15 minutes of advance notice. So these are accurate buy and sell signals up to 3 candles in advance of the trend using a proprietary momentum algorithm that reads the market in real time. The algorithm also contains a trailing stop component. So once you get into a trade, right, you have to manage it. And so the algorithm will read the market in real time, and based on volatility, trend direction and momentum strength, and things like ATR, it will print a trailing stop for you. So you know how long to hold onto the trade, so it doesn't reverse on you, because markets never go in a straight line. So if it reverses, right, it can help you get out with profits before that happens. But it's designed to help us forecast short-term and long-term trends. It can be used on any asset class, equities, ETFs, futures, Forex, whatever, crypto, whatever you trade, okay, any time frame. And like we're doing today, we're going to use it to supercharge our option strategy. So for directional options trading, right, very time critical. So you have to be precise on your timing, and the move has to happen before expiration. Otherwise, it's difficult to make money on that trade. So the indicator doesn't repaint, meaning that once you get a signal set in stone, right, it's there on your chart. It doesn't change on you after the fact. There are indicators out there that do that. They look great in hindsight on a chart. You got to use them in the live market, and they fail miserably. Okay, so this doesn't repaint. It has built-in protection to avoid whipsaws. So it can help keep us out of the market when you're not getting a strong directional trend. But it helps us capture the trend before it reverses using the trailing stop algorithm. It's designed to limit losses and let profits run. So it also gives you a stop loss level to define your risk and get out of the trade if things don't go as planned. There's always going to be losing trades, right? Not every trade can be a winner. But we want to obviously maximize the profits on our winning trades and minimize our losses, keep our overhead as low as possible. You can use this with any other indicator that maybe you're using other indicators that are working for you, but they're not quite up to the level that you want them to be, or you want some added confirmation. This is the one to go to. Okay, but it's designed to help you remove the guesswork from all your trading decisions. So we're looking at using this for options in our session today, but I use it across all asset classes. So this is what it looks like on one of my charts. I trading the E-mini S&P futures. So I trade the ES quite a bit. It gave me a buy signal. This was like just a quick, I think 2 or 3 day trade, but it told me exactly where to get in using a buy stop limit order. I went long 4 contracts at 64.33 where it told me to go long, and my P&L $7,100 on just one signal. All right, so again, you can apply this to any market, any time frame. You can use it with any size account. You determine all that. You determine your risk, your position sizing, all of that stuff. And it's going to give you predictive buy and sell signals. And it's designed to do that before the move actually develops, before the trend develops, up to 3 candles in advance. So it's going to give you the exact entry price to go long or short up to 3 candles in advance. So that might happen on the next candle. It might happen on the second, and maybe the third. Okay, if it doesn't reach that level by the third candle, then the signal is null and there's no trade. Okay. And that's kind of one of the powerful things behind it. So again, if there's no directional follow through, then you just don't get into a trade. And that's how it can help you, keep you out of the market when conditions are favorable. What's really exciting is that, and I'm going to let you know how you can get this indicator for your own charts. Once you apply it to the chart, put it on the SPY, the SPX, or the NDX, or the QQQ. Okay, go on one of the index products, go all the way back as far as you can on your chart. So look at every black swan event, market crash, bear market. Okay, you'll see a trade trend sell signal. And when the market ultimately rebounds, you're going to see a trade trend buy signal. Okay, here's some examples. This is the flash crash of August 2015. Okay, S&Ps weren't doing a whole lot there, range bound, consolidating. But August 19th, trade trend flashed a sell signal. One day before the market crash, so it gave an entire day of advance notice or warning. And then it gave a buy signal in early October when the market double bottomed and then ultimately rebounded. This is the 08 mortgage crisis. Okay, S&Ps, they were in an uptrend in March, April, May. Okay. A sell signal. Okay. At this point, there was no indication that the market was going to go on and lose over half of its value in the second half of the year. But trade trend gave an advance warning. And then it gave a buy signal at the end of November after markets bottomed and ultimately rebounded. This is the 2000 .com bubble. So this is from September of 2000. Okay, the S&Ps had just put in a new all-time high just a few weeks prior. Okay, there's a lot of buyers coming in here, right? We're in this huge bubble. The market's had this incredible run up, but trade trend flashed a sell signal. And we got the .com bubble bursting. It gave us a buy signal late September, early October, right near that bottom as markets rebounded. This is the 2022 bear market. Okay, we're looking at the S&Ps again. Okay, one day after S&Ps put in a new all-time high, trade trend flashed a sell signal. And markets tanked. We went into a full-on bear market, cyclical bear market that year. This is the tariff crash from last year. Okay, again, the S&Ps. We got 3 triggered sell signals on the way down. And we got a buy signal April 9th, the day we got that huge relief rally and markets bottomed and then ultimately rebounded. I actually traded that. So I traded in a lot of different ways, different asset classes, different stocks, but I went in and bought contracts of the micro S&P futures. Well, I shorted them, and then I also bought on the way up, and over 40,500 in P&L. Okay, using the trade trend indicator. So virtually every system or indicator out there, if you can stick with it long enough and not blow up your account, should produce a winning trade, right? But the problem is they don't always keep you out of the market when conditions are not favorable, right? And you end up giving your profits back on the losing trade. So that's what ultimately you want to avoid. And my goal on our session today is to help give you the tools and strategy and knowledge and confidence to avoid that. Okay, it'll happen from time to time, but you can't get in that consistent loop of having that happen. Otherwise, you blow up accounts. So I know we don't have a whole lot of time left, so I want to obviously let you know how you can get the indicator. So this is just more, not for purposes of bragging, but I always back up everything I teach with real money. So this is out of my personal Thinkorswim account, trading futures. So these are all just one lot trades using the trade trend indicator. Okay, I do have losing trades. The indicator helps me keep those relatively contained, and it helps my winners run. This is also using the trade trend indicator on 3 different futures markets. Okay. I traded both buy and sell signals here on the way down and on the way back up. So I can't guarantee anyone will replicate these results, right? But I do want to offer you the chance to help you. And one way I can do that is giving you access to use this. Okay. So I'm going to invite you to do that. I'll let you know how you can get the indicator, and you can start using it alongside things like I taught you today with, using vol skew and expected moves in your favor, right? Stacking the trading's all about edge, right? Stacking the edge in your favor on every trade that you place. And that doesn't mean you're going to win every trade. It just means that you know that when you got into that trade, that you did so with the odds in your favor and not working against you. So I reveal everything. I don't give you a redacted version of anything. I don't give you a basic version of the indicator where I'm using some advanced version. It's the exact one that I'm using, and it's available on the Metastock platform. So you're going to get the trade trend indicator. Again, use it for any asset class you like to trade. It's going to give you exact entry and exit signals. You're also going to get invited to weekly live interactive strategy sessions that we hold every Tuesday at 7 Eastern. We record those and post them in the members area so you can get access to all of our past weekly sessions. You get full support and coaching from me on those sessions. And we're going to give you a whole lot of education behind this as well for managing options trades. And we do a lot at Altos behind option trade management and adjustments. So when things don't go as planned, like how do I take this, credit spread that I just traded and it's losing money, and how do I adjust it to mitigate a loss or give it net profit potential? So we teach all of that, and you're going to get access to that on-demand online training as well. So this is all designed to help you cut the learning curve and trade with more confidence, more consistency. And there's even more in the package. So I'll walk through this and then I'll let you know how you can get it. But it includes a 12-month subscription to the trade trend indicator on the Metastock platform. You get weekly live strategy sessions with us. And I'll coach you on a weekly basis on those sessions. So my personal coaching typically starts at $19.97 and goes up from there. But that's included in the package every Tuesday, 7 Eastern. We'll get together. All right. And you get access to our private invitation-only Facebook group. So we have around 900 members in our Facebook group you can interact with, bounce ideas off, share success stories, whatever you want to do. Okay. You get the options trade adjustment on-demand online training, and ultimately trade really any asset class that you trade. We're not a one-trick pony, so we do options. We do pretty much every asset class at Altos. And then as you're getting up and running with the indicator, you're going to be receiving my top 2 weekly trade trend picks. So every Monday, I select 2 trade trend signals and I send them out to all of our members. So you're going to get your first 2 picks this evening when you join here momentarily. Okay, so you're going to get just over 100 picks a year. Okay, and you're also going to get my latest ebook, my top 10 stocks for 2026. So total retail value in the package is over $5,000. If you bought all this from us individually, don't do that because we're knocking 80% off the retail. You get this entire package exclusively for the Metastock Summit at $997. Okay, we do limit this to 25 seats. So if you want to scoop one of those up, the link is altostrading.com/trade trend. And you can immediately add the indicator to your charts and get everything else in this valuable package, including bonus number 1. And again, the 2 trade trend picks will be going out this evening. So you'll get access to those. We've been doing these for many, many years, sending these to our members at Altos for many years, and it's done remarkably well. This is just a snapshot of our track record. But you get the stock, the exact entry price, the stop level, the profit target level, instructions, and almost all of these are optionable stocks. So as long as it's optionable, and there's liquidity in the options, we send out a supplemental option alert along with the underlying stock or ETF alert. So if you prefer to trade the option in lieu of the stock or ETF, you have that ability. And then you get my ebook. In the interest of time, I won't go through all of our testimonials, but we do get a lot of testimonials from our members. And ultimately, we want you to be successful, right? And so that's why we price the package to make it affordable for anybody who wants to get access to it and is serious about it. But we do back it up with a guarantee. So we have a double your money guarantee. If you don't earn at least the cost of your membership fee back in the first 90 days, we give you a $2,000 store credit to spend on any of our other products and services. Okay, you can use it on whatever you want. It just can't be applied to existing subscriptions. All right, so first of all, I want to thank everybody for attending today. I hope you got something out of the session. And I'm happy to, if there's time, take any questions, Jeff, if any have come through. And maybe while you're doing that, I can just show you what it looks like on the Metastock platform as well.
Yeah, we have a few questions. I'd say about 4.
Oh, okay.
And we can go through them real quick. So
I'll be fast.
All right. Is there a one wants to know if you have a financial, like an earnings report due in 1 week, do you hold your options or do you usually exit them? I love that question.
Yeah, well, it's largely dependent on my thesis for the trade. So if I set it up as an earnings trade, then I might hold the earnings. It depends if I, what the strategy is, if I bought the option, sold the option. For instance, like if I'm short options going into earnings, I might be looking to take advantage of the vol crush, which would benefit the option seller. So it's largely dependent on what my rationale for getting into the trade was to begin with. But for newbies, I generally tell people try to avoid earnings because they can be unpredictable. And you can get obviously large gaps because companies report either before the bell or after the bell. And so you can get a large gap at the open that you might not be expecting.
One wants to know, is there a relationship between the Greek letter delta and implied volatility?
So everything's tied together. There's a correlation, with delta, gamma, theta, vega. It's all intricately tied. Obviously, we don't have time to get into all that today, but yeah, it's all correlated.
William says Jeff is an awesome teacher. I think he's talking about you.
Oh, thank you, William. William's a great client of Alta's. He's been a long-time client. I don't think he ever missed one of my sessions.
Art says, thanks, Jeff. Exclamation point, how's the flying coming along?
Oh, hey, Art. Art's another great client of ours and fellow pilot. Yeah, I'm training. It's coming along. I'm getting very, very, very close. And the weather's finally improved, so I can get back up there. So.
Are you going for a pilot's license?
Private pilot, yeah.
All right. Yeah. Tammy wants to know, what indicators are supported for trade trend?
Indicators are supported.
What platforms? Sorry.
Oh, platforms. So it's the package includes the indicator on Metastock. We do have it for other platforms. So that includes some broker platforms as well as online charting platforms. Let's see. So Thinkorswim, Ninja Trader, TradeStation are the broker platforms we have it on. And then TradingView, of course, Metastock, and Wealth Charts are online charting platforms, cloud-based charting platforms. You can get it on as well. And so if you want it on a second platform, normally we charge a second licensing fee for an additional platform, but we'll comp you a second one today if you want it on one of those platforms as well. Yeah. And here's what it looks like. So this is, I just pulled up NVIDIA. The symbology will be a little different across platforms, but on Metastock, you get a diamond for your buy or sell warning, and then an arrow for the confirmed entry, which again, not every signal. So like here was a sell signal, looks like back in April, entry would have been down here. It didn't follow through, so that this was a non-triggered trade, but you can see if there's an arrow that follows it, it means it reached the suggested entry. And this is a daily chart, so it has to happen in the next 3 days. This one did, got a nice move, and then it tells you where to get out. There's the exit. Here's another, this was a triggered signal, tells you where to get out. There's the exit. But that's what it looks like.
Don wants to know, how does this work on intraday, like 0 day to expiration, 1 minute, 5 minute bars?
Yeah, again, you can use it on absolutely any time frame. So there's nothing you have to do with the indicator. I can go down to a 30-minute chart, and the algorithm will automatically adapt to your selected time frame. So just change the time frame, and the signals show up, and you can see the accuracy, right? The buys and sells near major trend turning points, right? But this is a 30-minute. So you can use it on any time frame.
Okay, cool. Let's see. You send this. Thomas wants to know, on the Tuesday evening strategies, do you cover additional options and stock strategies?
Good question. Yeah. So our Tuesday sessions are kind of similar to what we did here. So, but we start out with a kind of high-level market overview, map out key levels for the major indices, and then we focus on a new strategy each week. So yeah, it could be an option strategy. We do other things outside of options as well. So it might just be based on technical analysis. There's different things each week, but each week's a new topic. And then time permitting, we'll do a ticker roundtable so members can throw out tickers that they're interested in trading or watching, and we run a technical analysis on it. Yeah.
Don says, do I need to purchase the Metastock platform? I used to use it 30 years ago. Don, thanks for using Metastock 30 years ago. We definitely will provide a free trial to the current version of Metastock that's not 30 years old as part of your trade trend license. And pricing for that starts at about $75 a month, which would allow you to do all the scanning, the testing, all of that kind of stuff. So if you do the trade trend today, you want to try it with Metastock, we'd love to welcome you back, of course. We've missed you as a customer these 30 years. We'd love to have you back. So Art says, great. And that comes to the end of our questions. Jeff.
All right. Well, thanks so much.
All right. So altostrading.com/trade trend. If you want to call us, you can call us at 800-882-3040. You can also go to metastock.com/sales chat as well. altostrading.com/trade trend. Jeff, great job creating that, putting it together, making it available. Appreciate all the work you've done.
Likewise, you guys have been a great partner. Appreciate it.
All right. Say more. No, I'm just kidding.
I'll say more when I come back next time.
All right. Sounds good. All right. I'm going to go ahead and kind of move over here. I do recommend this. It's been very, very popular. This is a great package with all of the inclusions, the 12-month subscription, the indicator, the weekly live sessions, the bonuses. altostrading.com/trade trend, or give us a call. We can set you up 800-882-3040, metastock.com/trade trend. Final thank you and a final goodbye, Jeff.
All right, take care.
Yeah, I promised a few Jeffs in a row. So let me go ahead and get over here to my screen share again. Got a little bit of this. Okay. Want to invite you to join the Traders Forum. The Traders Forum's a great place. I absolutely love it. You can go there. You can chat with really smart traders. They can share ideas with you. They can run scans all day long. They look at the stocks. They'll give you advice in terms of what they're doing. We do indicator focuses where we go in and just talk about indicators, kind of how they work, how they're calculated. We do that once a week. Market chat's open every day. We also do a pretty cool event there where we call it Ticker Talk, where we bring in a guest expert. We talk about trading. We talk about the markets in general. We talk about indicators. It's more of a podcast style type of an event, and it's a lot of fun. So you can join for free if you go to thetradersforum.com, and we'd love to see you there. So all of the offers that we're talking about today, you can find on our website at metastock.com/conf-promo. We would be more than happy to answer any questions you have if you give us a call at 800-882-3040 or metastock.com/sales chat. So, Don, I'll get to that in just a second. I promised another Jeff. Jeffrey Scott is next. Jeff has been a big user of Metastock for a number of years. There's been a few things that really, sometimes people will say something and it'll just stick out for you. It'll stick in your mind and you're like, yeah, I agree with what he just said. One of the things that Jeff has talked about extensively in the lessons that we've done is the fact that he likes to find and buy stocks that are in an uptrend. And the reason he likes to buy stocks that are in an uptrend is because as long as it's not the end of that uptrend, it puts the odds in his favor. He says it a little bit better than I do. Jeff has a very common sense, a very common sense approach to trading. I was looking for that additional word. We've been going for a little bit today. It's got a very common sense approach to trading. He either has a top-down approach, which he's going to talk about today, where he looks at the market and what the market is doing and kind of makes decisions based on where the money is. So without further ado, I'm going to bring on Jeffrey Scott. Jeff, how you doing today?
I am doing well. Can you hear me?
I can, and you look great too.
Oh yeah, because my wife's out of town. I'm relaxed.
Okay. Let me go ahead and let me make you the presenter here real quick.
All right. And you
just
want pictures on or off? Doesn't matter.
That's up to you. I would prefer to be able to see you, but you know.
Okay. All right.
Some people, yeah, whatever you want. I just made the presenter you, so it should ask you if you want to share your screen.
Yeah, this is always an adventure picking your screen. I'm going to go for door number 2. And yep, the right screen is there. So
yep, you got the right one. I was hoping to see like your bank account statement or something.
Well, you could see that, but you'd have to be on my video last night. That was only my trading account. And actually, yeah. I'm not kidding. All right, how do I maximize that screen, or does it maximize when you?
It will be maximized for the viewers. We can see it.
All right, I got it maximized. I double-clicked on it. All right.
Perfect.
All right, well, thanks for having me, Jeff, as always. So 3 Jeffs in a row. I didn't hear who was before, but 4 of a kind's a good hand as well. Thank you so much for inviting me, and thanks to all of you that are still here at the end of what's probably been a long day for you. Now, I'm going to be very different, I think, than some of your prior presenters. That's not necessarily a good thing or a bad thing. I don't have a big trading business. Why? I have a real big business outside trading, which means I have to do things during the day besides trade. I've got 3,000 employees plus. I can't be sitting in my office and having people walk down the hall and see me with charts, or else I'll give them the opinion that's okay for them. I live down here in the tax-free haven of Florida, and my office is on the water. And when we built the office, we had the stupid idea to make all the interior office walls windows so you could see right into the water. Well, that means I've got no privacy. So I don't have a fancy website, not what I'm into, but what I am is a trader. And I've been doing this for 30 plus years. And I love to teach. And what you're going to get over the next 45, 50 minutes is sort of what I've learned from the beginning, the good, the bad, and some ugly, my thoughts on the market, and how I've been able to work with Jeff and William to port my tools into Metastock. I'm not in a lot of platforms, and I don't have anything to sell you besides the tools in Metastock. But I do a lot of education, and most of it's for free, which I'll talk about as we go forward. So I think I can pull my PowerPoint up. Let me get to the right screen. Can you all see the PowerPoint? I guess I can't see your answers anymore. So I'm going to assume Jeff's going to interrupt me if you don't see the PowerPoint. I'll be bouncing between PowerPoint and Metastock as we go. And let me just make sure. Okay, so back to the PowerPoint. All right, I use Zoom, so whenever
Jeffrey, I don't see it changing when you go back into Metastock. I just see the PowerPoint.
Okay, well, I would have been in Metastock for a microsecond. All right, so let's go ahead and get started. My email address is marketmripro@gmail.com. I have a Google group called Top Down Trader, and that's how I interact with folks. I'll probably move back to Discord when I stop my day job. But my whole story is, how do I do this while working full time? As you've heard from every other speaker, this is for education only. I do these videos to show how I use my tools for top-down analysis. Trading involves risk. You are solely responsible for any investment decisions you make. And trading stocks and options should be considered risky, and you should always be consulting with your financial advisors. Top-down Trader, without the hyphen, is the name of my Google group. Just sign into Google Groups, go to all groups, and look for Top Down Trader. and then you tell us how you want to be contacted. Why would you do that? Because I put out a video every night to my followers. I make market calls. I show you my account, how I'm doing. I do frequent educational seminars, and for the most part, unless it's a live event at a venue, they're free. So I love teaching people how to trade. I have sold multiple companies to public companies. All right. I don't do this because I want more money. If I did, I'd charge for everything that I did. I do this because I'm paying back some very smart people that I learned from by carrying on their messages. So I'd love to have you join the group. If you join, look at there's a chronicle of mail from me. Go back to Sunday night. You can watch my video. And if you have any questions about whether I make money trading, they'll be answered because I showed my performance very clearly. I also do live meetings. So the live meetings at venues I charge for. I have no choice. I don't charge a lot of money. I am doing a meeting in Phoenix. It used to be in Orange County, and we decided to move it to Phoenix this year. This is not me. This is my trader. This was supposed to be me. My wife says he's much more handsome than I am, and I agree. And basically, I'll have a couple of guests. John Person will be there, and a couple of other folks. And it is just traders talking about trading. It's June 5th, 6th, and 7th at the Embassy Suites in Scottsdale, Arizona. Because a lot of people get scared off by my vocabulary, I start the meeting Thursday at noon, and I invite people who just want to go through my indicators and the names of my signals so they don't get left behind. I do it live and online. It's $500, and if you come live, it's breakfast, lunch, dinner on Saturday night, and drinks, coffee and sodas in the room all day long during the meeting. Love to have people. If you do it online, I don't forget you, and everybody gets slides and recording of the session. So if you find this interesting and you want to learn more, and there were a lot of questions that came up about options, I can guarantee you haven't seen anybody trade options like me. More of that can come up as we go. I'm a cancer doctor. It's a great profession. I love it. I'm board certified in internal medicine and oncology. I started trading in the 90s all the wrong ways. What do I mean by the wrong ways? I sat in the doctor's lounge and I heard tips. It can't get any better than the following. One day I hear about some stock. It's called Software of Excellence, and the ticker symbol is SEXI, SEXI. It's about a $2 stock. And the worst thing that can happen with a penny stock is you buy it and it goes up. $4, $5, $6. I tell all my friends, they're all buying SEXI. And then it imploded. Well, it turns out their offices were probably a half hour from where I was living and working in the Baltimore area at the time. I got in a car, I drove to their offices, and there was a boarded up strip mall, which was their address. So not only did I get screwed, I screwed a bunch of my friends. So that was the end of that. I had to start learning, and I've spent a lot of time, a lot of money working with a lot of different educators, and you're going to see the result of that as we go. I quit practicing in 2001. Why? Because I sold my first company for a lot of money, and I realized I could make money not just being a physician. And I've sold 2 companies to AmerisourceBergen, now called Syncora. We sold another company to Magellan, which is now part of, I think, Centene. And then we sold one company to Cardinal Health. And right now I've got the biggest of my companies, and I'll probably exit and retire in the next year or so. But because of that, the busyness of running a big business and building a healthcare technology unicorn, I can't trade during the day. I've been teaching people how to trade for decades. I've put out a YouTube video almost every night of the week. I just did one this before I came on here, the live seminars, and then mentoring. Anybody that buys any of my products, I invite to mentoring at least every other month, if not more frequently. and I share the videos and the slides, and I keep supporting the products. Why? Because why not? It's the right thing to do. That's me, not that long ago. And you might tell where I went to school. This is the apple, the light of my world, my little 5-year-old, almost 5-year-old granddaughter. Not to be left behind, I've got a almost 4-year-old grandson, but his dad went to Georgetown, and I don't think I'm going to get him to Michigan. In the mid-90s, as I was getting all these tips and learning a lot of bad things, I met this guy named Ian Woodward, and Ian changed my life. And I used to call my education, be your own trading guru. Why? Because Ian, who had a strong British accent, and I'm not going to try and pretend that I have one, would say, I am not a guru. I will teach you to become your own guru. And that's what I believe that that's the way to do it. I've worked with everybody you could think of, and my trading style is sort of an amalgamation of what I learned. And the tools that I'm going to show you tonight help to make it quick and easy. I'm a top-down trader. Jeff called that out, and I'll prove it to you why in a couple of slides. I am a swing to position. What does that mean? Well, I enter every trade hoping that I'm in the right direction. And if I'm in the right direction, I'd like to see it run for a while and make money. I make the biggest money on a longer term holding. That doesn't have to be a stock. It can be an option. And what I do with my options, I call them campaigns. I just closed out on Friday a campaign in SanDisk and Micron, where I bought the stock much lower. But what I did is I bought calls, and I keep rolling that call up to a higher strike price, meaning putting money in the bank, pushing it out to a later month so I have more time. And so my kryptonite turned out to be that I got married to my stocks, and I'd ride them up and down. And I'd look at my equity portfolio, and I do just fine on an annual basis. I don't want just fine. And the way I got rid of just fine is I became a shorter term trader. I trade almost predominantly options. And my equity curve is very happy these days because I don't have drawdowns, because I'm constantly rolling up and rolling them out. I'll talk more about options at the live meeting. I'm always happy to talk about options. I do about 5 different option trades. They're all long or short position trades, and they're all designed to be low cost, high reward. I could say minimal risk, but that's not the right word. Defined risk. And I love teaching people how I trade options. I use daily and weekly charts. I use indicators and scans to help me find setups. And as I mentioned, equities and equity options. One of the folks that I learned from was Alexander Elder. And one thing I liked about Elder was how he would make us get up to the front of the room and present our A trade. And the first time I went, it kind of made me nervous. And then I realized the A trade is it's what I do every day of the week. I find stocks in an uptrend that pull back to support, and I want to buy them on momentum off support. And I have rules-based position sizing and stop management, and I like seasonality. The last 2 bullets we're not going to talk about tonight. There's not enough time. Now, in a downtrend, I'm not buying long. I like making money, not giving it away. So in a downtrend, I have the same stock, the same trades. Stocks in a downtrend find a retracement into resistance, and then I buy momentum off of resistance where it comes back down. I can do this in 30 minutes a night. Most of my webinars during the week, today was 24 minutes, and I looked at markets, sectors, industry groups, breadth, stocks, and I was done in 24 minutes and found 3 to 5 stocks to look at tomorrow. And my approach really hasn't changed in 30 years. New tools like the ones in Metastock just make my life easier. Simple slide. Here's why you do top-down trading. I don't care who you are and how good you are. I sat in a room with brilliant people in the 90s. And what we would do with Ian Woodward is each month we would pick, and I wasn't there all the time because I was still practicing. Each month we would pick 5, 10 stocks that we thought were going to be leaders for the next 30 days. And then we had I hate to call it secretary, but we had someone who kept the records. And then retrospectively, after 2 years, we assigned the market was strong, mixed weak, and weak. And then we looked at what the returns were by these really smart traders trading the same way every month. And what we found, in a strong market, you could be up 100% in 20 days on a stock. Imagine if that was an option with some leverage. In a bad month, these really good stock pickers did really crappy. And then the other thing we learned is take profits if you get them, because there's a reversion to the mean. So if you get 100% return in 20 days, and yes, it happens, then take half of it off, because if you give back some, you put some in the bank for the next trade. The other thing was, in a weak market, it doesn't revert. So if we, I'm going to have a slide about the midterm election year, and it's a bad year typically in the market. If we get down 20, 30% this year, and it can happen, hope it doesn't happen, don't hold on thinking that next month it's going to get better. Because when we had weak markets, the performance just continued to deteriorate. So message number one, when the market is strong, when the wind's at your back, you attack and you buy. And if you only know how to go long when the market's weak, you go to cash. Now we have contra ETFs and so many different things we could do. So there's these great things now sitting in our browsers, Gemini and other AI. So I want to dispel a myth of money managers. I have a lot of money managed by money managers. Why? You did get the part that I work all day long. Well, here's the second part of the equation. I'm going to die someday. So are you. And I'd like the ethos guy. I've got plenty of insurance. But when I go, who's going to manage my affairs? My wife has the financial aptitude of a snail. She gets a check every week. We call that my paycheck. And that keeps her going. And I live off the money I make trading. And we're still married, happily married. I need to know that when I pass, somebody's going to write her that paycheck every week until she dies. So I moved a lot of my money into professional money managers. I kept out a small account, and I wanted to prove to my followers that I could trade a small account in addition to an 8-figure account. Well, that small account in 18 months is up from an investment of 150,000 to 2.4 million. And that's from January of last year. And that's what I present at every one of the meetings and show people what I do. Again, don't trust me. I could be lying. Go watch the video from Sunday. You'll see my account statement from Schwab or the performance from Schwab. So this here asks 3 questions. What would my return be if I had put $10,000 into the market in 1990? I bought spiders and I didn't do anything else. I just let it ride. What would happen if I did the same thing, but I was out of the market on the 10 best days of every year? And then the third scenario was I'm out of the market the 10 worst days of the year. Well, the money managers have always told me, Jeff, you have to leave your money with me and leave it fully insured all the time, because if you miss those 10 best days, you do horrible. Well, they were right. Buy and hold on the spiders for 35 years at 9 to 10% CAGR. You grew to as much as 250,000, but you also had to deal with a 55% drawdown. Missing the 10 best days of the year, the money managers are right. Your CAGR is 0 to 2%. You maybe were lucky to double your money in 25 years, 35 years, and your drawdowns were huge, just like buy and hold. I used to live that life. But what happens if you have a way to avoid the 10 worst days of the year? Your CAGR is closer to 22%. Your growth of 10,000 is to 2.5 to 4 million, and your biggest drawdown is 50 to 20%. Everybody tells you about missing the 10 best days because they don't want you to get out of the market. What they should be teaching you is how do you avoid the 10 worst days. How is your 2026 gone? I would never do this. I don't have the time. But I saw this the other day for the first 3 months of the year, and I know we're in month 5. This is a very popular contest with a lot of people, and the results get published. Only 16% were profitable after the first quarter. It has been a tough year for some people. I mentioned midterm elections. You've got to be careful because you get pullbacks. Well, if every 4 years in the second year of the presidential cycle, you get a significant pullback, why would this year be any different? We had 11% or so with the Iran stuff. We had a 20% Trump 1.0, 27% in Biden, 10 to 17% in Obama. We still could see a significant pullback. And this is just fact. This is life. Now, those pullbacks are bigger if we have a recession. Well, we'll see. I'm not going to show you tonight, but every week I talk about what happens after you have an inverted yield curve, and it corrects. And if you go back to the 70s, you get a recession. We're overdue a recession. And I just look at the mess that we're in now with $100 plus oil. Employment, it's okay. It's not great. What happens when $100 oil hits our economy? I'm concerned. So I'm a little bit more defensive than I normally am. So I'm all about top down. That means 50% of what happens tomorrow is the market. You can be the world's best stock picker, and if the market's down 5% because bombs are falling, you're going to lose money. 20 to 30% is the industry group, which means that only 20 to 30% is the individual stock. I let the market determine my stance, long, short, or in cash. I look for my favorite setups in the top industries, and then I'll do bottoms up to find some special opportunities. And I use different tools to tell me what's working. Very smart guy. I actually only learned from him in an online session, webinar, or series that Trader Lion put on, Stan Weinstein. His hair is even whiter than mine. He's been around a long time. This is a fantastic book about understanding the trends and knowing when to trade. Every stock, every index, sector, industry group, and every time frame are going to repeat this pattern over and over again. You want to buy in stage 2. You want to be out in stage 4, either short or in cash. And you don't want to be, you just want to be watching during these periods of consolidation. So how do you find this period of time? How do you know you're here? Well, I created, after listening to him, I said, I can do that. So one of the indicators that some of my friends and I created is called the bongo. Ian was a hoot, and he was all into the bingo, bango, bongo. And I was assigned to develop the bongo with 4 other of my friends. And he wanted us to come up with a trending tool that would allow us to catch the better part of a move. And then Weinstein had this 30-period WMA as a stock moving above it or below it. And I thought, why don't I combine those two things and create a timing model that has a trending indicator, which is always going to be lagging because I like the weekly, and it's got the WMA to filter it so I avoid whipsaws. So I created a model which I can look at the bongo, and when it breaks out, the weekly is going to go long, and it's going to really stay long until that run is done. The daily bongo may turn short when it's pulling back, and then it will go from short back to long when it's time to buy. So I can scan for that pullback trigger. I can scan for a long weekly bongo and scan for when it turns long again on the daily. In consolidation, whether it's a stage 1 base or a stage 3 topping, everything's flip-flopping, and that's a signal in itself. When the markets break down, my weekly bongo gives me a short signal. And when it reverts to long is when it's probably retracing. So I could scan the market for stocks with a weekly bongo that is red and short, and the daily bongo is long, or the daily bongo long has converted to short. I can find retracements. I can do even better. Let me go and show you some things in the program. So let me just verify. Can you see Metastock now, Jeff?
Yes, sir.
Okay, perfect. So I took that phenomenon and I created a timing model. And boy, it has been really good for me. So I'm going to open it up right here and we're going to take a look at it. Now, I did give Jeff a PowerPoint of my presentation today. And so everybody can get access to my presentation. And all the slides I'm showing and pictures of what I'm showing are there. So this is, let's go to the spiders first, which is right here. So basically on the top of this chart is the bongo. Green when it's uptrend, red when it's a downtrend. Like I said, it's a lagging. It takes a few weeks for it to flip. Here is the 30-period WMA. My goal with this was, as a mostly long guy who likes to stay in for a while, keep rolling my options up and out. I want big returns, all right, is to find a signal that gets me in and keeps me in for a long time. This signal turned positive on the spider in November of 2023. Now, yes, you had to go through the tariff tantrums. You had to go through Iran. And let's get to current date. I don't know why it's not giving me all the way to 26. It does on the daily. So we're just going to talk about what we have. But this tool, from a weekly perspective, has met my needs. It gives me the signal to be long the market. Now, long doesn't mean dumb. It means the major trend of the market when this bar is green is long. If we look at the Qs, and there's a lot of dates on this chart, so let me just give us, spread it out a little bit. The Qs have been long here, and that other chart, ignore the 23 date, because I realized it didn't give me any data after 24. There must have been an issue with my ticker that I'm using. Here we have a long on April 17th, 2026. And I want you to remember this date. We also went long on May 16th of 25. You could see how long I was overall long the market. Short the market, I missed this. I missed most of this. And I want to capture most of the gain. But I don't rely only on the weekly. But when I look at the Qs, the spiders, the diamonds, I'm in a long, and the Russell, I just lost the long in some platforms on the daily, but on the weekly, I'm still in a long. And so another way of playing this is to, you can see I'm still in a long here as well. Again, look how long we were in a long, from May all the way until March. It keeps me in. Now you're probably thinking, this guy's nuts. There's no way you're going to rely on a weekly indicator to stay in the market or not stay in the market. I don't blame you. I think it's kind of nuts too. I don't just rely on the weekly. Trend is determined for me by the weekly, but I also need to know conviction. And so the daily is very important for me. Now the daily, as you're going to see, will flip-flop a lot more in that. But what the daily is going to do for me, it's going to give me conviction. So up until today, we were long everything. Look at the signal that came in here on April 6th, about a week when the market had actually bottomed. Last year, I called the bottom, and I'll tell you what I mean by called the bottom on April 7th. I got the signal to buy here on the 24th. So the dominant signal right now is the weekly is long. I'm still long with less conviction. Why do I have less conviction? Well, one reason is because the Russell daily has turned to a sell signal. And I pay a lot of attention to that. So the Russell, not the Russell, but the fact that I've got a sell signal came up on one of my dailies. So right now, 4 weeklies are long, 1 daily is short. That tells me to be careful. I'm not short the market because I'm not buying that we're done going higher yet. I've got concerns about the market, and I raised some cash. Instead of rolling up and out, most of my semis and data center plays, I got lucky because on Friday I closed a lot of my option trades because they were expiring. And you know the old adage, sell in May and go away? Let me show you why I'm concerned about it this year. Let me make sure my fire's done running. I hope I ran it, but we'll see. I have a good buddy. His name is Sagar Nandi. Why bother reproducing signals when he already copied my signals and put them into Metastock? And when I say copy, I say it lovingly, not accusatory. Sagar and I are friends. And he took what I learned from Ian and others, and he created what I'm going to show you. And this is where it really fine-tunes my approach to the market. And he created the Q market breadth tool. So he's got an issue with this indicator, which he's going to have to fix. Do you notice these things here? I don't know how well you can see it, but they're skulls and crossbones. Does that make you feel warm and fuzzy or nervous? I hope you're saying nervous, because the skull and crossbones represent an old wives' tale called the Hindenburg Omen. To me, it's no wives' tale, because if you go back to the 80s and before, the markets pull back with most of these Hindenburgs. And if you go back and look here, when you see a cluster of them, the market goes down. You see one, no one cares. It's got to be confirmed. Cluster of them, the market goes down. There has not been a major market crash, including the Great Depression in 1929, that was not preceded by the Hindenburg Omen. Only 1 out of 4 are a big deal. We've got a confirmed, meaning we had 2 within 30 days, Hindenburg Omen, that occurred on May 13th. I am concerned about the market. Another reason why I'm concerned, and I don't love how he spreads it out here, but the AD lines on the NASDAQ, the S&P 1500, the spiders, all rolled over as we were getting higher highs. We call that AD line divergence. When we look at the new highs and new lows, which he has down here, we're seeing more and more new lows, and we're not seeing lots of new highs. Bull markets are built upon new highs, not new lows. So I'm not going to go into overly more detail on this. Sagar Nandi, superiorprofit.co. I use the same tools every day. You'll see it in the webinars that I do. There have been a plethora of signals that are telling me the market's at higher risk than it has been for a long time. So therefore, I'm heeding that message, the fact that the Russell turned into a sell, and I have taken profits, lightened up my holdings, and I'm ready to pounce to go right back in. I think my video tonight, I call it dumpster fires in the semis in data centers, and they're bouncing after hours. So we'll see. But I'm still concerned the midterm election, the Hindenburg Omen, the fact that we've got those divergences. I think there's risk right now. And if I think there's risk, then it's time to be lightening up. I haven't said short, and that's your business. I'm not ready to say I'm going short or buying contra ETFs, which is typically what I do. Now, another thing I like to look at are the sectors. Remember I said top down? So I'm going to pull this up and I'm just going to revert back to the PowerPoint for a second. So you'll have, as of 2 o'clock today, these were the charts for the March weekly and the daily signals. By the way, when you purchase my tools, you get all the layouts that I show you. So I supplement, except for Sagar stuff, by the way, with the Hindenburg-Omen, and then come to my live meetings. You'll learn so many different tools to make you more successful in the market, to give you that edge about a market bottoming or topping. So I talked about this already, showed you Sagar's tools. Remember I said I called the bottom on April 7th, 407-2025, YouTube Premium, just YouTube. That's me, another one of my emails. A bottom is in. Don't know if it's the final bottom, but a bottom is in. And why does that matter? Because if you trade like me, you make most of your money off of bottoms. I love bottoms. Give me March 9th, 2009, March 21st or something in 2020. Give me April 7th in 2025, and it turns out give me April 1st in 2026. I'm not even going to tell you what my performance was between 4-7 and Friday because you won't believe me if I tell you. But you make most of your money with market turns. I used to lose most of my money at market turns when we topped. Now I take profits as we go up. So when the market turns and we get a huge down couple of days, maybe today was part of that, I don't think so, I don't get hurt as much because I'm sitting in 70% cash. So I want to see if this is loaded up. So within Metastock, I have pulled up, let's see, well, it's in there. Let's try one more time. And if not, I'll just show you in the scan. It's right there. All right, maybe it's behind. Here it is. You can't see anything there, I admit, and I'm not going to take the time. So I did it earlier today, so let me go back to this. If you look at what was going on at 2 o'clock today, here's technology. This has been totally strong. It's pulling back. The shallow line is that 30-period WMA. It has not given me a sell signal yet. The bongo is fired, so I'm concerned. What really amazed me is look at how many green shoots we have. We have this one here, which is, to put my glasses on to see what it is. I know staples have popped. Energy has popped. If you look at industry groups, financial, so this is healthcare has got a green shoot. Energy has been strong. Who else has got a new green bar? XLF financials. Who else has a green bar? Got one here, and this is communications. So we've had horrible breath. Only thing that's been working has been data centers. And all of a sudden, a bunch of other sectors are flipping to green. That makes me kind of optimistic that maybe we're not going to see a big sell-off just yet. And what we're going to see is rotation. Now, as a true top-down person, I'm now going to go concentrate on those sectors that are turning positive. Now, I don't just rely on my timing model. Now, the good thing about starting late and being the last one up is that I know if I go right to the top of the hour, I'm not going to get thrown out because there's nobody to follow. I will look at traditional charts with moving averages. This is an indicator I call the high-low oscillator. It helps me a lot to find tops, all things that I teach when I talk to you. I show you what's in them. And then I've got a number of other symbols that I use. And I look at the major indexes, the commodities, and then we get down to stocks. And I want to get into scans in a moment. My chart has some superpowers. This chart, which looks very complicated, is not complicated. The bongo is the trending, okay? The bottom of the two, there's two there, is the weekly. Every time the daily hits red is when it's pulled back. It's pulled back. I don't have to look at the chart. I know what's going on. Then I have the high-low oscillator, which runs from plus 100 to minus 100, which gives me a mathematical tool to predict extension and when a market's likely to reverse. I like simple moving averages. The green is 17, the yellow is 50, the red is 200. I like to buy when things pull back to the 50. We used to call it free parking. Then I have what I call my impulse indicators. I had to read an EKG. I'd stick these leads on a person's chest and measure the electric response, and I could tell if you were having a heart attack, if you had a rhythm that was likely to kill you. Well, I want the same thing for stocks. So this is my EKG for stocks, where I have the core number 4, 5, 6, and 7, which are individual signals that seem to accompany most major moves in a stock. So I want to use these to help me find stocks that are moving. And then another secret weapon, relative strength can be done a lot of different ways. What we do is we take the relative strength of whatever is in the chart and create a ratio chart with a spider, and then we slap a moving average on it. And I have found, this is daily, this is weekly on the same chart, if you buy it when you break above the average, you hold it until it breaks below the average, you catch a big run. So I want to scan when I get a number of my signals occurring. I want to find stocks that are trading stronger than the market on the daily. The weekly is a laggard, and this is OBV, on balance volume. So I have best supporting actors, which I just told you, the relative strength in the OBV, and I like to look for divergences. So the PowerPoint tells you what's in the dots. They tell you about the high-low oscillator, which is extension, and then we get to the expirations, which is where I wanted to go to before I run out of time. So let me close a few of these windows that I don't need and get to the regular Metastock window. Close that over here. I don't need this anymore. No. And then open up this one. Don't need this anymore. Buy Sagar, great tool. And then I open up, eventually I'll find the right one right here. So I ran my explorations already. I have explorations for specific patterns. I have long-term downtrend, uptrend, momentum, pullbacks and uptrend, retracements and downtrend, short-term downtrends, and short-term uptrends. And on each of the trending, I can look for breaks, outs, and bounces. So let me see if I can find where, I guess they went back in here. All right, so we're going to look at the report from today. And here's today's report. So I ran this on the S&P 1500. It took maybe about an hour, probably 45 minutes. I don't know. I went to get dinner and eat. And you can see 518. These are two that I ran for one of Sager's tools last night. And let's just look at my favorite one, which is momentum. I found that momentum dot, of which you get two dots, this is momentum. It's the first set of dots above the squeeze, that when I find a stock that's got two momentum dots in a row, where the relative strength is crossing over the moving average, this one's late, it's weekly, where the volume is crossing over the moving average, this is where some of my best runners have come from. And so when I went through the list, I can set it up by up, down. I could look, is there a squeeze, a typical Bollinger Band squeeze? If it says 1 on OBV, that means it's trading above the moving average. For one bar, relative strength hasn't flipped yet, but we know visually that it's close. And we know that weekly relative strength hasn't closed either. But what I can do is look at these, and if I want to find something that has the perfect criteria, it's probably Primerica. And if I double click on that, and I forgot to set my thing as default, apply a template. The template we're going to use is going to be the MRI basic with weekly RS. I'm going to apply it. And what I'm going to look for is to see if this is a viable candidate. I think this is one that was on. So I had relative strength and OBV are both turning positive. You can see here, OBV is a 1, which means it's above the moving average. 0 bars means it happened today. Relative strength is a 1. It means it's above the moving average. It happened today. And it's got the 2 momentum bars. This is another one of my indicators, which is a short-term buy-sell indicator that gave a buy signal. And so I'm looking at Primerica, and I'm going, all right, do I know Primerica? Yeah, I know what it is. I think it's in the financial services and insurance industry. And one of the things I really love about the new version of Metastock is I could call up and I could look and see if there was any news. Somebody put a 295 target on it today. Okay, that's not that exciting. Close the news. But if you don't know about the company, you just right-click, go into Zenith, and pull up company overview. And you can find out all kinds of stuff. Provider financial products and services, middle-income households, life insurance. For whatever reason, and I didn't do enough analysis tonight, a lot of life insurance stocks are moving, kind of breaking out of a little bit of a trend line there, which it's not perfect, so it's not formed. These are auto-generated trend lines, and that's breaking out. Is there anything else that has it? What about Intuit? Thought tax time was over. Well, we know the software stocks got hammered. So I'm looking at this. I'm not that excited because it's got a trend line and a moving average over it. So I would typically go through the list and look for stocks that actually look actionable. A break above this line, which would be a short-term trend line breakout tomorrow, would be interesting, but it's below the 200. I prefer not. I want things at uptrends in that stage 2 breakout. And I'll go through, well, this one would have been great, but it's probably run too much. So the purpose of scanning is to define what you're looking for. What about a pullback in an uptrend? So I'll rank this by dots because I know the ones that have the most dots are most likely to move. Now, I guess it's got plenty of volume. It's a cheap stock. Let's look at AMBAC. And of course, it's going to require me to do the template again. I keep forgetting to set default. And I use the scans to help me find the stocks that meet the criteria that I like to trade. That's what scanning is for. Now, I don't know what the story is here. It's a cheap stock, but if it breaks out of this line right here, it's got the double momentum, it's got a breakout, it's got a volume, it's got my buy-sell signal here, it's got all the criteria I like. And is it also in the financial services? I'm almost certain that it is. I don't know if they do insurance, but now I'm seeing 2 stocks in the same, wrong one. What I'm looking for, what you want to pull up is company description, company overview. So I like, there's so much to like about Metastock, but a lot of it is the other things that you can get inside Metastock. I'm going to close that tab, do that first. And here it is. And you can read about it. Oh, is this Active Specialty Group or AMBAC? Well, here it is, AMBAC. Oh, they changed their name to Optic Specialty Group. What does it do? It does global insurance company. Shocker. Here's another one. Primerica. So something, I just found what we call as a wolf pack. When you start to see of this Primerica, that's Microsoft. I have to go find it. When you start to see a number of stocks in the same industry group start to behave, to work together at the same time, that tells you something's happening. So something is going on in insurance. So obviously I don't have enough time to show you everything I want to show you. So I'm going to revert back to the PowerPoint. I love trading and I love helping people trade like I do. So here's even better. This one moved up, pulled back, breaking out above the 17. Both bongos are green. Here's your double momentum, breakout and a buy signal. This relative strength, it says to me here, I don't have that cross here. Relative strength is not crossed over yet. Neither is OBV, but looking at them, they're about to cross. So that's how I use the scans to find what I want to do. Let me go back into the PowerPoint. So daily momentum bullish is looking for those double dots above the squeeze. And these are stocks that have, for me, have performed very well. A breakdown would be a double red dots on the momentum. A pullback in an uptrend, here's a stock that's in an uptrend, has pulled back to support and it breaks out. A retracement in a downtrend, the stock's in a downtrend, it retraced up towards this resistance line and broke down, or to this moving average and broke down. A long-term downtrend breakout, here's a long-term downtrend, and we broke out above it. I want to find it when it breaks out. A long-term downtrend bounce, it's downtrend, it pulls into the trend line and it breaks down. Long-term uptrend bounce means I'm going up and I pull back. I'm going up, I pull back, and apparently, oh, it's a breakdown, and we broke down right here, retested. This is a perfect short. This is back month, so it's not a short right now. And then the same thing on the short term. So I've got scans that were made by William and I and Jeff Gibby that helped me find the things that work for me. So summarize what I just did in a whirlwind. And I talked too much in the beginning. That's what I always do. One, what is the market direction? Well, I think right now we have a market that still technically looks like it's going higher. What is my conviction? My conviction is falling because AD line divergences, the Hindenburg omens, the horrible breadth that we've been seeing, the absence of new highs. Now, that's great, but I didn't tell you to short the market. Why? Because all my weekly major markets are still bullish, still saying it's going higher. So if I'm not shorting, but I don't have much conviction, I've raised cash. So I'll go long, I'll go small. I'll have tight stops. And yes, I might buy some contra ETFs and try and front run a pullback, but I would be doing that as much for insurance as any other reason. I don't have a signal to do that. You want to learn more how I do it, how I trade options, and I'll have time for some questions. Come see me in Phoenix. This is my cheap meeting. In November, I have my expensive meeting, which is in Palm Beach Gardens, right north of West Palm Beach. I do it with John Person, but that meeting's $1,500 or $1,600. It's not more expensive because we're in Palm Beach. It's always been low cost for Orange County, which I moved to Phoenix, and higher cost in the one in Palm Beach. Nicer hotels sometimes, things like that. Market MRI Pro at gmail.com is how to find me. Go to YouTube. You can put in Market MRI Pro. You can put my name, Jeffrey Scott, and the word stocks, and you'll see hundreds of videos, including the ones where I do market turns. So I have found that trading with a top-down approach over the long term is the best for me. My timing model is designed to capture most, it's 8 o'clock, of a big move, but more importantly, keep me out of major downturns. It's objective. It does not repaint once the day is done or the week is done. The weekly guides my direction. The daily guides my level of commitment. The expirations are to help me find my favorite setups. Once I've identified a list of charts, I review them, looking at setup, support, and resistance. Thus, the indicators and scans help me locate actionable stocks, but it's the chart that guides my decision making, and I don't trade against a major trend. As I mentioned, join my top-down trading Google group. You'll get free mentoring, nightly videos, notes when I think they're important. Everybody goes on moderation on posting until I realize you're not a spammer, and then you can communicate in the group. At least quarterly training events for those that own my products, live seminars, and I answer my emails. Thank you, and I'll turn it back over to Jeff.
One quick question for you, Jeff. Good job, by the way.
Thank you.
John Nichols 456 in YouTube says, Is there a problem that there are a lot more Hindenburg omens than crashes?
Well, you need one Hindenburg, doesn't mean anything. The second Hindenburg is a sign that it's confirmed. And then from that point, you know you have a 1 out of 4 chance that you got a major pullback coming.
All right. Okay.
All right. If you have 7 or 8 Hindenburgs, I've never looked to see if it correlates, but markets don't go 10% up after a Hindenburg omen. They go flat, they go a little bit down, and some just drop like a tank.
Okay.
I worry about the drop like a tank.
Yeah, that's as you should. Those are the ones that hurt.
Yep.
That's all the questions we've got. I do want to talk a little bit about how to get the indicators, all that kind of stuff. But before I do, I want to say thank you for coming and spending some
You
time.
bet.
finishing
Thank
up with
you.
us today. All right. Let me go ahead and share my screen. And we'll just talk a little, we'll just finish up with, oh, okay, entire screen. I'm gonna move this over here so that we can see this. All right. So with Market MRI, Jeff did a really good job of kind of going through and identifying exactly what it did. I like his top-down analysis framework, the sector analysis he does. It includes his bongo timing model, his dots indicator, the high jump, the relative strength versus the S&P 500, the timing signals, all of this stuff. All the stuff that he showed you pretty much, except for cigar stuff, is included. And that includes 11 custom indicators. The scanning, of course, you're going to get scanning with Metastock. You're going to get those 3 expert advisors, a system test, the 4 professional templates, and a video with 3 online training videos that are guaranteed, are not guaranteed. They're designed to help you succeed in terms of what you're doing. We will give you a money back guarantee on this, though. Normally, and I think it's underpriced for what it is, normally Jeffrey Scott's Market MRI is $997. At the conference, we're going to do a price of $597. We are going to back that with a money back guarantee. We're going to include access to all the training, everything you need to go ahead and get started. If you don't have Metastock yet and you need a trial, we'll throw in a free trial. So to do that, you can go to metastock.com/marketmri, which I'm going to type in the chat right here. You can give us a call at 800-882-3040. You can also visit us at metastock.com/saleschat. So all of the stuff you need to run this, just getting that link chatted out, is going to be included. You get a money back guarantee. You can evaluate it. You get a free trial to Metastock, metastock.com/marketmri. A big thanks again to Jeff for being here and for spending some time and for finishing up the day with us. As we get out of here, I want to say thank you to Stocks and Commodities Magazine for sponsoring the event. You can find out more about them at traders.com. You can also join the Traders Forum community at thetradersforum.com. We've talked about it all day long. Join it. I'd love to see you there. All of the offers, the extended trials, all of the add-ons that we've talked about today, you can find at metastock.com/conf promo as well. Metastock.com/saleschat. You can give us a call at 800-882-3040. We got another full day of people tomorrow. Great guest experts that are going to talk about the markets, what they're seeing, all that kind of good stuff. So I look forward to seeing you again tomorrow. Thanks for coming in today. Thanks for spending some time with us. I hope it's been beneficial. I hope you've learned something. And I'll see you again in the morning.